What's up, everyone? Welcome to the show. My name is Mike Butler. I'm here with Jermal, Chandler, and we've got some retail earnings on deck today, amongst other things. But E-minis are down 36 right now. NASDAQ is down 380. Join us on the YouTube channel if you haven't already. We're streaming live there. You can throw in your trade ideas, questions in that chat along the right-hand side. But Jermal, how you doing?
PCA, 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 PCA. Did you see that last night?
I saw that he hit a homer in the first.
Hell
and then Suzuki
yeah.
hit a homer in the first.
And then he hit a homer to close the game out.
Did he really?
Yes, walk-off homer.
Amazing.
It was awesome.
I feel like there's been magic at Wrigley recently with a lot of walk-off wins.
Yes.
I feel like that is statistically accurate. We have one of the highest walk-off win rates this year.
I feel like that's probably accurate. We're going to make it accurate, but that was a really fun game last night. I'm still hyped up from that, obviously, as you can tell. So that's how I'm doing. I'm doing hyped because of that. Other than that, like you said, we got some retail stuff going on today. It looks like some housing-related stuff as well as retail. I guess housing starts are hitting right now. Building permits, all those type of things that, honestly, most of us don't pay attention to. But it's fascinating having those on a day where you have Home Depot earnings. Stock is up slightly. As a result, they say that people are doing not the big projects, but the small projects. So that's good. I have a Super Bowl in there. I think that might have been one of my trade of the days. So yeah, that's pretty much what I'm paying attention to. Market's down a little bit here. I think this is a good thing if you're bullish in the market to see the market slightly down. And by slightly, I mean it's less than 1%. So it's nothing big. And people have been talking about how low vol is. I certainly have more recently talked about that yesterday on Tasty Crumbs with Jim Carzon. And we just went through that whole complex of volatility. But other than that, man, just chilling.
I like it. Yeah, I mean, it's going to be an interesting day here for some of these earnings reports with the market down, but not really moving too much from the numbers this morning. Crude oil up a little bit, though, and this has been kind of the talk of the town here. This curve in the back is silently increasing a point every day. Like this was in the low 70s a couple days ago. It was in the high 60s last week. And now we've got 74, almost 75 in the furthest dated cycle. And we are increasing backwardation in the 30-day relative to the 60-day by a little bit here. But this is really the story. Higher prices for longer. And this is kind of creeping in quietly, unless you're paying attention to this curve.
Yeah, it is. Almost seems like a USO trade is in order once again, taking advantage of that. But yeah, you're right. We've seen that. We watched that curve a lot over the last several months. And again, I mean, these months do change. I mean, we were looking at it 2 months ago. Obviously, it was probably no May and no April. But I feel like at the time we did, it was well, at least the May might have not been there. But even when we did, it was in the high 60s, and now it's in the mid 70s again. So it does seem that oil is getting a little bit crazy again.
Mm-hmm. Indeed. But yeah, lots to talk about today. And we've got a bunch of guests. Why don't we give the people the schedule of the day?
Let's give them a little preview.
Yeah.
Got a little preview? What we got? Opening bell. Then we got live trades with TP at 8:45 a.m. We got live from the trade desk with Q at 9 a.m. No, wait, this is old. That's not right. What we do have is,
keeping us on our toes.
We do have Chris coming up at 7:35 a.m. I do know that. And then we do have Kevin Davitt coming on at 8 a.m. And he'll come and talk to us about what he's seeing more recently. And off the dome, I know we have obviously opening bell at 8:30. We do have a guest coming on. Kathy Lien will be on today to talk to us about. She's more kind of a little bit macro, but a lot of Forex. So she'll talk about that. I know she trades gold a little bit too. So we'll get some insights from her, among other things. We do have what a lot of people have talked about later in the day. Trades of the day. It's kicks off at 11:30 a.m. with myself, followed by Mike, followed by Errol, followed by Chris, and followed by Ilya. So check that out. That's what I do now.
That is correct. Yeah, it's been fun getting the deep dive into different strategies. It's been nice, and I think it answers a lot of questions that people have about certain strategies and how to find trades and defend trades, the whole 9 yards. But yeah, this will be an interesting day. We're kicking off the bulk of the earnings that are happening this week. As Jermal mentioned, you've got Home Depot up about 8 points, 6 points pre-market here. You have a bunch of other retailers, Target, Ross Stores,
throughout this week,
TJ Maxx, Walmart throughout this week. But yeah, I think Home Depot is going to be an interesting one because this is one of them. And I actually charted all the retailers together. But Target is by far the biggest gainer on the year. So Home Depot is rallying pre-market. Maybe we get a little interesting move to the upside here. It'll be great for us.
Flat to 2%. I mean, they did beat on both levels. So, you know, there's that. They beat on revenue. They beat on EPS. But like they said, the beat came from small projects. So it does comport with the fact that we're in a very expensive housing market for a lot of people, and people might not necessarily be changing home to home like they were a few years ago, if you can remember that, but they're staying within their home. They're doing a lot more small projects. Who are these people? Because I'm not doing any small projects, I'll tell you right now.
I did actually just redo my bathroom with a Home Depot vanity. So
well, there you go.
Me.
It's you. It's you.
But yeah, before we bring Chris in, if you want to bring over to the chart that I've got pulled up here, you can do this on the platform now. You click this little compare button at the top and you can layer on different stocks against each other. So you can see the Home Depot chart is the standard green and red candles, but all the other ones that I've listed here, Target, Lowe's, Walmart, and TJ Maxx, you can clearly see Target is the big gainer on the year so far. Everything else is kind of just chopping around, and Lowe's is underperforming relative to Home Depot. So
Target's had a good year. Does that mean people aren't stealing from Target anymore?
I guess so. They're retaining some revenue. But yeah, it will be the week of the retailers. We'll get a lot of information about the consumer this week. So stay tuned. But we do have Chris Vecchio on the line. And Chris, I got to know, how's being back home, back in the home studio?
It's nice. I just didn't expect to come on to hear Jermal talking about shrinkage so early in the morning.
Yeah. Well, you know, you just never know what you're going to get when you tune in the Tasty Live show in the mornings.
That is
No,
fair.
inventory shrinkage has been a huge problem for Target, and you know, they seem to be overcoming it.
Yeah. Yeah, they do. They do. I'm a little surprised because that was a real problem for them. I forgot this stock was trading almost $300 at one point in time. I'm like, wow. I had a position in here, and I took it off. I was like, okay, this is a little bit much, you know, because I was just basically paying attention to the year, but I just pushed back over the last 5 years. Holy cow, I completely forgot what this thing used to trade. Another position might be in order.
Target's had an interesting run recently, in part because it found itself in Bud Light territory, drawing ire from both sides of the political aisle. So sales dropped off from both groups, but management really has fixed the ship this year. I think the Home Depot read is more interesting, right? Just in terms of like sustainability for a company, their business, as you pointed out, come from the small things, not from, you know, new housing projects, which at these mortgage rates, which are going higher today, thanks to that 30-year yield, those are going to be a little bit more expensive and hard to come by. So if that was their line of business, right, new home construction, you'd probably see a little bit more of a problematic reaction for the stock. But the good news is that yesterday, guys, for trade of the day, so to speak, I rolled out the idea of the day, which was short iron condors across all these retailers. We've had a bad mix of data, so to speak, for consumers. And the iron condors were giving you more than a third of the width of the strike, like 96 cents, 95 cents on a $2.50 wide strike in some of these names. So Home Depot, Lowe's, Target. What else did we put on yesterday? There was a third one here, and I just need to pull up the platform. Walmart as well. So for today, the Home Depot 3 days to expiration, 32, 2.5, 325, I should say, and then 352.5, 355, short iron condor. That looks like that's going to work out just well. And it makes me feel confident about Lowe's, by the way, because as you mentioned, Lowe's has been underperforming, and Home Depot had a little bit of a potential management issue with their CEO taking a health leave, and so that could have had an outsized impact on the stock. Clearly did not. So I'm feeling good about these retailers this week, maybe inside and up, but perhaps some of that good news, right? Lowe's is up pre-market.
Yep.
How much is that pricing in their earnings that are due out around the corner? Either way, though, I'm feeling good about the short iron condors right now, given what we saw this morning.
Yeah, Lowe's and Home Depot both up pretty sizably pre-market here. Home Depot is continuing to rally up to 345 now after closing at 338. and Lowe's is up to 218, 219 after closing at 215-ish. So yeah.
There's several times where you will see Lowe's do a similar thing on earnings to Home Depot. There's also been times, not gonna lie, where it runs on Home Depot's earnings, and then the next day it has earnings, and then it fades. So I don't know. I guess we'll see what happens. But I mean, they have
listen, my short strike.
What's that?
My short strike in Lowe's is 205. So if this thing wants to rally a little bit today, then come back down tomorrow. Hey, okay.
Yeah, I mean, we'll see what happens. But again, they're going to have the same issues or positives as well. So I mean, you kind of look forward to that. I'll tell you guys, as I'm looking at markets here, and again, they're barely moving, right? They're only down 0.5%. It's always funny to see them down. I'm sure the world is shaking for a lot of people, but this is nothing. But it is interesting of note that this is the last day for August VIX options to trade. August VIX futures expire tomorrow, so it's something to keep an eye on with the last 2 days. Market sliding a little bit here.
Yeah, and
So
I think
short vol, you think those trades are being lifted? Is this just short covering in the VIX, Jermal?
Maybe. I don't know. It's so hard to really think that this is going to really lead to something on the other side of tomorrow with the VIX expiration, but make a case for it.
I think that if you have a bear case, this 4-day rip in the E-minis after Microsoft and Amazon and Meta and Apple earnings, this is really the lift from those 4 companies. So if we do reverse, we're moving back through this range here. This was like zero resistance, just rally it to the moon. You could see it go back the other way pretty easily. So
yeah,
we'll see. I
mean, as our man in the chat just texted me, how bonds got to 107 in the overnight session, and so that's kind of the quiet story that's happening here, right? Buy bonds, ZB 30-year bonds. It's kind of the quiet story that's happening here, right?
I've been making all sorts of noise about this.
I know.
I need to speak louder, Jermal?
Yes.
Yeah, you do, because the market's not hearing you. You know what I'm saying?
I did actually I bought a TLT leap yesterday.
Did you?
Just for fun.
Old move cotton.
Yeah. Yeah. TLT is 20 plus years, right? It's like a combination of 20 year and which doesn't really exist anymore.
I think it's like effective duration is something like 15.6 years right now. So it most resembles ZB if you're going to trade it.
Yep.
It's not perfect, but here's the thing. Bonds right now, oil's coming off a little bit. The memorandum of understanding. So, morning news, right? What happened overnight? The U.S. memorandum of understanding ran out with Iran. Iran says that it's shifting from a defensive to an offensive posture now. Trump's saying that it's going to bomb Oman and Iran if they continue to be duplicitous and backhanded. We're declaring the Strait of Hormuz a U.S. territory, apparently. I don't think any commentary is needed on that. Oil is a little bit higher here, but look, we have now this combination. There's clearly more stress in the system because of inflation pressures. Can you guys pull up CRAK, CRAK, the refiners ETF here? CRAK is running through the roof right now. And we think about how, what this reflects. The margins are going to be much higher for your refiners. Do you like paying high gas prices, folks? If you do, I have good news for you. If you don't like paying higher gas prices, you might want to turn off the next few minutes because inflation's coming. It's still coming. It's going to filter through into everything. Food prices, housing, right? How do you get food to the grocery store, Mike? On a truck.
Oil.
We don't have enough Amazon drones there. Yeah, diesel. So when our inventories are being drawn down to help insulate the world, which they have been for the past several weeks and months, eventually you start to go towards tank bottoms, and then you get dramatic move higher in energy prices. So the fact that the CRAK ETF, when you look at the individual components, MPC, Valero, Phillips 66, they have been showing so much more strength than your Exxon Mobils, the Chevrons of the world. That to me is a big red flag. So ZB right now breaking down to a yearly low today. It did hit to the 107s overnight, not when I was online and I wanted to take off my 108, 107 put spread, but I'm going to hold it for a little bit longer here because this continues to work. This is so textbook, guys. And I really insist on this being so textbook. When monetary policy is looser for longer, the market wanted hikes, and now it's saying we're not going to get any this year, and inflation continues to press to the upside, inflation expectations are embedded at the long end of the curve. Higher yields need to go out. They need to persist. So 2 steps down, 1 step back. This has been one of my better trades. TP got me on this a few weeks ago, and I've just been milking this whole thing. If you see a pullback to its 1 month moving average, it feels like it's been an opportunity to try to sell some bonds here. So I'm continuing with the long put spreads. This is the biggest news in the market today. It's going to bring more attention to some of these long duration tech names. And so perhaps this is the straw that breaks the camel's back, Jermal. We have expiration, we have OPEX, we have NVIDIA, we have Jackson Hole, and now we have 30-year yields at their highest level since 2007. I can't believe that my mortgage rate's lower than the actual 30-year yield now. That feels good. That feels really good. I'm basically borrowing for free, right? No, that's not how that works. Damn.
Yeah.
I had to get that sweet 3%.
Yeah.
I know I have a friend that has like 2.85%. I was like, well, have fun in your 30-year house that was staying in for 30 years.
We put in a bid for a home, and Bank of America, our 3.8% mortgage offer expired because just couldn't get a home, right? This was late 2021 going into 2022 when like it was peak panic and surged after COVID. And then we got knocked into a 5.15 rate. And so I took my business away from Bank of America. No, it's not. I took my business away from Bank of America. I'm like, screw you guys. I'm going to Chase.
I love that their bias of like, no, it's not because I had a 3.8.
Like, no, it's not.
But it was 90 days. That's what mortgage rates were doing back then, right? And that just blows my mind. Where if you look at today and you would apply the same mortgage spreads the banks put on, the lenders put on for like things like prepayment risk, for example. And so you had a lot of prepayment risk back in 21, 22 because everyone says, okay, this is temporary. Rates are going to come right back down.
Right.
All these people are going to refinance here. But if you had the same spreads today that you had back in 2022, the 30-year mortgage would be approaching 9% now. So let's hope we're not heading there.
Mm-hmm.
And yeah, Frankie, I know you're going to say, oh, when I bought my first home, rates were 18%. I don't care. We don't care. We don't care.
I did have that thought in my mind. I was like, Frankie's going to say something like, oh, well, back in my day. What, 10?
Yeah, and back in those days, you'd bump into someone on an elevator and be like, oh, can I have a job, sir? And be like, well, whippersnapper, come on up to the 50th floor. And then like next thing you know, you're CEO.
Exactly.
So, like, it's a totally different economy.
Times. Exactly. Yeah. True that. True that.
But yeah.
Like jobs in the paper.
Houses back then were also the same price as a really nice car. Like it's crazy.
Well, that's been the big problem over the past 30 or 40 years, to go like philosophical. The cost of living back then was tethered to like your income, and all the things that were seemingly the extravagances, the extra things in life, those were out of reach. But now everyone has a smartphone, everyone has a car, everyone has a computer, everyone has like the fancy add-ons, but the cost of living things, the rent, the shelter, the utilities, all that stuff has gone through the roof. So day-to-day living is so much more expensive. Guys, it's like the funniest thing. I bring this up to my parents all the time. We label generations by names in America. There is a generation known as the lost generation, which goes all the way back into the 1800s. Mm-hmm. People under the age of 40 have lower cumulative age growth from the ages of 18 to 40 right now than what we dubbed the lost generation. So I stop with this nonsense about how, millennials just need to stop eating their avocado toast and make coffee at home. No, that's not buying us our home.
Chris is like, no, I'm not. I'm still going to get my avocado toast every day.
Chris,
got to do it
on the soapbox this morning. I love it. I love it. I love it.
But yeah, we brought this up earlier. The crude oil curve lifting silently. It's like a snake going through the grass here. But these were literally in the 60s a week ago. Now they're in the high to mid 70s, which speaks to your higher for longer inflation hasn't gone away, et cetera, et cetera.
Yeah, this is something to keep an eye on. Again, there's a lot of little things happening right now in this quiet time that we've had over the last couple of weeks. And we just got to take note of them all. I think it's also bears mentioning, I think we talked about this last time I was on, but just mentioning again, this has been a good time to not overposition. And by that, I mean, like thinking that something, coming up with a big thesis, putting on positions for that, and then all of a sudden we get a market that just doesn't work to that thesis, then you're stuck in that position, right? So, I mean, I think it does bear mentioning right now. I think you really want to be careful about where you're positioning, making sure you're just being smart about your trades.
Jermal, could I bother you to pull up? I saw it last night. You tweeted about this, and it wasn't. I hate Twitter's algorithm now. Stop showing me things that people are tweeting out 3 days ago as like the first thing I see when I go on. It doesn't matter if I said it's a recent. You tweeted something about how there was a Bloomberg article. There was a chart in there about how folks are basically like selling iron condors. I have to scroll through all of your tweets about PCA. Yeah. Piling into multiple short about, that the worst trade in Mets history, piling into multiple short iron condors with VIX below 15, quote, just to try and make money because it's a boring market, quote, does not end well.
Yeah.
Guys, this is kind of what we were talking about yesterday on the morning show. And so you mentioned this, I think on Sunday afternoon is when you tweeted this out.
Mm-hmm.
When the ranges in SPX, when you get through that open, if you can't get filled on an iron condor when it's like 30 or 40 points wide and this thing collapses to low 20s or single digits, that is the picking up pennies in front of a steamroller. And so just avoid the temptation. You don't need to overtrade the indexes. There's plenty of little things that are going on. And quite frankly, if things don't meet your criteria, right, don't step out of your comfort zone. Learning to trade a new style in a thin market when the VIX was just below 15 and stocks were at all-time highs, you could find yourself landing on your face pretty quickly. So that's why I'm sticking to some of the individual names right now. I haven't added on any index level positioning. Really, I took a little shot on a call butterfly in the triple Qs, which was like $20. So that doesn't really count. But in terms of the positioning elsewhere, the consumer names, the names that aren't related to AI, a lot of consumer staple stuff, diversify. Don't necessarily look to sell vol in the indexes when they're sitting at all-time highs before you get a meaningful pullback here. So Jermal, can you just go on about piling into multiple short iron condors for a brief moment?
Yeah, I mean, when we look at that montage, options montage we just saw right there, I mean, we got a 10 IVR, right? 10 IVX. And so the tendency for some people, Mike has it laid out like 10, but like the tendency for some people could be to make that thing $20 wide right now to try to get a decent size credit and then size up and do like 5 of them, right? And like that's the situation where I'm talking about. Like, you're doing 5 $20 wide iron condors in a situation where IVX is really low. That's not a good idea. I mean, it really isn't, because right now we're moving 0.5%. All of a sudden you get on the other side of maybe a VIX expiration and we move, all of a sudden like a 1.5%. That's the day you get blown out on that type of trade. So you just got to be careful in this environment. It'll come back to you. It'll come back to you at some point in time, this volatility.
Yeah. I think when you look at the 1 day expected move in SPX and it's 25 points, like you can't do an iron condors in that environment. You're just asking to get blown out because like we're down 35 points right now. That's all what else can you say?
Mm-hmm.
But because we're down 35 points right now, I did throw on a 1 day Super Bowl in the global trading hours session, which you can find here. If you're placing a trade and you flip the trade session to global hours instead of regular hours, you can trade SPX basically 24/7. SPX, RUT, XSP, and the VIX all have global hours with many more to come in the future. But yeah, SPX is going to open right around 77.10. So I'm just taking a stand here at 7,700 for through tomorrow. Sold the 5-point wide put spread there to buy a 10-point wide call spread. If we get a reversal of this move, this will be a couple $100 winner. I can close it.
Cool.
But yeah, that's the pre-market trade of the day.
I like it. Hey, Chris, before you head out, I want to do a little something that they do on Good Hang with Amy. With Amy Poehler? You ever watch that? You ever listen to that, I should say?
I've seen clips online from time to time again. Yeah,
so
sure.
One of the things that they do, that she does, is talk to somebody about the person that's coming on today beforehand. And we have Lien coming on. And I was just curious, her being a Forex type person, I think you know her a little bit. Any questions you think we should ask her and talk to her about today?
She was my first boss. That is true. She was the head of the department that I was in at my first internship when I was 18 years old. And then she left the company the next year to start her own firm with the other guy who was the head of the department, which, when people at the top leave, usually that means there's openings for others to try to climb the ladder.
Mm-hmm.
So I suppose I should say thank you for leaving the company when you did, because it created openings that I was able to take advantage of. And voila, here I am.
Mm-hmm. Mm-hmm. Nice.
Beautiful.
Definitely talk to her about that. Now that you mentioned, I didn't know.
Yeah.
I had no idea about that. I thought you were going to say something earlier. Forex. This is even better.
You know what? I think we should ditch the Forex stuff and just talk about Chris
most
the whole time.
definitely. I got all kind of
Talk
questions about young
Chris,
Vecchio.
Chris the whole time.
For sure.
Yeah.
I have some stories off there.
I bet
Not about
you
Kathy,
do,
about the
friend.
other guy. About the other guy who
I can hear it in your voice.
you get to know people when you're at the office at 5 o'clock in the morning, and it's
Yeah.
like, okay, yeah.
No, you really do,
You learn
man.
some things.
Yeah, you're taking me back now. I remember going in super early when I was at Peak 6. Yeah, you do get to know people. God, there's some assholes out there. Anyway, it does look like it's going to be somewhat of an interesting day. We'll see. It's been kind of quiet over the last several trading days, right? But the last two, a little tiny bit of movement here. I think we're starting to get to something, fellas.
Yeah, I
I
think.
can't believe that. I haven't seen Kathleen in person in like 18 years.
Yeah, it's kind of
Crazy
wild.
times.
Hey, man, it's a small industry, man. I mean, it really is.
We should bring you on and it's like a surprise guest.
Yeah, man, no,
Won't
right?
remember
great.
me.
Be amazing.
You never know.
Won't remember me. Summer intern.
Never
Definitely
know.
not.
I guess
You never know.
You never know.
But yeah, I agree. I think we might get a
Summer
little
interns.
volatility here. E-minis down 35, NASDAQ down
I'm in a
380.
good mood this morning, guys. PCA.
There you go.
Thanks, Chris. Thanks for sending
Producers,
him this
please
way.
take me out of the show. Get me out
Thanks
of the
for
show.
sending him this way. We
Get me out of
appreciate it.
here. Please get me out of here.
Chris, your wish is my command. Enjoy the rest of your morning. We'll see you a little bit later.
Later, man.
Can't now. Thanks, Jermal.
E-minis down 35, NASDAQ down 386. We're going to come back with Kevin Davitt from the NASDAQ. You're watching Tasty Live. We'll see you soon.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Step into the futures arena with Tasty Trade's Active Trader. Multiple ladders, hundreds of indicators, precision control. From micro gold to NASDAQ, all CME one click.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Diversify your portfolio with stocks, options, futures, crypto, and more. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Tasty Trade. Download today.
Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than trade like a trader? Tasty Trade.
What's up, everyone? Welcome back to the show. We've got the E-minis down 33, NASDAQ down 380. It could be a wild day in the market. We're currently down more than the continuous projected move in SPX, but we've got Kevin Davitt in the house as well as Jermal. Kevin, how you doing?
I'm doing great. Glad to be back. I think your point about expected ranges is an interesting one. We have seen index implied vol levels fall to historically, the lowest level since very early in the year, and absent like half days or days right around the holidays, the lowest levels we've seen in quite some time.
Yeah, we are in the single digit territory, 9.8% IV for today in SPX, 10% across the board. And it doesn't really kick up until later in September and into November, October, November. That's kind of where the realized volatility could be. But right now, the implied is just nothing. Crazy. 26 points for the rest of the day is insane on a $7,700 product.
I tend to agree.
And let's make our man feel at home here. Let's pull up some NDX and look at those vols too. I mean, pretty low.
It's going to be similar.
16s. Yeah, I mean, 16, 17. I mean, we just don't see that, right? I honestly wasn't paying attention. What if you know off the top of your head, what were we seeing like a month ago when we had these earnings? It wasn't even a month ago. It was 3 weeks ago.
Yeah.
The 30th, 31st of July.
Yep. So a couple of weeks ago, let's level set. Over a long time frame, what is typical on a one-day basis in NDX is up, down 1%. So for around 30,000, you would expect that straddle to be in the neighborhood of 300 points. When we were moving with greater velocity around earnings, that got up to about 1.3, 1.4%. If you get up toward 2, that's when we're seeing some fireworks. More recently, we have seen those daily ranges compress down to about as low as 0.7%. So then if you think about a $30,000 index, you're talking about what, like a 210 point straddle? Distinct difference. And your point about even with this low volatility, just thinking in point terms, whether it's 26 on the S&Ps or 200 in NDX, after a morning like this where we're already down 400, it strikes me as wild that they're not more reactive in the front of the curve.
Yeah,
no fear.
Interesting. I mean, remember, so it was actually about almost 10 days ago. Remember when I sold like a strangle in AMD because it was still higher IVR, and I was thinking it's going to be quiet, and this is actually really high vol. I did an AMD SMH, and I only had the cojones to hold it for like 4 days. I mean, honestly, I made like crazy money from it too. I originally wanted to hold it until here, thinking, this is the Tuesday before VIX expiration. On the other side of this, we might get some wildness, but I didn't want to push it too much. But yeah, I mean, that's exactly what you were able to do over the past 10 days or whatever. If you wanted to sell a strangle in a name that's 100 vol on a single name, and those have come in like meaningfully. When I say AMD, like is right before I give you the floor here, I sold AMD, the SEP, it was 75 IVX or 75 implied vol at the time. It's 57 now.
Yep.
That's the kind of last 10 days that we've seen here.
So there's a couple ways I would love to take that. One, let me just be direct. What happened 4 days later that made you just say, all right, it came in so fast that you were like, I've made a ton of dough?
Yeah. I made $1,000 in like 4 days in AMD, in a strangle. So
no apologies for that, right?
Yeah.
There you go.
The dynamic that you're talking about has influenced the relationship between NDX vol and the S&Ps. And it worked in reverse earlier in the summer. So what you talked about where whatever 1 month, 6 week AMD vol came in by a third, 75 to whatever, something in that neighborhood. That happened across the semis. And what we saw over the course of the past 3 months is that NDX vol, whether you're looking at VXN minus VIX over VIX, or just your at the money vol relative to the S&Ps. I did have a visual there if I could get your production to pull up that one. The relationship has normalized very, very quickly. We'll see if that continues to be the case. Just to put some numbers around this, on average, front month at the money NDX vol tends to trade at like a 4.5, 5 volatility point premium to the S&Ps. That got up to 12 points when we saw this real, thank you very much for that visual. This lays it out. On the bottom right-hand side, you see how dramatically that volatility spread in point terms has come in over the past couple of weeks. I would imagine you put on that AMD trade when the spread was probably closer to 10 points at the index level.
It was
and it's
August,
just collapsed.
August 7th. Yeah.
It's collapsed. Now, what does this mean when we get through your point about VIX expiration, which historically has been kind of an unwind for, or a potential widening of realized ranges, or this Friday's August standard expiration?
Mm-hmm.
I don't know, but it's on my radar.
Mm-hmm. Exactly that. We don't know, but it's on the radar. That's exactly the point. Yeah. Yeah. Look at that, man.
Yeah.
That's craziness. That is
So,
wild.
Just going back to this bottom chart, which again is the relationship at the money vol between the two indices in point terms, you would have to go back to like the early 2000s to see spreads that wide. What we saw, very much centered on the semi names this summer, has been very unusual. My inclination is to believe that it's not over, but maybe I'm in the dark here. I don't know.
So to that end, I mean, we were hearing a lot of comparisons between the current, more recent environment and 2000s, and you just brought it up again. Is there any parallels here? Did we see vols calm down this much prior to any craziness, or this is different from that time?
My personal take is that there is so much different in terms of the constituency in the NASDAQ 100 and their profitability, where those comparisons on a volatility basis, I think it's very interesting. And for option traders, I think the environment, that backdrop was rife with opportunity. But in terms of the like selling the fear of an index getting cut in half, I don't believe that. The correlation these days between the S&Ps and the NASDAQ 100 are much, much stronger than they were 2 decades ago when you and I were, kind of just introduced to this business.
Mm-hmm.
So when you think about opportunity in the markets in volatility terms, there are comparisons that I think are reasonable. But bigger picture, I think that's a bridge too far. Just my take, though.
Yeah, I think this is another way you can see this on the Taste Trade platform is you can pull up on the indicators. You can go to implied volatility and just layer it on below the chart. And here in NDX, you can see we reached a peak of around 33%. This is just the IV index that you see on the right-hand side here, which is basically this number, 16%, 17%, but it's around the 30-day mark. So the 30-day implied volatility at 21%, you can see that right here in the chart that we're sitting right there. But we were as high as 33% just a few weeks ago, and we've had this big 10% collapse. And that's where you got your big payment from AMD, because you can see AMD was sitting at a peak. When you put this on, it was sitting around 70%, like you said, and we're now down sub 60%. But it was as high as 90% pre-earning. So layering on implied volatility like this really helps you see what range is the product moving in terms of implied volatility. on top of IV rank. IV rank tells you 0 to 100, where's the low and the high. But this spread between the low and the high is where you really make your money from a premium selling standpoint. If you see an IV rank of 0 and 100, but then you look here and there's only a 5 percentage point spread, you're not going to make any money from selling premium. Like that's just it. Like that, there's no vol crush in that environment. Where in AMD and NDX, you clearly see that you had that vol crush of 10 percentage points or more over the last month.
And that's a great illustration because you might not catch the 90 vol. Like you might not catch that one, but it's fine to catch 70 down to 50. That works just as well too. But I tend to agree with you, Kev. I mean, this is a different environment. It's not the same. And honestly, I think what we've seen more recently serves to explain that this is not 2000. This is not 1999. I mean, this is a different time period. It's not the exact same market as it was back then.
What I found it interesting to see how kind of consistently AMD vol moved up for the better part of the past year. Did that tendency play out in, or here, what do Broadcom and NVIDIA, the couple names that I think still have yet to report, is volatility holding up in those names on a relative basis? Wow, it's come down quite a bit.
Same
wow.
deal.
Yeah.
Interesting.
And that NVIDIA is especially interesting because they have earnings coming up.
Yeah.
Where the others have already reported. So you would expect to see maybe it fluttering around near the highs, but not.
But that's just how high it was, though, in these names, right?
Mm-hmm.
Like it was really that high.
Yeah.
Switching gears a little bit, have you guys talked at all about like the health of the consumer this week with a lot of retailer names? I think we have Walmart tomorrow morning. And from a corporate standpoint, we were obviously super hyped to see their listing move and Walmart move into the NASDAQ 100. And that's probably not a name that most people would associate with the NASDAQ 100.
Yeah, I didn't even know that.
Yeah. Yep.
That happened.
Yep. The listing move was late last year, and it was added to the index. I can't nail the date, but very early this year. So, and it's a top 15 constituent in the index.
What was the interest rate? We have been talking about it, actually. We were talking about it this morning too. What was the interest rate, and when was the first year you bought a house?
The first year I bought a house was 2015. I was a little bit late to the game. And
that's
then,
right. We were on the same. I bought mine. That's right. We talked about this before. I remember because I bought mine in 16. Yeah.
Yeah. Same. The first interest rate refinanced at 3 1/8, which seriously.
Congrats on your future wealth.
No. Well, I bought another place last year, and it's more than double that rate.
Yep.
Yeah, you learn about the cost of money and how much that filters through to everything.
Something else, man.
Yeah. How about interest rates? I mean, or the housing market, or just you think about one other thing here. I was looking at cars recently, and I switched my car out, and I go in and I look through like the loan stuff. At the low end of the car borrow market, you're paying like 25 or 27% on a car loan.
That's crazy.
Man.
That's nuts.
Yeah.
Yeah.
I got my car 3 years ago at 495.
Yeah.
But I also walked in there like guns blazing, like, I'll buy this car right now, but you got to give me 495.
Yeah.
You got to be sub 5%.
Yeah.
And they did. And I was like, wait, so you're really going to give me this car? But I just got my oil change, and they're trying to play the game. They're trying to say, oh, we really like your car. We want to pay you a premium for your car.
3 years is that point.
Yeah, because I'm about to pay it off because I had a 5-year loan. So I'm like, I literally told them, I'm like, I know what you're doing. Like, you want me to get a new car, which would feel good at first, but then I'm in a brand new 5-year loan,
right?
And I'm front loading all the premium payments, and they're like, here's some coffee.
Let me have some coffee. Let me talk to my manager.
Yeah.
They don't like it when smart people come in and they recognize what's going on.
I literally was like, I'm not selling this car. I love this car, but I also have 25,000 miles on it, and 3 years. Like I don't really drive it all that much. So.
What we're speaking to is the economy right now.
Yeah.
It is interesting, and you see the 30-year doing what it's doing, and you see oil moving around like crazy. And we talked about these gas prices that seem sticky, above 4%, at least in our area, right? I mean, this is all part of the little wall of worry that's beginning to build and add bricks to it. So
yeah, it's been wild. It has.
Home Depot went this morning. They said that people are doing a lot of smaller projects, not big projects, which you would imagine. I mean, people aren't moving from house to house like they were a couple of years ago, like we saw in the pandemic. That was crazy. I don't know if we see that again, but that was so wild. Same thing with jobs, right? It was just like, oh, well, you're just going to move here. You're just going to move to this one, going to move to this one. And now a lot of people are stuck to that house. I mean, and you're not really going to be rolling around to the next house right now just because interest rates are so high. We'll see what happens, man. I mean, we've looked at the CME FedWatch tool and the chance for a rate hike, and it's calmed down some, but it's got to be kind of weird to see what's happening at the back end of the curve right now, too. So I don't think it's great.
What, if anything, positioning-wise, are you guys thinking around Jackson Hole? It historically has been kind of a non-event.
Right.
Maybe I'm...
I think that's fair. Like most times, there's been some years, but I think the years where it was an event, there was something going on that year.
Yeah.
Right.
Yep. Tend to agree. Like debt ceiling or government shutdown stuff, which again could become a thing before terribly long. But you have a Fed that seems committed to being less transparent than previous Fed chairs, and you have an interest rate environment globally that seems concerning. And we're talking about how that ripples across everything. People feel wealthy in no small part because their portfolio has done exceptionally well. And could things snowball down the road? And is there anything you put on? We talk regularly about butterflies. And typically we're talking about relatively short-term hedges. Is that something that you guys look out? I'm just picking a number, but 6 months or for the end of the year, if we get some 15% pullback and look at the set it and forget it risk off trade?
Yeah.
Not that far out.
Yeah, I think the nice thing about going that far out is you can make it super wide.
Mm-hmm.
But yeah, we have the end of the month butterfly on an NDX. So the 29,000, 28.8, 28.6. And I mean, we've been hitting home runs like PCA, and you've been on a PCA kick recently. But yeah, we've been doing really well with those just because we've been fortunate with the timing. But really, having these on is not at all a big cost in the portfolio. Like I put this on for $700, this butterfly here, and it's currently trading for $5 into this rally. And I put this on over a week ago to this day. So if we get a sell-off here, and we're really not that far away, 1,000 points in the NASDAQ is just 2 more days like today, and we're at the money on that butterfly. So yeah, I have this butterfly on to the downside as a hedge, and then some neutral to bullish positions in some single name stocks to kind of offset it.
Well, I'm hoping I come back here in a couple of weeks and we're talking about, just for your sake, not for everyone's, but I do like to hear, and the way you've explained those historically, you can be directional with relatively small dollar risk, and it can offset a significant amount of other exposure that you have, and it can serve that role over kind of any number of time frames. I am starting, you talking about the end of the month options, pricing the end of September and end of October's the butterflies, and I'll come back to you on what I decide to do there.
Nice.
Yeah, I mean they've been good hedges, and again we've been fortunate with the timing. But really, at the end of the day, that this is the hedge in this portfolio that I use really exclusively because it's the best bang for your buck for a high reward, low monetary risk, and the monetary risk doesn't really move all that much until you get closer to expiration, where then it's like, okay, the probability of actually getting here is now 0. But until that point, like even right now, we're 1,000 points out of the money, and it's a couple $100 loser, but it's holding on to 80% of its value than what I bought it for. So it's a nice hedge for sure. And if we do get a violent downside move, it explodes. So yeah, I love it. And then if we do get that big move to the downside, I'll be looking to add wider, like iron condors, just like implied volatility, range bound trades. So that's kind of how I've been playing it.
Yep.
I like the way you guys have been super transparent about your positioning when you close stuff, just as a market observer and somebody that also trades. I think it is real in a way that you don't often seem. People will come on financial media and really just focus on the stuff that works. And it's refreshing to see it update in real time and be like, oh, I remember when Mike put that thing on, seeing him take it off here. I think it's a great way to build understanding and community. So well
Thanks,
done.
man.
Yeah.
So that's a huge endorsement coming from somebody like you, a career trader. We appreciate that, man.
Yeah.
Good stuff.
Appreciate it.
Very welcome.
Well, Kevin, you're welcome back anytime.
Anytime.
Thank you very much.
We love the
I look forward
visuals,
to it.
100%.
Good.
We'll see you soon. But yeah, E-minis down 40, NASDAQ down 400. We'll see what the rest of the day brings, but we're going to take a quick 90-second break. You're watching Tasty Live. What's up, everyone? Welcome back. We got E-minis down 40, NASDAQ down 400, and we got about 8 minutes until the market opens here. Home Depot selling off a little bit from the recent high, about 2 points, but this will still be a nice winner here on the open after earnings here. Got the 350 long call in October, went longer term. This was also a relatively cheap option for the days to expiration, but also I wanted to get into this sub 30% implied volatility with lower implied volatility crush potential. And then I sold this 350 against it for about 25% cost basis reduction. But another reason why I went to October is so that you have the ability to roll to September. If Home Depot ended up selling off, you could buy back the 3-day, roll to September, go to a diagonal spread, crab trade, whatever, and you'll be able to reduce basis that way. But I think from a analysis standpoint, using this implied volatility overlay on the chart really helped me realize, okay, after earnings, what can I expect from Home Depot's implied volatility? Because this entire year, and this is basically what I did, the entire year we haven't gone below 22%. We've had our troughs here of 25%, 27%, and we're currently sitting at 28. So when I went through this analysis, I looked at crushing 28.7 down to 25, which would be pretty typical for earnings. But I also looked at bringing us all the way to the annual lows of 22%. And I think that is super important when you're looking at these trades and analyzing, what is my theoretical profit potential with, post earnings, and then a crush in implied volatility down to 22%. And that would be the low of the year. So that would be like the most conservative view of this earnings trade.
Yeah, I like it. I mean, and this is a decent scenario for that type of trade. I mean, you still have an opportunity to see if there's some upside that comes. And like you said, if it does, you'll be able to roll that short call into the next month there to September. So nice trade. The calendar call on earnings is such a viable trade. We've used them so much. We've talked about them a lot. I am in a different camp a little bit. Similar camp as far as I'm bullish, but I did the Super Bull in here, and I'll just have to. Well, I mean, I'm in a good spot right now, mostly even before this earnings, but short the 330, 320 put spread to buy the 360, 375 call spread. It is in September. That's the only real thing I have to think about here, how long I'm going to hang on to September with 31 days to go, or if I want to move this out. I still kind of like having a position in Home Depot. I do have one in Lowe's as well. I have a diagonal in there, I believe. So I am in the home-related retail space, if you will, but just with these two stocks, this is a question of if I want to hold on to this Home Depot and move it further out. With Home Depot, I'm pretty sure. With Lowe's, I'm pretty sure I'm long October and short SEP. Yeah, this is one that I rolled out because I was originally long SEP and short August, and then now I'm long October, short SEP. I'm long the 220 in October and short the 240 in September in Lowe's. So that's the play we got on there.
Love it. Yeah, and this is another cheap one. 20 points wide for $7. Like, that's a smash in terms of the risk relative to reward, especially after earnings coming out here shortly. But
yeah, that because this one has earnings tomorrow along with Target.
Yeah, Lowe's is before the market tomorrow. So if you want to trade earnings, it's got to be today before you place that trade, since it'll come out tomorrow morning. And then Target was the darling of 2026, up 50% on the year relative to these other companies. And they have the biggest implied volatility at the same time. 9-point, almost 10-point implied move on $150 stock. So Target could see some fireworks, but as we've said, this is another one that has a pretty decent range in implied volatility. So if you're looking at selling premium, I mean, we've had a low of 30% IV and a high of 45%, and it's got as high as 53% back in February. So nice wide range for implied volatility changes. I think TLT is one of those examples where I talk about how like IV rank doesn't matter to me in TLT because the range of implied volatility is just too low. So you look at this entire year from, where are we here? March, April, here you go, 2026. So yeah, so we've had a low in implied volatility of 10% and a high of 18% at the peak of the war. So only an 8 percentage point range between the high and the low. But if you look at the most recent range, you've got a 10% low and a 13% high. Like this IV just doesn't move. So it's completely different than something like a Target or Home Depot or Lowe's, where you have a much wider range of implied volatility. Target went as high as 50% earlier this year and as low as 29%. So that raw percentage point range is what you're looking for if you're trying to play changes in implied volatility.
Yeah, I'm just looking here to remind myself what the move index is comprised of, because I'm a little surprised that this isn't moving, but I think it's mostly tethered to the 10-year, but that's still moving a lot. The move index, of course, is the VIX. We don't have it on the platform, I don't believe, do we? I don't know. I don't think we do.
Well, I guess there's a ticker symbol now that's moved, but
yeah, I don't think we do. It's just one of those things, but you guys can find it. It's even if you haven't heard of it, it's basically the VIX of the bond index, if you will, right? And so it is weighted at 20% 2-year, 20% 5-year, 40% of the 10-year, and 20% of the 30-year. But how they're all moving quite a bit, I feel. I would think vol would be higher is what I'm trying to get at in TLT, and it's not quite. So I kind of like that buying in there. And those are the situations where you can look to buy volatility, I would say.
Yeah, that's what I did.
Yeah, it's very low, and at some point it could pop, and by pop, it could pop to like 12, 13. But hell, that's still 2 percentage points. So we'll see. Got a minute to the bell here. Things are dipping. Did dip a little bit lower a second ago, about 4 or 5 handles, but we bounced right back. So futures seem to be clinging to 77K at the very least. We're at 77.28. I don't think we'll have a breakdown today, but we'll see.
Yeah. I mean, TLT, my exclusive trade when I've been in here is just long options, whether it's a zebra or just a straight up long option. But like that's the only trade I do in here. And it's just so cheap. Like you can control 100 deltas to the upside in TLT for $400 with a zebra with 150 days out. Like any other product you try and do 150-day zebra in, you're basically paying the equivalent of 50% of the notional value of the stock. Where here you're looking at 5%. Crazy.
Yeah. some of the other earnings today, Klarna had earnings. That's down 20%. I can't say I'm surprised. I don't even know what they said. I don't know what's going on, but I know the company and I know what's been going on in that space, right? And people are that this is an environment where people are struggling to pay for things. I don't imagine they're having hard times paying back some of these loans, if you will, whatever you want to call them. So buy now, pay later, struggling a little bit. As we see the open here.
Interest rates on cars being 25%. That's literally nuts.
Yeah, right?
That's crazy.
That's wild, man. That's
no wonder,
the environment we're in.
Yeah, no wonder the defaults are so high.
Mm-hmm.
It's crazy.
Mm-hmm.
E-mini's selling off here, down 50. NASDAQ down 420. Let's see what this Home Depot's trade is looking like. Not too much here. Ooh, we just reversed instantly.
Yeah, we did.
That's crazy.
Well,
that was fun.
Lowe's is still up.
Look at this.
Is still positive.
This is crazy.
I know. Wow.
We were up 4 or 5 points, and then first minute we just dropped like a rock.
I might have to. This might be an opportunity to move my SEP to October. I'm going to need a little bit more time.
Okay. So yeah, we immediately just got all this value out of the short option. I think the prudent thing to do would just be buy this back for whatever the value is, just to try and secure the value in September before it collapses. Because yeah, this September value is still pretty good here. So I'm just gonna make this move right now. Go to a 10-point wide diagonal spread for a $1.40 credit. There you go. $1.40 credit. Move to September. If we keep chopping around here, we'll be fine either way. But secured almost all that value in the short option in the 4-day. Now I'm down to a $6 basis on a 10-point wide diagonal spread, and we'll see what happens.
Can't get anything done in here. Send this down. A lot of chip names are down. A lot of tech names are down as I look a lot across the landscape here. SK Hynix, SpaceX, Styx, a lot of those names that were actually positive yesterday seem to be in the red today. To tell you what, Mikey, it almost seems like the chips versus consumer names trade is back. At least that's what it's looking like this morning. Walmart is up. Procter & Gamble is up. Nike is up. Since when did Netflix get lumped into this space? But it seems to be moving on those days as well. Pepsi, UNH is up. I actually did a trade in UNH yesterday. I got a little long in there. I'm curious to see what Mr. Tim Knight thinks. I know he was talking about it apparently yesterday, UNH. So,
yeah, it's definitely a wild day here. But we just talked about the NDX butterfly. Look at this thing exploding.
Yeah,
up $400 today for a net profit of $100, and this was a $200 loser before the market opened. So this just goes to show how sensitive these can be in your favor, especially into a market sell-off. This isn't even really a sizable one, but this will be an effective hedge if we go down and continue below 29,000. And again, the net cost is $700. We can make that up elsewhere with other bullish positions if we rip higher. So yeah, love these as a downside hedge. Really effective for small to medium portfolio sizes. And yeah, USO, we're talking about this. USO is just going to continue to benefit from the backwardation and the lifted back end of the curve in crude oil. And we've seen it rally from 114 all the way up to 130. After, again, we had the calming of the curve, and now we're back. It's just like the gift that keeps on giving for now.
Yeah.
But this trade is up $500. I had the 120, 135 call diagonal spread, long October, short September, 15-point wide for $500. That was another one that's just like, this is so cheap. It makes sense to just have on in case these things get haywire again. But I'll hold this until we get closer to 135 if that's going to be the case. And it seems like that is the case considering the steepening of the backwardation in crude and the lifting of these back contracts here at 75. They were in the 60s a few days ago.
Yeah, well, didn't you have a strangle in here still, right?
Yep.
Yeah.
Mm-hmm. Yeah, I just moved it in MCL. I moved it from the near contract. I moved it from the 30-day to the 60-day. This was also to get out of the steepening. So like if markets do go crazy, you're going to see the 30-day just rip higher. And these near contracts, the 60-day will be a lot more stable. So being in the next month, if you're trying to collect premium and just play for range bound trading, being in the next month after the active month actually, I think, helps you avoid that steep backwardation if it does rip higher. Because we've seen it like at the height of the war, we had a 15-point difference between this current contract and the next one. So that was another reason why I went there yesterday. I made that adjustment.
Not a whole lot of change here on the day. We are down a little bit lower than we were this morning. We're seeing volatility perk up just a little bit, 34 cents in the front monthly Q contract, which, reminder, expires tomorrow. The future does. The options stop trading today. So how does that manifest itself? Well, let's just say you bought a 16 call in the VIX today. In the VIX, that is the August VIX, the August 19 VIX, right? Right now, that's trading for 34 cents. And the August VIX is trading 15.90. And if we end up here, if we end up here tonight, might still have 30 cents of value, but tomorrow morning, it'll go to zero. So it really doesn't behoove you to hold anything in the VIX. Unless you just, you want to play the lottery. Other than that, it doesn't behoove you to hold anything into VIX expiration. You must just roll to the next most times.
Yeah. And that's why, if I'm going to trade the VIX, if I'm being forced to trade the VIX, I'm just buying calls up here. Because that's really for me, that's how you play it, is you buy when the VIX is super low, you just inventory some upside delta here for a couple $100, and you just hope you get a move like this where you buy it at 2 and you see the spike in the VIX from 15 up to 25 and you double your money and you exit.
You play with the extrinsic value. Exactly. Yep. That's one of the ways to do it. You can also do the mini VIXs. I have a couple of those on right now. I have them in the September contract because I was not really expecting a whole lot of volatility in this contract. So I'm long a couple of the VXMU contracts.
I like it.
Frankie's like, behoove is one of my favorite words. I know. Me and Frankie like the same words. Behoove, Frankie, bifurcation. I think we both like those words a lot.
It behooves us. It's a good one. It's a fun one. But yeah, haven't done anything else. Keep my eye on some P&L days. The NDX one I'm going to keep on, of course. SPX, I've got a Super Bull here, chopping around at the same price we put it on. We were basically at down 40 when we put this on, but also have a butterfly in here, picking up some value today, 75, 74, 73 in the same expiration, August 28th as the NDX one. And then I've got this Iron Condor that I put on. I don't even remember when I put this on, a month ago, it appears.
Mm-hmm.
And this I need a little selling. 76.80 is the short call spread. We're about 50 points in the money on that one, but 30 days to go.
30 days ago. My SanDisk Butterfly people, you know who you are. I did one yesterday. I did the downside after the huge move we saw in the last couple of days. So I did, it is for this week. I was trying to get next week, but they were just too expensive. So I bought one for the 1,600, 1,500, 1,400. Put Butterfly. I bought it for $6.50 yesterday. Keeping an eye on it. Would love to see a little more move to the downside today.
Yeah, these have been really nice trades. Just super wide, such high implied volatility. And this is another one when you look at the implied volatility ranges for SanDisk, we've had this year a low of 70%. That's the lowest implied volatility has gotten.
Yeah.
And a high of 167%. So this is an insane range. If you've been buying butterflies, this is the IV you want to see for butterflies. I think this is why you've had so much success with these, because when you're buying butterflies in 100% IV product, they're just so cheap relative to the max profit.
Mm-hmm. Yeah, they've been great trades, like you said.
Indeed. But yeah, let us know what you're trading in the YouTube chat, and we'll get to some questions and trade ideas throughout the morning here. But yeah, kind of an interesting open. We're down 40, but it feels quiet. Feels like we've just gapped lower, and that's the day for now. But USO picking up some heat here, up $1.20. This spread is coming in a lot more, up $540 now. And then crude oil picking up some heat, up to 83.25 in the X contract, which is the next month here, but 85 almost now in the V contract that has another 30 days on it. Crazy morning.
Mm-hmm.
But yeah, I think for this portfolio, just keeping an eye on some of these P&L days that are moving aggressively. And if we get a continuation in USO, if we get up to 135, I'll probably just close it, but still about 4 points away from there. And would love to see that happen over the next week or so. Apple, Super Bowl. Somehow Apple's up in this red day in the NASDAQ. But to your point, could be a rotation out of some of these big name stocks like MU, SanDisk. If we look at the NASDAQ 100 watch list, you've got your Adobes, your Workdays, your Microsofts. This is the complete opposite from yesterday. And then to the downside, it's the names that you would expect: Micron, SanDisk, WDC, AMAT, Marvel, CoreWeave, all moving down 5% or more.
Yep, we're seeing a little bit of the rotation once again. Seems to be taking shape, at least on this day. We'll see. I don't know. Maybe this is sort of maybe this is the last unwind of it as we're heading into VIX expiration, heading into August expiration, or maybe this is something we see until the rest of the year. I don't know. For whatever reason, it gives me a little comfort, honestly. I like being long both of these names and being able to play off of each of them on individual days. I mean, for example, right now, although small, McDonald's is working for me, Coke is working for me, Costco is working for me, Pepsi is working for me. Again, Netflix is somehow being lumped into this group. I've seen this before. But I do see financials being down. Citigroup is down. A couple other banks are down. And some of just the whole AI trade is down today. So that's the other thing that's happening.
Indeed. Yeah, I can't believe Home Depot just had that 1 minute reversal.
Yeah, it's like that. It's like stock opening and just boom, have it, yours.
Dumped it.
How many shares was that, by the way?
I mean, it had to be big volume.
Yeah.
But yeah, we'll see if we can get out of this one. But I think we'll be okay. 60 days on the long option, 30 days on the short now. 10-point wide diagonal for $6. And it's basically flat, down 80 cents right now.
It's bouncing back a little. But yeah, somebody traded, it looks like they bought them because the stock went up, but somebody bought 16,000 shares in the open, right at the open. 16,881 shares. And then the big down bar you saw is 8,781. It's almost like it was a fat finger, and they sold half of it out. And then the other half after. 1688. 8781.
Oopsies.
8418. It does look like that.
I mean, the notional, that's insane. 18,000 shares for a $300 stock.
8418.
It's craziness.
Yeah, that's almost that similar volume. Kind of weird. Huh.
You don't say. But yeah, I think this day is just like the rest of this week, just slow grind with low implied volatility and a handful of earnings names. So it feels like we need some kind of catalyst here to bring us into higher VIX territory, maybe a continuation of the sell-off here. But as of right now, SPX 0-day implied volatility, only 23 points, which is very low.
As you say that, just looking up what the VIX 1D is doing. VIX 1D is actually pretty quiet. Yesterday, we did see this move from 5 to 8 in a short order of time, but seems kind of muted today, though.
Yeah. You'd expect to see a little more volatility, a little more pep in the step of VIX 1 day with the market down 37 points, NASDAQ down over 1%, 377 points here. But yeah, we've got to kick this over to TP right now, but we'll post these trades that we placed in the morning session. We'll be back on the other side of TP's show, but you're watching Tasty Live. Join us on the YouTube channel if you haven't already. We'll see you in a little bit.
Good morning. I'm Tom Preston, and let's check out the markets this morning, Tuesday morning. August 18th. Jeez. Okay. Almost the end of summer, and well, not really. And I guess the kids are back to school. I saw the school buses driving down the road, and personally, I'm glad that my kids have grown out of that section here. I'm going to load up. Let me load up the YouTube chat really quickly. I want to be able to see if my audio is coming through okay. Let's see. If anybody can give me a thumbs up, is the audio coming through okay? And if not, I'm just going to, while I wait for that, I'm just going to get straight into it. The big news that I could hear is the lousy. Sound good. Okay, thank you. The housing starts were pretty bad. They came out with housing starts for the last month, I guess, and they were the lowest they've been since COVID. Some data point like that, and that is, if you go to the watch list page, I have my home building and housing stock list set up here. Rocket Mortgage, AOS, CTRH, Home Depot, Toll Brothers, Lennar, DHI, et cetera, et cetera. Most of them are down. Home Depot's up. NVR, what is NVR again? I can't remember NVR. But that's understandable. Rocket Mortgage is pretty much the only one with some decent liquidity in it. It's a $14 stock. Taking a look at let's take a look at a chart just for kicks. And Rocket is a decent proxy for the housing market, at least when it comes for option trading. Yes, you can look at Lennar and XHB too, the home building ETF. That's down today too. And let's just check XHB's liquidity. It's not great. I mean, there's some decent open interest in here, but the home building sector, those stocks their options aren't great for trading vehicles. The idea, I guess, is that the higher interest rates on the far end of the curve, the bonds, 30-year bonds in the 10-year notes, those are actually starting to catch up to the housing market. Maybe that's the story. And you know, the big sort of all the moving pieces are that, you know, as the AI stocks, very broadly AI stocks, need to raise some money to build out their dream data centers or whatever the heck they build. They're using bonds to do that. So they're offering bonds, selling bonds to raise money. That's drawing money away, presumably, from the treasuries. That's the story, driving treasury yields up. And that's been happening over time. Bond prices, ZB's down a tick right now, pretty slow. I would sell bonds on any rally in them. I'm bearish on bonds right now. I already have a position on in short call spreads in ZN, the 10 years, and I'm hovering right around 50% of max profit on that trade. I am, if we get a little downtick, I might get that so I can buy this back. And I think I would reposition in a long put spread in ZB, something like this. I don't want to load the boat in these trades, but if I go out to, let's say 24 days, so 108.09, and by the way, these are 30 seconds. Unfortunately, the bond market is still living in the time of Spanish pieces of 8 and doubloons or whatever the heck they had. So these are 30 seconds. So it's 108 and 9 seconds. So it's approximately a quarter. 108.25. There it is, 108.25 right there. So these are in 30 seconds. These, conveniently, the options are in 64ths. Okay, so when I was trading that stuff with the border trade, you get pretty good at the fraction for that stuff. But anyway, what I would look at, if it's trading right around 108 and a quarter, it's right in between here. And I think I would look at, actually, no, these are the I'm still looking at the ZBU future. I'm going to look at the DES's 107.23, which is about 3/4. So these are in backwardation right now. I would look at buying maybe the 108.5, 107, a trade like that. Not a huge delta, a little bit of positive theta. So if I can take off my ZNs, that's what I'm doing. Let's go into the SPX. Well, let's go look at the VIX. The VIX is up 61 cents, not nearly enough for me to close my short put spread out of the money. I'm short the 16-17 put spread in there. I'm still going to reestablish. I'm going to go out to 28 days. I'm going to sell another put spread in here. The cash is at 1580, and I call that cash just because it's the index. You can't actually trade it. So if I do this, buy this, sell that, the September future is trading at, you take 18, the strike price, add in the debit, 18.18. So if I sell, so the 17 halves, for example, are out of the money, despite what this says. So if I go in here, I can collect 50 cents. I don't need to collect that much. I'm going to evaluate that. I'm going to look at, let me pull up VVIX. And the VVIX, let's go to chart. VVIX is actually ticked up a little bit. It's low. This is the volatility of the VIX. It's low. So maybe I will look at let's go back to the VIX. Let's go back to the VIX. Go back to the maybe the 17-19 call spread. Something like that. I don't like the negative theta. That could be just the calculation. I'm going to have to look at that a little bit more closely, put it in my super secret squirrel option pricing stuff. But that's what's going on with the VIX. One of the trades that I did in my 1 o'clock show is BSX. One of the viewers sent that and said, hey, what do you think about a bear bullish trade in BSX? Sure, why not? So I sold a 50 put with like a week to go. Right now I'm trading at 65% of the max profit. So I want to take that off. Boston Scientific, excellent. Let's buy that back. Let's try 15 bid on that. Let's do 15 bid and see if somebody wants to play. And this is just cleaning up. Let's see, make sure 15 bid. Yep, filled at 15. So we'll take profits on that. Right now, gold, GC, I am short a 1-day put spread in gold right now. It's right there. It's right there. So the 44.10s, I'm long the 44.05, short the 44.10s. Future, the August future is ready at 44.14, so I'm $4 away. I love these trades, so it gives me something to watch. I'm going to be watching this. I'm not going to adjust it necessarily. If this is in the money, I don't want to take delivery of the future, so I'll probably close it out. It's going to give me a little bit of time. The volatility in gold is up, so this is not going to reach its full value. It's neither going to go to zero, or even if, even if these futures drop below there, they're still not going to trade at $5 because the volatility is going to be high enough. I might be able to buy it back for $4.50, something like that. So I'm going to be watching this closely. Let's go into the SPX, do my little iron condor. And yesterday it didn't get filled. Today, we're going back with a vengeance. Nothing like revenge trading in the S&Ps. So let's do these ones. So with volatility this low, unfortunately, it's not getting enough premium for the way out of the money stuff, and that's okay. What do I used to tell my kids when handing out popsicles? You get what you get, and you don't get upset. You get the orange or the blueberry, whatever the heck it was. 60 by these. So what I'm going to do is, come on, first day with new hands. By the 76.47, sell the 76.65, sell the 77.35 by the 77.60. So a little bit leaning, coming down a little bit. This is a little bit slightly bearish. Review and send 305, ship it. take a fill. And what I'm going to do, just to show my mechanics of this, go in here. What is 1/2 of 305? About $1.50. So I'm going to do that, $1.50 bid just to buy this back. It's a resting order. If I can make half my max profit on these trades, I'm happy. Okay. Let's go out. What else did I want to look at? That's basically it. So some of the dollar is a little bit stronger today. The 6J is up. Actually, I'm short a call spread in there. 6E is up. All right. So the dollar's has come back down, and 6B. These are all up. I'm short premium in these. The dollar was looking a little bit stronger earlier. It is weaker now, and I think that's part of the plan. So as far as short-term trades, I'm taking the other side. Taking the other side of this and selling some premium in these currencies, but longer term, and that's why I'm okay getting long deltas in gold. Just as a defensive trade against the weaker dollar, because I think the administration and the powers that be, which ain't me, want to push the dollar lower. So with that, it is time for me to hand this back over. And remember, none of this is a trade recommendation. And if you do trade this stuff, don't take any more risk than you are comfortable with.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click, all on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. Investopedia says we're the best for options trading. Stockbrokers.com says we're #1, and Broker Chooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
What's up, everyone? Welcome back to the show. We got E-minis down 40, NASDAQ down 440. Not much has changed over the last 20 minutes or so, but we have placed a few trades in SPX and Home Depot from this morning. SPX threw on a Super Bowl, sold a 5-point wide put spread to buy a 10-point wide call spread further out of the money, playing for a bounce from here, and then adjusted the Home Depot calendar spread. I had a 350 calendar spread. Bought back the 3-day 350 short call and rolled out to the 360 September call, creating a 10-point wide diagonal spread. Picked up a $1.37 credit, which brings my net debit down to $6 on that 10-point wide diagonal. So we're up a little bit from when I made that adjustment, and it should be a profitable trade if we get a continuation of this move here.
Yeah, and I just chose to roll my Super Bowl out to October. I just want to give it a little bit more time. So pretty simple, pretty straightforward.
There you go. Love it. But yeah, Home Depot had a wild chart from this morning. Kind of insane to see the intraday range, but right at 8:30, just dumped it. And now we are net up on the day somehow.
Yeah, somehow.
But yeah, this trade is probably it's a winner now, interestingly enough. But I'll probably just hold on to this and see if we can get some more out of it, considering short option now has $350 of extrinsic value, to decay over the next month, and any continuation to the upside will be good for this portfolio. But if you wanted to close it and just call it a day, it's a 70-cent winner now, even after that adjustment.
Yeah, for me, the bigger things that are waiting for me right now are the SanDisk put butterfly, the NDX, like you said, is the NDX put butterfly is winning, and so is the SPX put butterfly. So put butterflies are winning in the portfolio right now. Winning.
Mm-hmm. Yeah, any kind of continued sell-off here with a vol pop, and especially as we get closer and closer to this expiration, these could be magnificent hedges once again. But got to temper expectations even with these NDX butterflies and SPX. NDX butterfly, we were on expiration day in the morning and we hit the short strike. It was still it was a $4,000 win, don't get me wrong, but max profit here is $20K and we were only able to get 4. You really have to hold it through expiration and get that pin on your short strike to get the full max value. But still a great hedge relative to the risk of $700. And really that if we do that again, it'll cover any losses I have in all these other positions, like easily.
Yeah, when you're long deltas and a lot of things, these end up being a great thing to look to on a day where you might be red in a bunch of other positions. They're the ones that are actually green. The other thing that's green for me is a former trade of the day, diagonal and SPY. I have 2 of them actually. Sorry. Yeah, they are diagonals. I'm tripping. 2 diagonals in SPY, both of them long October and short the September cycle. So one is long 7, they're both $15 wide, long 770, short 755. Another is long 775, short 760. So like having those on.
Yeah, I like it.
We'll probably keep them on. I'm only up, percentage wise, only up 14%, $100 and change on both of them. And I'm curious to see if this leads to more selling off after tomorrow, heading into not only VIX expiration, but to August expiration.
Yeah. We've got a continuation of this move in Apple. Apple's now up 4 points from 15 minutes ago or so. Really interesting move there considering the rest of the NASDAQ is down, but love to see it. I have a Super Bowl in here in October, 292.80 put spread to buy a 330, 345 call spread. So 10-point wide put spread, 15-point wide call spread. It's up $100 right now, but plenty of time on this one. I'm just going to hold this and see if we can rip higher. But yeah, like you said, the biggest P&L day in this portfolio is from those butterflies to the downside.
What I see right now is a weaker Mag 7, chips getting sold off, and a lot of the consumer staples names up, as well as healthcare. And again, when I say weaker Mag 7, except for Apple, like you just mentioned, Apple is up. We've seen this. We were seeing this a lot in July, and it's playing out again. And I'm not, this is the first time in the last week I feel like we've seen this. This is kind of fascinating. It seems like when we get volume, we get this type of movement from between these spaces. Again, Mag 7 being weak, chips being weak, software is up, consumer staples are up, healthcare is up. So that's the MO of today.
Yeah,
and Apple is up. So the anti-chip trade, if you will.
Truly. And we had Home Depot this morning. We've got Lowe's, Target, Walmart, TJ Maxx, Ross this week as well. So big consumer earnings week. But let us know how you're trading it in the YouTube chat. We could pop over there, give the people some love, see if we've got any trade ideas in there. We can analyze as we see what the market does this morning.
What the people are saying.
What are the people saying?
That picture is great. I didn't realize we had that. It's like a picture of you and me hanging out around the retail names. That's fantastic. Hey, Mike, you compare the advantage of the Super Bull bear over selling a spread. Can you break down how the Super Bull / bear stacks up against the profit potential of a debit spread? Oh, yeah, for sure.
Yeah, we can do that. Yeah, I mean, it's just like the difference is if you're buying a spread, if you're buying a call spread, for example, The difference is just the probability of profit, which is derived from where you are losing money at expiration, technically a penny at expiration. So if you buy this call spread and we look at this out of the money call spread that I've got loaded up here and look at the expiration theoretical graph, like you're profitable pre-expiration, you can still show profitability if you get a rally. This does not need to expire in the money. But this is a 10-point wide call spread that you're buying for $500 out of the money at 7,800. That's 100 points out of the money from where we are now in SPX. This is 30 days to go. So at expiration, of course, you need the spread to be in the money to show profit. And it's very binary. It's either out of the money or in the money, and you're either losing $500 or making $500. From a theoretical standpoint, you can make money on any rally today or tomorrow or the next day. It's just not going to be $500 worth because this call spread still has extrinsic value that needs to decay to zero, which is why you have this kind of curved risk graph, as opposed to if you pass time, it starts to look a lot more like that expiration risk graph. So this is your call spread, your traditional straight up debit spread. But look at the probability profit, 41%, because if the market just chops around here, you lose $500. So one way to offset that is to shift your risk from this debit spread where you lose money on any chop or any kind of downside move, or even if you just don't get the correct upside move in a short amount of time. One way to offset that is to sell something against it. So look at the buying power, $500. Look at your max loss of $300 or $500. It's the same as your debit paid here. But if you go and you sell something out of the money that offsets your cost on this trade, we can just throw this up as an example. This is now routed for a credit. So you're basically selling a put spread to finance the entire cost of that call spread. And what happens is when you run the expiration analysis graph, now all of a sudden, if I pick up a 50-cent credit, I've got no risk in the middle. And if the market just chops around here or even sells off over the next 30 days, this is still a profitable trade instead of losing $500. Your risk and your buying power does go up, but this is a strategy where now all of a sudden your pop is well over 50%. And if you run these 1,000 times, you're going to have a lot more winners in the middle here versus max losses of $500. And you still have this upside profit potential. And it's even more from a theoretical standpoint, because now instead of paying a $500 debit and having that appreciate to, whatever the Theo is, $200 or so, you've got a 20-point wide put spread that finances the entire thing, and you're routing it for credit instead of a debit up front. So you have way more profit potential here, because now instead of just your call spread appreciating, you're also losing value in your put spread, which helps the overall trade. So your Theo graph also looks a lot better with this strategy versus just the long call spread. That's basically it.
Yeah.
You're improving your probability of profit by financing the cost of your low probability debit trade with a credit spread. And you're really not giving up all that much in terms of the credit received. You're in a lot of cases, especially ours, like with the 0 days and the 1 days, I have a 5-point wide spread that I financed to buy a 10-point wide long call spread. And this call spread is only worth like 40 cents. And I gave up 40 cents in the put spread, but it changes the dynamic of the trade entirely. Because if we do get a reversal and the E-minis go flat, this is now a trade that has multiples of the profit potential of this little 5-point wide spread.
Mm-hmm.
That's basically it. But keep those questions coming in the YouTube chat, and we'll do our best to tackle them. But we're going to take a quick 90-second break. We'll see you on the other side of it. You're watching Tasty Live.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Grow a strong community with Tasty Trade's referral program. When your friend joins Tasty Trade, you'll both receive $100. As your community grows, you get more bonuses. Only at Tasty Trade.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click. All on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto. We got it. We get it.
What's up, everyone? Welcome back to the show. We got E-minis still selling off, NASDAQ selling off, but we've got a very special guest on the line, Ms. Kathy Lien, Chief Strategist of BK Asset Management. Kathy, how you doing?
I'm doing great. How are you?
Fantastic.
Doing well. What are you watching this fine day? I mean, it's been a weird week with not too much movement, 20-point implied move in SPX, feels like every day. But as you know, there's always stuff under the hood that's moving.
You're absolutely right. I mean, volatility, I think, is just beginning to pick up. I mean, we haven't seen this level of ATR in NASDAQ in a while. And I think it's because we're getting closer to what is kind of the big event this week, which is Wednesday's Federal Reserve meeting. And I think, stocks are trading heavy this morning. Like you said, I think it's going to be very difficult for stocks to have any meaningful rally with the Fed minutes expected to show us why the three members of the Fed voted in favor of a interest rate hike and how close were they to convincing their peers to do the same as well. So stocks are heavy. I'm kind of interested in the fact that U.S. yields have turned negative after being up earlier. That is helping equities come off their highs, but it's not, helping FX at all, which we'll talk about. But, I'm watching the market, I'm watching bond yields, and I'm watching the fact that oil is not rallying despite the fact that Trump said not too long ago that there's been no discussions between the U.S. and Iran.
Yeah, Kathy, it does seem to be like we're heading towards those Fed meeting minutes where, again, that's the area that a lot of people have been paying attention to and what's going on with bonds. We saw ZB bonds, 30-year bonds touch 107. We haven't seen that in a while. Everybody's been talking about what's going on with 30-year rates and how they're at the highest in 20 years. But I'm curious to see what you're looking at from the FX side. I know that's one of your main leans, no pun intended. But what are you seeing in the FX space that has you super interested?
Well, I mean, first off, the dollar itself is right now turning lower because U.S. yields have turned lower. You just pointed out that 30-year yields are at the highest level in 19 years, which is important. But the FX market really takes its cue from the shorter term, slightly shorter term bond yields, which is the 10-year yield versus the 30-year yield. And it actually mirrors it on a very tight basis. You can look at 15-minute charts, 1-hour charts. There's a very close correlation. So right now we are seeing the dollar come off its earlier highs. So we're getting a little bit of a boost in Eurodollar. And, I like that. One of my setups is setting up for a long in the euro. Past the Fed minutes, I think, the Fed, because we had a series of weak U.S. data, the Fed is probably not as close to raising interest rates than the European Central Bank. So I'm bullish euros on a technical basis. I'm getting a euro-dollar buy signal as well. So, I like that.
Yeah, we've been trading these currencies within the TastyFX platform, and it's been really fun to just take stands, get paid yield in some situations. But yeah, it's been a wild year for the dollar, especially with the Japanese yen. Had that huge implosion just a few trading sessions ago. Were you trading that, or did you avoid it?
I was actually on vacation during that time. I always say usually volatility spikes when I'm on vacation. Yeah. And I have been talking with my audience for weeks and weeks about how, they need to be prepared for Japanese intervention, and that we're getting closer and closer. And the 1 week I was on vacation, I completely missed it. But yeah, that's all right, because you want to trade every single day, not that just one black swan event that you get once every couple of years.
For sure. Yeah, that was a wild thing to see happen. And again, I mean, the whole, again, that gets back to bonds, right? The reason that the U.S. sort of stepped in and sort of helped out with the Japanese yen is because obviously Japanese are a large holder of Treasury. So we've seen all of that play out. We've also seen how it's affected gold. I mean, gold had a great couple of days run here, and then obviously we're seeing it fade today as these yields go back higher. I know gold is one of those things that you look at. Is there a trade that you're interested in gold? Because it seems like up to this point, over the last week, people were talking about getting back in long with gold, right? Considering what we saw earlier this year. But now I'm curious to see if that sentiment is changing just because yields are staying sticky up here.
So when it comes to Forex, I tend to have more swing trades. And, I tend to have more trades that, go for a larger amount of pippage. With golds, though, I'm more of a day trader. So I usually trade the New York Open as well as the Asia Open. So right now, gold is, on if you take a look at a daily chart, gold is definitely stuck in a range. There's no action at all. For the past week, it's basically been barcoding. But last night, we had a beautiful short trade. I like to look at moving averages, especially EMAs. So I had a really nice, kind of crossover in the EMAs right at the Asia Open that pointed to a very, very nice short trade. But right now, in the New York session, we're just barcoding. I think we need to see a move above the London high or the Tokyo low, which is kind of the ranges that I'm watching. So right now you see my charts. You've got the London high here. You got the Tokyo low. We've just been barcoding. We need to break these levels to get beyond it. But right now, you can see these are my two lines. The blue line is the 8 EMA. The black line is the 21 EMA. And right at the Asia Open, we had the cross. Very simple strategy. Just cross below 8, crossing below the 21 at specific times of day when momentum kind of kicks in. That's when you can get a very, very nice move lower. And you'll also notice I trade this at the Asia Open, I trade this in the New York Open, but at the New York Open, which is I define as the early New York Open, 6:30 a.m., we had no crossover. So there's no trade whatsoever. So the only trade we had overnight was over here. Yesterday, I traded, this sell-off over here during the early New York Open and this pop here. But right now, once again, just barcoding between these levels. If we go to a daily chart, same story. There's no direction. Yes, you're right. We had this huge breakout to the upside a couple of weeks ago, but that's old news in many ways. In many ways, we've had the breakout, kind of begs for a little bit of a retracement before we can really continue higher.
Yeah, it's it's funny because I only look at SMA, but again, it's all about, everybody uses different things. It's all about what you do consistently. And I've noticed that there's a resistance at 4,500. I'm curious, you're the second person to come on the show and talk about trading the London gold session and then the US gold session. What is it about those two sessions that you like? And what do you look, as far as second part of that question, when you're saying there was a nice short, how much of a move do you look to take out of that?
Well, first of all, I don't trade the London session because I have to sleep sometime. I'm in New York, so
but you look at both.
I can only. Yes, I have to sleep, so I can only trade the Asia session and the New York session. But in terms of how much I squeeze out of this trade, that's where I have the session highs and lows. And right now the previous ones were it moved lower, but. Sorry about that. But I had some targets I took off half of the position right at this kind of spike low here, which, obviously was way too early. And then I took the second half of the position at this low here. There's so many ways once you're in profit that you can manage. In retrospect, the best way would have been just to trail against the 8 EMA. But in real trading, I took a little bit off on this spike low and then the rest of it off right over here.
Nice. And yeah, with the Tasty platform, you can throw on exponential moving averages really easily. I just mimicked your 8-day, 21-day. You can throw on your exponential moving averages, and then you just change the length to 8 and then 21. You can change the colors, and we can see exactly what we're looking at here with the crossover right here, and then the other cross here. So yeah, I like this, the intraday trading and the movements we've seen in gold. We're both positioned for a little more upside, playing for a continuation to the upside here with just how beaten up it's been. But it seems that at least right now we're on the right side of it.
I use these exact same indicators for trading NASDAQ as well. So if we pop over to the 5-minute chart, I know you're looking at your chart, but if we pop over the 5-minute chart, which I use for NASDAQ. So on gold, I use the 15-minute chart. On the NASDAQ, I use the 5-minute chart. So basically, and I also add in a 65 as kind of my quote unquote longer term filter because the NASDAQ can be a little bit more volatile. So I only take trades in the direction of the 65 SMA. So these are just kind of indicators that I have. But you can see we had a crossover right at 7 a.m. over here to the upside, but it didn't take the trade because we were below the 65. So I waited for this setup over here where we had naturally, this was the cross and this was the entry. So I sold MNQ over here because we had the downward cross between the 8 crossing below the 21 and we're below the 65. And you can see that led to a really nice move lower. Now, I stopped trading this strategy at 9 a.m. At 9 a.m., I'm switching over. It's, the market's opening. We're looking at other things. And then the Asia session last night, I also caught a really nice trade here. So what's interesting is that right at 8 o'clock, we had this cross down over here. We're still above the 65. I waited for it to drop below the 65, which was, pretty much on a closing basis, pretty much right over here. And you can see that coincides, that timing is very important because it coincides with momentum coming in and us finally breaking out of this consolidation and then finally breaking lower.
Yeah, that's amazing. It's an interesting time. Of all the things on here, as far as the patterns today, Kathy, I'd like to direct your attention to somebody that we were just curious if you remembered. It's one of your interns that is actually one of the prominent members of our network. Do you remember this face at all? Chris Vecchio. Probably been a long time. He said you might not remember him.
Of course I remember Chris Vecchio.
Look at that. Look at that.
I do. He was, he was one of the later hires that we had, and smart kid at the time is no longer a kid, but he's definitely was someone I knew that would do great things.
He said he really looked up to you. He said he appreciated working with you, and he didn't think you'd remember him at all. He was very nervous to even come on. We were trying to get him to come on with you, but he was very nervous. So we'll relay the good words to him.
I love it.
Certainly.
Amazing. Well, Kathy, appreciate your time. There you go. Look at that. Nice pixelated image too. Perfect.
He's going to hate us.
He's going to be so mad. He's going to be so mad. It's going to be great. Can't wait. But Kathy, appreciate your time.
Thanks for coming on, Kathy.
Always interested to hear what you have to say. And hopefully we see you again soon.
Yeah. And if you don't mind, if you want to follow what I'm doing, my X handle is Kathy Lien FX.
Beautiful. Kathy Lien FX. We will see you soon and appreciate your time again.
Thanks, Kathy.
Adios.
All right. Have a great one.
Yeah, you too. E-minis down 42. NASDAQ down 430. We've got choppy market today, but maybe we see a little pop in volatility with the downside moves. But we're going to take a quick 90-second break. You're watching Tasty Live. Hello, everyone. Welcome back to the show. We got a market measures for you, sponsored by SIBO, which means one thing and one thing only. We got Julia on the line. Julia, I hope you are sufficiently healed from your leech experience.
What happened?
Yeah, I don't know. I think I'm going to find out. Oh, you did.
You had leeches on
Well, you missed the leech story. Yeah, I was swimming. I was swimming in a lake, which I have trust issues when it comes to natural bodies of water.
There you go.
And we noticed that there were a lot of clams on the ground. So we were, of course, naturally messing around with the clams. And we put all the clams down, and there were just tiny little brown leeches just kind of stuck. So that was a fun Saturday.
Nasty.
So I have trust issues.
Not a fan.
What lake
That's
were
what I'm
you in?
Undisclosed lake in Illinois.
Yeah. Keep it undisclosed.
I'm going to keep it undisclosed. Yeah. Just always check yourself after you come out of nature. Ticks, leeches, the usual.
Yeah. Classic.
Yeah.
What do you have for us today?
Okay, so today, while the market is certainly marketing, we're going to be talking about how volatility impacts strangle decay. So this is a piece, it's a simple one, but I think it covers some interesting core concepts when it comes to setting expectations, especially around hitting certain profit targets and how volatility can change that. So volatility is something that we use to not only gauge premium inflation, like how much, how rich premiums are at a given time, but it comes with a number of other properties that impact short premium. And I wanted to talk about that today.
Sweet.
Cool. Okay, so let's get into it. So implied volatility, it's obviously a very critical signal for premium sellers, as elevated volatility indicates richer premiums and more compensation for this tail risk that's often carried by short options. As volatility and premiums increase, theta decay also generally increases since there's more premium to be lost in the same amount of contract duration. And so today we're going to take a look at what this looks like in practice with real trades to really better understand how the speed of hitting a profit target changes with volatility. And this is also really going to be a comparison of different durations and how sensitive those different durations are to changes in volatility, and how you can kind of make sort of profit expectations around that or set profit targets for a given trade depending on vol conditions.
Beautiful.
Cool.
Easy. Okay, so let's get into this study. So we're going to be using data from 2016 to present. Here we're going to be using 20 delta short SPY strangles. We're not going to be using any management just because we want to isolate sort of the effects that we're trying to look at specifically here. So we're going to be looking at 10, 15, and 30 DTE contracts. We're going to be tracking cumulative daily P&L as a percentage of initial credit. So we're going to be scaling everything relative to initial credit. And then we're going to be calculating the median P&L on each day. It's basically cumulative P&L per day that the contract is held for these different durations. And we're going to determine the point in each duration on average when a 50% the initial credit is hit. And we're going to compare that point when it's hit when the trade is opened when the VIX was under 20 versus over 30. So pretty simple VIX thresholds here. We're not going to be using IVR. We just want to look at overall volatility inflation, VIX under 20, actually a little bit above its long-term average. That's even a little bit high for the VIX versus over 30, which is very high for the VIX. Make sense?
Yeah.
It does indeed.
Does indeedy. What could the results possibly be? So now we're comparing 15, 10, and 30 DTE strategies. And then for all of the strategies that we tested, that 50% the initial credit target was reached on average past the halfway point in each contract's duration across all VIX regimes. So we're taking volatility out of it. But when we look at all these different DTEs, we can see that it's past the halfway point for all of them. And we'll get into some more statistical details kind of after this point, or after this slide, I should say. But that's kind of an important factor with 45 DTE contracts, 60 DTE contracts, that happens around the halfway point. But for the shorter DTE strategies, the shorter duration strategies, it generally happens later in the trade because it just takes more time for that theta decay to kind of kick in. Make sense?
Yeah.
Yep. 20 delta strangle, doesn't matter the duration, they were all reached 50% profit within half of the time.
Past half the time. So these are days held.
Right.
So past half. Actually, let's get to the next slide because this is a pretty interesting point when it comes to choosing that duration. And this is, again, we're taking the kind of VIX out of it. This is just looking at all the VIX. But when we're looking at 30, 15, and 10 DTE, you can see the average days held that it took before that 50% profit target was hit. So for 30 DTE, that happened after holding the trade for 17 days versus 8.8 days for 15 versus 6.1 for 10. What you can see is that the percent of duration, basically the amount of time that the contract had to be held relative to the duration of the contract before that 50% threshold was hit, actually happens later. It has to be held longer for those shorter duration trades. So even though the number of days overall is lower as a percentage of duration, it actually happens later for those shorter duration trades.
Yeah, I think when you weigh the difference and when you think about the curve and how it exponentially increases as you get closer to expiration, it makes sense that you've got this sloping curve that kind of helps out those shorter term durations.
Right. And then this also kind of like ties into why, a lot of the times people will use smaller profit targets for shorter duration trades, especially those 0 DTEs. A lot of people will use very small ones, just because this other factor is that because it takes a longer percentage or longer amount of time relative to the contract's duration before that threshold is reached. One way to get around that, still getting out, around halfway through the trade, is by reducing that profit target. So maybe using 40% for 10 DTE or 35% for 10 DTE, noting that you want to obviously manage the tail risk and whatever the profit targets are that you're trying to, your profit goals as well is a factor.
Yeah.
Make sense?
Yep. They still have to hold on to some premium. They have to price in premium, even in those shorter dated ones, because anything can happen all the way up until expiration day.
Anything can really happen.
Mm-hmm.
And here we're looking at all the way to expiration. And you can kind of see that being tied in here. And then when we go to the next slide, now we're taking the VIX sort of into account. And here we're using kind of like, arbitrary thresholds, I should say. So VIX of 20 is actually above VIX, like the VIX's average. It's around like 19 for the VIX. Median is even lower than that. But when the VIX is less than 20 at entry, we can see like that's where most of the occurrences are. VIX was over 30 pretty rarely throughout, like the back test period that we tested. But what you can see here is that when the VIX is elevated, the likelihood of hitting that 50% remained elevated. It didn't change, in a very meaningful way. But for all the contracts tested, it took less time for that 50% target to be reached on average. So we went from 17 days, 17.6 days for 30 DTE to 14.4 days in those elevated VIX regimes. So with the VIX being elevated, in addition to premiums being higher, those profit targets, at least on average, come in much more quickly.
Yeah. And this just speaks to when you're dealing with a strangle, you pretty much eliminate delta as one of your ways to be profitable on that trade. So you're left with theta and volatility collapse, where the volatility collapse after you enter into a new trade after the VIX pop, you are priming yourself for profitability from a VIX crush or a volatility crush after the fact. So, this is something where we can show this at the end here, but like pulling up implied volatility onto your chart so you can visually see where implied volatility has gone, where it spiked, where it's hit its low. Like that can really help you realize, like, do I actually have implied volatility crush potential here in this trade or not?
Yeah. And that's the other factor as well. Here we're using like raw VIX levels. So a lot of the times will normalize volatility using like IVR and IVP as kind of our benchmarks. And that's really, those are very like active trader signals. Those are people who are looking for opportunities, short-term opportunities that sort of bubble up. Where here we're really looking at like just like overall VIX levels, because we really want to exaggerate that premium inflation. And kind of like you said, we're taking that directional piece out of it because we really want to understand kind of that time decay and isolation.
Mm-hmm.
So that's sort of why, even though someone might not have been trading strangles through, 2016, that entire time to present, I, wouldn't have been. But we want to be able to understand, like really isolate the effects of time decay in here and like how volatility sort of impacts that.
Yeah, totally agree. And I think like when you look at the last 3 months, the implied volatility of SPX has only had a range of a low of 15%-ish and a high of 22%. But when you bring in March, which was the height of the war, now you have that big spike up to 30%, which then crushed down to the teens like a month later. So there's your volatility collapse potential, especially if you were entering in the middle or end of March and then you exited in the beginning of April. Like that was pure volatility crush right there.
Yeah. And you can get that even when the, VIX has not breached its average or even when it remains, relatively, or I should say low in absolute terms. And that's again, why we kind of use like IVR and IVP, those relative volatility signals just to capture those local fluctuations. But just kind of like research side note is that IVR is a very, very volatile signal. So that kind of makes back testing it in certain contexts more difficult, or it can kind of obfuscate the results because of that. Which is why sometimes we like to use like absolute VIX levels versus relative VIX levels, for example. Here we're using here we're using absolute ones, but you can just see how many occurrences got cut down with that extra threshold in place. Just the VIX was over 30 very rarely from even like 2016 over the last 10 years, which is a decently long look back time.
Yeah.
Yep.
Yeah. Only went above 30 once really this year.
Right.
think.
And it's important to bring the idea of just implied volatility into the complex, not just IVR, to your point, because it's in a similar but different way. We were talking about this morning with regard to a single name. Again, it's different a little, but similar in that I sold an AMD Strangle 10 days ago, and it took 4 days for it to reach 50% profit. Just because the implied volatility was just that high and VIX was fairly low and things were fairly quiet, and you didn't have this crazy historical volatility as far as movement. So just came in.
Yeah. And this implied volatility on the bottom here doesn't look like much, but when you entered the trade on the 7th, it was around 70% IV, and then 4 days later, it was in the 50s. So you got a 15% vol collapse in 4 days with not much movement in the stock.
Right. And that's with that implied volatility, right? Like that was just so elevated. And I think actually, if we go back to the slides, I think there's an interesting takeaway in here that's going to motivate some studies that we're going to be looking at sort of over the next couple of weeks. What we saw here is when we compared 30 DTE, 15, and 10, the shorter duration contracts experienced the least speed up when it came to hitting that 50% profit target. So when we look at the amount of time, like that reduction in amount of time that it took to hit that 50% when VIX was high versus low, the 30 DTEs were sort of like the benefited the most when we're looking at these sort of aggregate statistics versus the 10 DTEs, which were least sensitive to those changes in volatility condition. So I think to me, this also makes an interesting case of using DTE strategically as well when VIX is low versus VIX is high, when vol is low versus vol is high, not just, across the S&P, but across like other assets in the S&P when we're using implied volatility as that signal.
Yeah, I think this likely speaks to the fact that regardless of VIX environment, you always have more implied volatility exposure in the near term. So if there is a VIX pop above 30, which is rare, that's when you actually get like the tail end lifted in terms of the implied volatility. And if you're selling that higher Vega value option, and then you get a crush in the back end, the front is still lifted. Like you'll always see the front with higher implied volatility exposure. But if you get a VIX pop to 30 and then it drops to 20, you're going to see that fluctuation happen more in the back month while the front month is still a little skittish. And they're like, okay, we're seeing volatility, but we're going to keep this premium in here just in case things hit the fan again.
Just in case.
Just in case. And right, that's like, you kind of got to what I want to start looking at over the next couple of weeks. We talk about changing the strategy, directional assumption when VIX is low, but how can we potentially leverage duration as well when VIX is low versus VIX is high? Because those, longer dated contracts have higher premiums on average, like significantly higher premiums. And then those go up, right, significantly when VIX is elevated. But the lower DTE contracts have generally like higher volatility levels overall, especially when VIX is low. And then in addition to that, you get more occurrences out of your 10 DTEs, your 15 DTEs versus 130 DTE. It depends on volatility a little bit because it takes those shorter duration contracts more time before that 50% profit target is reached overall. And with the credits being lower for those contracts as well, those are just lower profit targets and lower dollar amounts in general. However, you get more occurrences potentially out of those. So that's kind of what I wanted to look at over the next couple of studies, just over the next couple of weeks. But I think you kind of got what I was kind of going for there.
Beautiful. Yep.
Cool. Okay, so let's get to some takeaways. So for the strangles tested over the back test, blah, 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 blah. Happy Tuesday, guys. For the strangles tested and the back test period we looked at, the 50% credit target was hit upwards of 80% of the time for the trades. However, to reach this profit target, the trades needed to remain open for 57 to 61 of their duration on average, with the shorter duration contracts needing to stay open longer relative to their DTEs as a percentage of their contract duration. Elevated VIX did not meaningfully change the odds of hitting the target. However, it consistently cut the time it took to get there. The time reduction was largest for the longer dated contracts. The 30 DTEs saw an 18% reduction in average days to hit the target when the VIX was over 30 versus a 7% decrease for 10 DTEs.
Beautiful. Yeah. And again, I think it's, you'll always have greater Vega exposure in longer term cycles, but you have to ask yourself the question, like, what is really going to bring these IVs higher in the longer dated cycles? And the answer is largely an abnormal VIX pop that we don't see all too often. Otherwise, it just kind of stays flat and you see the front month get the volatility. But when you see them all lift, that's when you can really get that big volatility collapse in 30 days and beyond, because those have a higher Vega exposure, which means 5 percentage point difference is going to be, a big volatility crush relative to others.
Yeah, for sure. So I think that's all I got.
Lovely.
Well,
awesome. Well,
awesome. Thank you, guys.
Thank you. We'll see you a little bit later, Julia.
Peace.
Peace. E-minis down 45, NASDAQ down almost 500 now. Market's selling off, but we got Tim Knight on the other side of this break. You're watching Tasty Live. What's up, Tasty Nation? Welcome back. We've got Tim Knight on the line. Market's red, so there's got to be a smile on his face. There it is. How you doing, Tim?
No, never. A jaunty sneer. That's the best I can do. So, yeah, interesting morning. First sell-off we've had in 12, 13 years, I think.
Yeah.
So it's refreshing.
It was red yesterday, right? Red.
Not my kind of red. So
it's a sizable red. Almost 2% in the NASDAQ.
Yeah. Well, it's comic to me because you probably saw the tweet that went out with the Strait of Hormuz is our territory now, which I think is pretty cool that we can conjure up reality with text. So I'm going to do that from now on.
Yeah.
Yeah.
It's a wild world we live in. That is for sure.
Yeah. What's that called again?
Well,
Not annex.
well,
But what's that word when you just take up? What's that called? Not annex, but like the opposite of annexing something. Whatever.
Secede? Secede?
Is that what it is?
Well, like the American South seceded from the United States. Secession, yeah.
Yeah, okay. Yeah, well, there you go. Because that's exactly it. I mean, we're just doing that with anything now? I guess we did it. We changed the Gulf of Mexico. I don't know.
Oh, well, no, that's more, that's just a...
Seed. Yeah, that's the word I'm looking for. Seed, C-E-D-E. To seed a property. Just
okay.
That's right.
Huh.
We're doing vocabulary.
I concede a decede, yes. Well, these are just nomenclature. I mean, it's the same thing. Here
we go.
Yeah, we can talk language for the whole segment.
Yeah, we should.
That's my gig.
Totally could.
Just
go George Carlin on us.
Give up surrender or yield control of something. I don't know if they yielded.
No, they definitely did not yield.
We're just
No,
That's a whole nother
They did not
saying
yield.
stuff. Yeah.
Good heavens. Yeah, we always have to tiptoe around this. I mean, we just talk charts, Tim. Just talk charts.
Tim, what are the charts you're looking at today?
I'm looking at a number of things. Let's bang them through. Here's the ES. And for the moment, we are, nothing's really broken. That green line there represented get back there. That green line represented the prior price peak from early June. And we bested that on August 4, went blasting over it because we had these 4 huge days, which sort of climaxed here. But nominally, we did kind of creep higher. So all we've done is undo some of that. We haven't even done this single bar. So the ES it's nothing's failed. This isn't a failed bullish breakout, but we're closer than we were. In contrast to this, we've got the NQ, whose own lifetime highs were a while back and were not beaten. The lifetime high from June 4th still stands. And I was wringing my hands yesterday because we were getting terrifyingly close to this trend line, our descending trend line. Because as we remarked yesterday morning, we have been engaged in a series of lower lows and lower highs. But it was getting a little scary. But because God is gracious, we are getting a sell-off now. We've got over 500 points on the NQ down. Not quite sure the catalyst. It really hardly matters. I suppose AI worries are kind of bubbling up again. Plus, as we've all discussed, you can't argue with facts. The seasonality is very positive for the VIX over the next 8 weeks or so.
Yeah, we've been playing for potential downside move, not because we thought it might happen right now, but just because the VIX was so low and the markets were just teetering. It felt like so we threw on some downside hedges in NDX and SPX, but this market would be much weaker if Apple wasn't up 2%. So I think that says a lot.
Yeah, I don't, funny enough, as big as it is, I don't trade Apple. I don't look at Apple. So I wasn't even aware of that. So that's extra cool. Whereas, say, by way of contrast, like Meta just keeps getting pounded. I suppose the trial that's commenced has something to do with that. As I've mentioned before, I'd covered my own Meta short down here, and it got deliciously close to its price gap. Didn't even fill it, though. It wasn't strong enough to even make that modest achievement. And then it's been falling since then. And broadly speaking, and the reason I thought that it was still quite shortable is because we have been in a private bear market for a year on Meta. Because this guy was around 800, is in the 500s now. And so in the midst of this shameless and unrelenting bull market in tech stocks, Meta has been just off in the corner over there. And so it's been this week, even in that context, in a bear market, if one ever comes again, you can imagine what risk there is. So this is kind of the big tobacco moment for Meta, people are saying, with respect to their own liability, with respect to their influence on children.
Yeah, I think so. It does feel like that. And it does just seem to be going through sort of a huge monumental change. I mean, they might have to change business in some way, shape, or form. And I think that's what we're seeing in the stock. So, yeah, this is one I think either way, I think, whether it's bulls or bears, I think you got a lot to sort of play here.
Well, I'm a stock picker at heart, and that's why I'm pleased to see correlation, break away from 1.0. There's even in the midst of the craziness we've seen recently, there's always opportunities in either direction. What's been kind of vexing for me, and I'll use that as a talking point to get this next chart, is semiconductors, because up until sort of the Leopold Aschenbrenner bottom here, it was just a dynamite setup. And it bounced, sure, and that's okay, but it kept going up. And it's not really illustrated here, but I talked about this in my memory stocks video over the weekend. A lot of very pretty setups just got ruined, spoiled, whatever negative attribution you want to lay down, just ugly. And out of nothing but spite, I tried again to short SMH, and that's worked out so far. Although for myself, the big money, which is just a simple directional SMH put play, I've been too shell-shocked to bother with. And of course, those are doing amazing. I'm not in them, but I'm short SMH because talk about terrifyingly close. I mean, we've been in this, I think as I described it to Mike yesterday, is this broadening descending pattern. And we just tagged it yesterday and just not a penny to spare before a breakout.
Yeah, it's been a weakness of this market today, but it's also been, the driving force to the upside in terms of how we got to this point in the NASDAQ. But it really is the pull on the market today, and it could be the unraveling of the market paired with products like Meta falling as well.
Yeah, I mean, I saw a headline this morning like OpenAI signs a 20-year lease with something that's like 20 years. I mean, you guys, don't know what's going to happen in 20 days. How on earth do people suppose that in the year 2046 we'll have any notion of anything? But there you go. But relatedly, and this was sort of a bad news, good news for me yesterday. WDC, Western Digital. This kind of has a special place in my heart because I mentioned the video I did this weekend about semiconductors, and the video was called something like, only one of these is shortable, and that was WDC. It worked out, but it didn't look so good at first because yesterday, Monday, we had yet another green bar on this fella, and it blew away this price gap here, so we more than sealed the price gap. But, I took a hard look at this, and it was still a good-looking short. And so in spite of getting stopped out at a loss in the morning, I reshorted it at a higher price later in the day, and it's down over 8% now, $43. Because, like I said, none of the semiconductor shorts are as clean and pristine as they were. But this one wasn't bad, and so I gave it a gamble, and that's working out so far. WDC.
Yeah, Jermal's been trading SanDisk, MU, I think WDC here and there too, but with just butterflies, like playing big directional moves in either direction, and it's been working out really nicely.
Yeah, I just did one from yesterday to today, literally $1,200 in 24 hours. That worked out well to the downside.
I heard the dollar before this show. I heard you mention that dollar figure, but I didn't know what it was about. So now I know.
Yeah, it worked out well. I did the 1600s, 1500, 1400. I arguably probably took it off a little early, but it's fine.
Right. 1200. Take the wife out for a nice dinner.
Yeah.
And that's on inflation.
Yeah. It'll be all gone.
Yeah.
It'll be
Leave the house, $500
immediately.
Yeah. Just in passing, we had also mentioned yesterday about this kind of range-bound SpaceX, and sure enough, it's slipping lower. It's God bless it. It's hanging in there. It's doing all right. But I can easily see this just lollygagging around between 104 and 150. It needs a catalyst to bust above that. But no big surprise here. I mean, given the high volume on these and the nature of this setup, are either of you messing around with SpaceX?
I just have a longer term position in there, 2 years out. The 125 short put that I sold for $3,000, and then I bought the 300 strike call, same expiration cycle, for $2,700. So $300 credit in the middle. If these options expire worthless, to make $300. But if SpaceX finds a way to go from 140 to 180 to 220, this will be a couple $1,000 winner, and I can exit. But I just wanted to get the asymmetric upside with a long time frame, but still route a credit in the middle in case nothing happens and we just chop.
Well, yeah, all things considered, negative 3.6% isn't too terrible, because this thing's going to have outsized moves no matter what's going on. And I see we're right near the lows of the day on both the ES and the NQ.
When's the next tranche of what's the word I'm looking for? The stock?
I haven't answered that. I have this cute little birdie calendar. Its sole purpose in life is to track those. So very low tech. But yeah, the first one was August 11th, then Friday it looks like August 21.
Okay.
Yeah, another 7%, and then just kind of regularly September 10th, September 25th, on and on and on, and then the big one is November 9. That's 28%, and then the last little tidbit is the 9th of December.
Interesting.
There we go. All right,
love it.
Keep an eye on those.
Well, Tim, appreciate you. We'll see you later on today.
See you both. Bye bye.
Tim.
Adios. E-minis selling off at the session lows, down 53. NASDAQ down almost 600 points now. We are hitting the lows on both of those fronts, and SanDisk's down 200 points. He closed that butterfly, $1,200 holla.
Yep. Closed the butterfly in SanDisk today. Just literally put that on yesterday for $6.50. Closed it for $1,900. And the other trade was Home Depot. Rolled out a super bull that is 24-cent credit. But stock took off here a little bit. It's up $6, so that's working out.
Yeah. Well, it's been a fun morning. If you want to reach out to us on Twitter, you can always do that. I'm at Trader Mikey B. Jermal's at Jermal Chandler. We're going to kick this over to Chris and TP right now, though. You're watching Tasty Live.
We're back. You're watching Tasty Live. Still Tuesday here. I'm Chris Vecchio. He's TP Tom Preston. This is Confirm and Send. Your questions, our answers. You send them to research@tastylive.com. We read them here every day, 10 a.m. Central Time, 11 Eastern. TP, how are you?
Chris, time to go buy your wife another wedding ring because they're just getting cheaper today. They're whacking gold. I have a couple long positions in that. It's not looking pretty on the gold side, Chris.
Not gold, not silver. The metals aren't having fun. Really, anything that's rate sensitive isn't having fun today. Bonds dipped into a 107 handle here, TP. We have bounced back. We're back to about 108.5 in ZB right now. But the highest yield on the 30 years since 2007. And the highest year on the 10-year since January 25. Really spooking this market here today. But it's the things that are related to all of the AI financing that are taking it hardest. I couldn't help but notice, yes, the S&P is down, but RSP, your equal weighted S&P 500 is still up, right? So in terms of how this market is shaking out, it's the stuff that was up yesterday is down today. And more importantly, if it's proved to be who's going to be paying for all this investment in infrastructure?
Yeah, and Chris, whatever the narrative is, right? But there's no question that, where's the money going to come from? And if you need to build whatever, $1 billion or multi-billion-dollar data center or server, but whatever the heck they're doing for this AI stuff, you got to pay for it. And, I think going out to the market and selling bonds here to raise money, whatever rate those bonds are paying or the companies are paying on those bonds could be cheaper than the growth they see in these in their big bets on AI. So that I can understand. The issue though is it's pulling money away, like we said yesterday, and like I've been saying for a while now. It's pulling money out of the treasuries. There just isn't the demand that there used to be. It's not catastrophic, but the demand is lower for treasuries. They're up a little bit today. They're up a little bit. I'm short a call spread in ZN. I'm at about, 35% of the max profit. I'm going to try to wait for that to come into 50% max profit. But then I'm going to sell any rally in ZBs. I know you're long some put spreads, Chris, and that's how I would trade it too.
Yeah, there's no, it was nice seeing him move down to 107 overnight, but not when I was awake. So my plan to get out of this position when I saw 107 print in ZB couldn't come to fruition because, it wasn't here. But we'll see what happens now, TP. I mean, I still like the structure. It's still heading lower. It broke down to a fresh yearly low. It broke down to a fresh low for 19 years, which is a pretty long time. Patience here. Oil's still going up.
Well, and it's sort of thing. Well, why aren't you guys contrarian bulls on these bond sell-off? Just because I don't know. I'm not shorting futures here. Okay, I'm going to sell a call spread. I'm going to buy a put spread. I'm not taking a massive amount of risk, so that even if bonds jump 2 points, okay, I'm going to lose some money, but it's not going to be this awful loss. And that's the point I'm trying to make is. Yeah, I mean, it's kind of following the trend. I'm not necessarily a trend guy, and it is against my sort of, contrarian nature. But still, I just think there are too many things weighing on bonds right now. I think the U.S. government, there's only so much they can do to keep yields down, and yeah, I'm just bearish on these things. The other big point too is, Chris. And this is, is the tail wagging the dog or whatever, but housing starts are the lowest they've been since, 2021? What did I read, Chris? Did you see that story?
Lowest since the depths of COVID.
Yeah. So that's not a good sign. And it's looking at all the, housing stocks. And like I said earlier today, in my morning segment, Rocket Mortgage is really the only stock, the only housing related stock that has liquid options. Everything else, I mean, Home Depot's not bad, and that's kind of a housing stock. That's up today. But Toll Brothers is down, Lennar's down, DHI is down.
Can we take a quick look at Home Depot here while we're on it?
Yeah, sure.
They had their earnings today. Yesterday we were talking about Home Depot. My trades of the day idea, or trade of the day idea, was iron condors across the space here in some of these consumer facing names this week, as well as a long super bear in Qualcomm, which on a day like today looks pretty good for shorting the weakest of the bunch yesterday in the semiconductor space. But Home Depot, right? There's now 3 days to expiration. This was put on for 96-cent credit. It's currently trading at 54 cents. So we've had a nice little bit of decay here. Yes, it's up, but it's still well within inside the strikes right now. So I'm not going to get rid of it yet. Maybe tomorrow with a little bit more decay here, TP. But this Home Depot trade is well on its way to working the way that we had hoped.
Very cool. Yeah, it's. I think the Home Depot up 530 right now is well within the expected move, and volatility has come in on that. I can looking at the options, they're just cheaper right now, and without even looking at the IV numbers, I know it's cheaper. So yeah, that's awesome. That's awesome, and that is one of the again, flying in the face of my own recent earnings experience. This is one that actually stayed inside its range. I've had a few that broke out and killed me, but that's trading earnings. That's why I use defined risk strategies on this stuff.
Can I make one more point to this?
Please.
When I put this on, in at 96 cents, each leg of the trade was basically 48 cents. Okay. When I'm looking at the short put spread here right now, this has already decayed down to 8 cents.
Yeah.
Is there much to be had by holding on to this for the next 2 or 3 days?
No,
not really.
Not for 3 days. No, not for 3 days. Not for 3 days.
Not for 3 days. So I'm going to see if I can get this out. If someone wants to come fill me at 7 cents, I'll let them take this from me.
Yeah, the markets are a little wide on that, but
They are.
if somebody wants to bite for 8 cents, do it. This is what I'm telling folks. It's, don't. The reason to close something is A, it hits a profit target, or B, in Chris's point, yeah, it hits both profit target and the fact that just holding on to the trade, he would not open that position at its current price. He would not today sell that call spread for 8 cents. That's a lousy trade. So if you wouldn't open it today, close it or roll it.
Close it or roll it. That's the deal. Home Depot, by the way, doing what it did today, gave me some confidence for Lowe's, which is up here a little bit, but that's also one of the trades on the board this week. The 205, 202.5, the 225, 227.5 iron condor here. If you were to put this on today, maybe you'd go up $2.50, for a short iron condor, because the move hasn't happened significantly. Also, Lowe's and Home Depot, right? Similar line of business. Is Lowe's going to jump another 3% tomorrow?
Yeah, I don't know what the difference. The markets aren't great in Lowe's.
It took me a while to be filled on this yesterday, for what it's worth.
And the thing is, that should inform you and anybody else trading Lowe's. If you're having trouble getting filled opening the trade, you're probably going to have trouble getting out. And taking profits, it's a little bit easier. Maybe you have a little bit of a cushion or time, in other words, to buy stuff back. But really, if I can't get in and out quickly, I'm probably going to move on. I may try to put sell some premium in Lowe's just to see. But, if I'm not filled in a few minutes, I'm yanking the order, canceling the order, and moving on.
Yeah, TP, I'm just running through some of these, popular names, so to speak, within the home builder space. When I hear the home builders quoted, it's often like Pulte Group or Toll Brothers. You say that the only liquid name within the space is really Rocket Mortgages, RKT. Rocket has 6.2 million shares traded today. I think Toll Brothers and Pulte Homes have 500,000 between the two of them. And very wide bid-ask spreads there on the options chain.
I mean, and I'm talking about the option markets that are they relatively tight, and home building stocks are not really. RKT, it's in the 31-day options. The 13 puts are 6 cents wide. Yeah, okay. There's a lot of open interest in them. And then what is is it XHB? The home building stocks is down 1% right now. You could try XHB, but I don't love the option markets in XHB.
No, these
There's
are
some open interest in some of the
strikes,
strikes, but not enough to tighten them up.
No, not at all. And even at the, September 18th, 31 days out, you're talking what? Unless it's at a round figure, you're really not seeing much open interest or even trading volume today. TP, it's confirm and send time. We've been talking a little bit about this market. Now, NASDAQ's down 1.9% right now, continuing to fall apart, down below some significant resistance, now turn support, now back to resistance perhaps. Confirm and send here. You send us your questions. We give you answers. Research at tastylive.com, research at tastylive.com. Hey, this first one is probably for me because yesterday's signal versus noise pertains to it directly here. I saw Chris break down that VIX trade. Someone paid $11.7 million for September 24 strike calls with a VIX under 15, so it needs just a 60% move to get to the strike. Is that a hedge someone actually expects to expire worthless or a bet that volatility is coming back? TP, I want to point this out yesterday. So on the VIX options chain, if folks go over to the signal versus noise video or they just hang around here, if you head over to the September 16th, you'll see at 24, there's now 244,000 contracts of open interest. What makes that remarkable is that yesterday the open interest, I believe, was only around 80,000 when we recorded that video, with a trade volume around 144,000. Someone put through an enormous trade, obviously expecting the VIX to go to 24. But those options were pretty cheap. If I recall, I can go back and check the notes that I had here from our producer. But when we were looking at the cost of those options, I think they were 73 cents each, and now they're trading at 82 or 83 cents each. So It's not necessarily a bet, right? And I do this sometimes, like when I do those intervention trades. Why am I buying out of the money calls in 6J, even at like 65 or 66 cents? Because if they intervene, the entire options chain is going to be repriced through higher volatility, through price movement, through yada, yada. So no, the bet isn't necessarily that VIX is going to go to 24, but it's a bet that maybe you're going to get a spike involved between now and then where the price of those 24 options, because they were so cheap, they will become inflated and they could flip them for $1, $1.50, $2. And that's really the way that I think how that's operating.
So it's anytime that you see huge volume in the VIX options, it's not a retail trader, first of all.
No. When they're putting through 140,000 at a time, right?
And this is some institution, whether it's a hedge fund making a bet. I think it's more in part either hedging some short premium, a desk has, or some hedge fund has. Could it be a hedge against a sell-off in the market? Yeah. So if I'm just long a bunch of stocks right now, and I need and I'm thinking, gee, we might have a sell-off at some point. Yeah, buying a VIX out of the money call could be a hedge against a long stock position. It's a little bit. It's not a little bit. It's very derivative. Okay, they're a couple of steps away from long stock deltas, a portfolio of long deltas, to a hedge with VIX calls. Something cleaner would be just selling S&Ps, something like that. So I don't know who this is. My guess is that it could be speculative, but I think it is a bet against some short premium option positions that are out there. If the trading desks, if the liquidity providers are short premium here, if anybody's stepping in and buying volatility in the individual names in the S&Ps, they're selling it. They're getting short this stuff, and that 24 call could be a hedge against just a bunch of short Vega that they're establishing.
PP, can I just pull up a fun chart here? I love this website, equityclock.com. It's a little seasonality website. Gives you 20-year averages, just laid out on your screen here. My cursor won't show, but if we were to go to the middle of August here, you notice from the middle of August onwards, basically into early mid-October, volatility over the past 20 years has tended to take a hike to the upside. In fact, if we go back over the past 20 years, the October VIX has averaged a 21.6 reading. So look, someone buying these calls, I think this is a seasonality trade, that you have a sub 15 VIX, that we're going into the teeth of midterms, FOMC meetings, CPI, Iran war resuming, another earnings season, right, coming around the corner, et cetera, et cetera. Someone was just buying a lotto ticket that was cheap, and I don't even think they're expecting VIX to reach 24.
Yeah, well, they don't need to. They don't need to. The future right now is about 18, a little over 18. So yeah, they could see, if VIX goes up a point, 2 points from here, yeah, they could have a decent profit. Is seasonality maybe?
Can we just harp on that, by the way? VIX options don't settle off the cash VIX the way people often casually quote spot VIX here, right? They're priced off of the VIX futures.
They're priced off, yeah. Just to clarify, at expiration, they settle off of cash. Okay, so if you held this call until expiration, it looks at the cash VIX. They're priced, as Chris just said, they're priced now 28 days in the future off the VIX future. Okay, so that's because there's no VIX hedge realistically. So anyway, I'm not so confident that it's a seasonality trade. Okay. I see it more of a hedge against some short premium.
All right. Well, more than one way to skin a cat here, right?
Right.
So
either way, they're buying the calls.
Either way, they're buying the calls. Like it's disaster insurance in some form or fashion because of the calendar, because of long premium outside. It doesn't matter to me. What matters to me is that we're going to question two. Question two here, TP. IV rank is high in a few names, but the actual dollar credits are still tiny. When rank says rich and the premium says otherwise, which one do you trust?
So we've been talking a lot about on Tasty, the low VIX, the VIX in the 14 handle, 15 handle. Gee whiz, I'm not collecting enough premium selling SPX iron condors. Okay. So talking about looking at individual names, Chris just talked about a short iron condor and Home Depot and potentially one of the lows. We do look at all these individual stocks. When you are searching for premium to sell and you start with the analysis of saying, well, I'm looking for high IV ranks, and then you go into the option, you're just saying, gee, that short put spread or short call spread isn't generating even close to a third of the width of the strikes. I'm looking at a 1 point put spread and maybe it's trading at 15 cents. Obey the option prices. The IV rank, even IV, is one step removed from actual option prices. And I know this is something I've said for years. I pay the bills in dollars, not volatility. So even though the volatility is high, if I'm not getting a credit for that short put spread or short call spread, no, I don't care what the volatility says. It is the option prices that tell me whether I want to do a trade or not. I'll filter things down. It's easier for me to do a top-down analysis based on, sort by IV rank and look at those stocks. But drilling down into, that's why I'll look at 25 stocks and trade 2 of them or 3 of them. Okay. Now that said, if you're looking at some of these, if the IV rank is high and the actual overall vol is high, and I know Chris, you and I have talked about looking at the individual option volatility, or the actual volatility, not the IV rank. If you're still not getting the premiums you're looking for, you may have to pull those a little bit closer to the at the money. So you may have to widen them out a little bit, which would mean taking a little bit more risk. In other words, selling a 3-point vertical as opposed to a 2 or a 1 point vertical, or pull it in a little bit closer. Instead of going out to, let's say, an option that has a 68% probability of expiring worthless, maybe pull it up to a 60 or, even like a 58%, something like that. You've got to manipulate the strikes until you find the trade that you like.
Yeah, TP, I mean, when rank and premium disagree, you always got to lean towards the premium here. And IV rank
100%.
is only telling you whether or not the option is rich compared to, for itself, I suppose. I'm going to use Home Depot, or actually Lowe's and LRCX Lam Research as an example here. Lowe's has an 82 IVR. Okay, LRCX has a 42.4 IVR. So if you just go by IVR alone, you're like, oh, I've got to go into Lowe's. But when you dig a little bit deeper here, Lowe's, the raw volatility in the 30% down the line. LRCX, they're still in the 60% here. So, a high IV rank in a low vol stock can be an absolute nightmare. It can produce a trade where the dollars received are just too small. You talk about always going into actually options chain. 305, 300, we're looking for at least $1.67. Is this even worth it right now for LRCX? Maybe not. right? You go over to Lowe's and we can go out to 3 days. And I know I already have a trade out here, but we'll call it like the 210, 207.5 is collecting 45 cents of credit. Is that even worth it? Maybe not. So the high IV, high IVR, they're not telling you the full story at the end of the day.
No.
You do have to keep digging. You can't just apply it automatically, but it's a place to start looking.
Perfect. That is exactly right. That is exactly right.
That's it. We go to 3. Number 3 here on the screen. When VIX collapses, people rotate from strangles to calendars and diagonals. What is it about those structures that actually turns low volatility from a problem into something that you want? I mean, the trade basically changes from selling expensive vol to owning cheap volatility with financing, TP.
Yeah. So what you're doing with those trades, when you're selling a front month option, buying a back month option, which is what a long calendar is, or diagonal. Calendars at the same strikes, diagonals are at different strikes. You're getting long vega. So an option with more days to expiration, all other things being equal, is going to have higher vega, a greater sensitivity to a change in volatility than an option with fewer days to expiration. So I'm selling a front month vol, or selling a front month option, buying a back month option. I'm probably going to be net long vega. So this is another way of betting on an increase in volatility. Yes, I can buy calls in the VIX. Yes, I could, buy premium somewhere. And I just got filled in my iron condor. Okay. But this is a way of going in an individual stock potentially, or even in the SPX. And instead of just buying premium outright, I'm going to sell some premium in the front month to generate positive theta, but get long vega. If volatility goes up, that will help the position. So you are, as Chris just said, you're buying cheaper volatility just overall, and you're getting long vega, but you're paying for it with a short front month option to generate positive time decay.
Right. I mean, that does, for the math inclined out there, which really, if you're approaching options, it helps to be a little bit more math inclined. But think of it as like a probability distribution curve. Think about that normal bell curve. When vol is really low, the curve compresses, and all of a sudden you're selling close. When vol gets bigger, the distribution of outcomes widens, and so you're selling the tails effectively. You want the high volatility to sell the tails, because then you're betting that the actual distribution will be normal, will come within. That's why we were talking this week, TP, with Mike especially, talking about like SPX iron condors. If you can't get filled before the open, when it was like 30 points wide last week, you were seeing this immediate collapse down to like 15 or 17. And if you missed the boat, then was it really worth trying to sell a 15-point range? Some days it worked, other days you got run over. So like the structure matters here.
Yeah,
low vol is not a problem for calendars diagonals. It's really part of the solution and the trade setup itself.
Yeah, and I gotta say, part of the reason you're doing, and this goes back to the previous question about looking at individual stocks and that stuff, is I encourage everyone to engage with the market every day. And I'm going to talk a little bit more about this afternoon, but it's, seeing what you can actually get filled on, seeing if the option prices are delivering what you expect them to be. But it's when you start experimenting with different strategies, calendar spreads, diagonals, you get better at trading. Okay, I'm not going to say you're going to make money on these things, but you get better at trading.
TP, we have one more question here. The S&P 500 hit a 50-plus records in 2024, 39 last year, 28 already this year, against an average of 18 per year. I'm assuming that's probably since 1950, I guess, which is usually the post-war demarcation for S&P data. Either way, 3 straight years of running way above normal. Does a streak like that show up anywhere in how options are priced? TP, if you don't mind, I'm going to answer this. Streaks like this don't get priced into the market as a statistic. They show up in changes of behavior. If dips keep getting bought, you'll see that realized vol comes in below implied vol. You're going to see that volatility can stay lower for longer periods of time. The market will grind around. But you're going to see maybe even call skew distribution change, right? Because behavior changes. I can't say with any degree of certitude, though, that the options chain looks back over its shoulder at the end of every year and says, oh, that was another year where we set up at least 20 plus record highs. which means that we should go out into the future and price in, another year where we're going to go up 20% or so. That's not how the market thinks.
No, option prices don't care about the actual theoretical value, has no input for bullish, bearish, neutral, the past, or anything. It doesn't care. The way it shows up is just like Chris was saying. If 50 years of bullishness or whatever the heck, people are looking at it and saying, gee, I'm going to buy those out of the money calls, sell those out of the money puts. That shows up. The market makers raise their prices of calls, lower their prices of puts. It's very, very mechanical. But that is a response, as Chris just said, to market or participant behavior, trader and investor behavior. If it makes them more bullish, jacks up the calls, drops the puts. It's simple as that. If they're afraid, somebody's buying VIX calls, they're afraid, they can do the exact opposite. They'll sell calls, buy puts. That's how that sentiment gets pushed into option prices. It's not a theoretical thing.
TP, one final thought here on this. So much of the market these days are zero DTE traders. We see it in the OCC volumes, where about 29, 30% of the market are like zero DTE spies right now. I don't think zero DTE traders are actively thinking about, well, it was a record streak. We had 18 plus new records this year, so I have to buy calls again today. So like, what's the time frame for how the market operates on? As it's becoming more short term in nature, some of these longer term statistics, I personally think, matter less and less and less. It's one of the reasons why I hear people reference data from 1950. I do it myself, but also how much has changed since 1950? We should really reference things since post-COVID, TP.
It's a factoid.
It's a factoid. It's a Snapple fact, we'll call it. It's a Snapple fact. Remember those?
Yeah.
And I think most of them were fake too, which is a great place to end on here. These questions were real and the answers are real too. Send them in, research@tastylive.com, research@tastylive.com. We'll give you more than the Snapple facts. We're done here. We're taking a brief break. Errol Coleman's coming up next. More live trading ahead. TP, good seeing you. Keep watching Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
It's time to trade smart, post PDT rule elimination. Now, traders of all account sizes have more flexibility than ever before. With rapid order entry and bracket orders that let traders manage entry, profit target, and stop loss, all in one ticket. Tasty Trade.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
What is going on, everybody, and welcome back to Risk and Reward. We've had a pretty volatile market, had a little bit of a gap down from last night, so we'll look at these indices, SPY, NASDAQ, and the rest of these underlyings that we have on the portfolio, but I hope everybody's doing well. Let me know what you're looking at. Let me know what you're trading, and with all that being said, we can go ahead and jump into the Tasty platform. But bear with me for 2 seconds as I open up chat here. Let's see let's see what's the most volatile asset that we got going on right now. And we also have Gus coming back this Thursday. I know it's been a little bit of a long Alaskan cruise, right? But you gotta get out there on the water sometimes. And it's funny because I had actually had another friend that went on an Alaskan cruise just a few weeks ago. And I was like, oh, I didn't know people went on Alaskan cruises. And then like a few days later, Gus was like, yo, I'm actually going on an Alaskan cruise. I was like, yo, I'm just out of the loop. Apparently, these are things you should be doing or having on your list that I wasn't aware of. But shout out to Alaska. But no, Gus will be back on Thursday, and we'll get it rocking here in a couple of days. But hope everybody else is doing well. Today's been a pretty good day in the overall portfolio, I will say. We've seen a little bit of a continuation in oil. We're starting to see a little bit more of a pullback in some of the indices right now. And then with the given sell-off that we've seen today, I've taken advantage of that to then scale out of some of the other positions that we had put on during the trade of the days. What's going on, nice boy? Good to see you in chat. Good to see you today. Yeah, but let me know if I'm missing out on anything else. Am I missing out on some copper markets? You know, what's moving without us? I feel like we're all looking at the same things for the most part, right? We had a pretty big gap down on some of the semi names, on a lot of the memory names. And just looking at SanDisk here, SanDisk down about 143 points on the day, about 8% on the day. And this is, again, a testament to how volatile some of these underlyings are because, I mean, just from looking at the daily chart, right, it looks like just another trading day. And then whenever you look at the change, I mean, 143 points, you know, in less than 12 hours, that's a pretty big move, but we've seen larger moves from these assets. I mean, SanDisk is an expensive stock to trade. That's also why we've taken advantage of getting some exposure to that market using INTC and Micron. What's going on, Sam? What's going on, Ryan? Hope you guys are doing well. I know I'm taking, again, like I was saying, I'm taking advantage of the pullback that we're seeing right now. I don't know if this is just going to be a brief moment in the market before we rip back to the highs. So I know we have a little bit of a window of opportunity to manage some of that short delta, given the down day that we're seeing so far. But I mean, I think it was good for markets because we needed to see a little bit of a pop in the volatility index. It was super quiet. You know, 1590 is nothing to rave about. But I mean, you know, just a couple of days ago, we're trading at a low of 1421, right? So 1590, about 16 on the VIX is a lot better than 1420s. And whenever VIX is, you know, down at these levels, it is nice to take advantage of that vol expansion a little bit there. But it is nice to see that vol's back in business. We'll see how that translates to the rest of the market. One thing I want to check quickly is to check out this backwardation that is still existing in the oil markets. You can see this front month trading for about 85, back month trading for about 69.99. So I mean that curve of backwardation on the oil market is really steepening right now. So we'll keep an eye out for any type of continued volatility. But I think this trade is coming close near to an end, guys. We're gonna have to take this off here soon. It's nice that we're able to take advantage of that upwards momentum in oil. But what we don't want to sit through is any type of deep pullbacks in the oil market, right? We could get a pretty deep pullback and then we could have a continuation to the upside. But given the fact that we only have on one contract in the micro crude oil, I mean, our hands are tied. There's really not much management that we can do with just one futures contract. So I think we just got to take advantage of the momentum to the upside on this current trend that we're on. And then we're going to look to exit that one. And then if we want to reposition with some USO products, you know, we'll go ahead and do that. But, you know, the market can't just head in one direction forever unless it's Micron or INTC or SanDisk or gold or silver or Dell or AMD. I might be missing a few there. Yeah, so again, guys, Gus is going to be back here on Thursday. He had just taken a little bit of time off. He had went on a nice little Alaskan cruise, so I'm sure he'll have some really good stories that we'll get out of him whenever he gets back here in a couple of days. Trade for you, ASX 918 short put, 35 strike. ASX, let's go ahead and check it out. ASX. Let's see, we have an IV rank of 46, just over 46, down about 9% on the day, $3.50 and some change. Right now trading at 36.21. This looks very similar to a lot of those memory names right now, right? This looks very similar to like a SanDisk. It looks even very similar, even closer to like a SMH right now. Yeah, ASX almost looks identical to SMH right now. We do have a position on an SMH. We ended up selling an out of the money call spread. It is $5 wide. We collected $220 on it. It's doing all right. I mean, it's doing a little bit better today The P&L open, we're up about $17. So really nothing to ride home about, but we're seeing some moves in the right direction there. And I think right now, it's nice that we're seeing this, we're seeing a little bit of volatility to the downside on some of these names. But given the fact that, I was so short into this portfolio. You guys see me put on the short delta day after day. I don't want to overextend myself too much. So I think if we continue to keep sliding, we're going to continue to scale out of these positions really slowly. So that's what we'll do for today. And then we got more trades of the day coming later today around the top of the hour. So we'll keep an eye on that. But just a quick update for everybody. We do still have on our long position in oil. This morning, there's this contract, the MCL V6. I was on my phone this morning and I wasn't seeing the position loading on my phone. And I have my broker connected to the trading view. And I clicked buy on it because I was like, my broker should be connected. So I clicked buy and then it bought oil again. And I was like, oh snap, did I accidentally buy 2 contracts of oil now? That should have brought my average price up on oil about halfway of that move, right? Because we only had on 1 contract. And I come to find out, no, it was actually the different expiration oil contract that I was looking like that I was looking at. That's why we're down about $1 on the day on this one right here specifically. But I was really happy I didn't accidentally buy another contract in the MCL U6 contracts. So with that being said, we scalped a little bit in the micro. NASDAQ, we can go over that here in a quick second. Apple's seeing a little bit more of a rally to the upside, which isn't conducive for the position that we have on here. We have a little bit of short delta on. Overall position is still sitting in the green. Our strikes aren't being tested, so we'll be patient on that one, right? We don't expect the market to continue to move in our favor on a daily basis every single day, unless you're long SPY and QQQ, and the memory names and all those kind of things. But we're seeing a little bit of a rally in Apple. We'll stay patient. 31 days left till expiration. App loving it is another one we're seeing some recovery in, which is really nice because we had gotten long post earnings off of a massive gap down. And this was one of those underlyings where we felt like we were catching a little bit of a falling knife. But we're seeing a little bit of a floor here, or at least a short-term floor. Maybe we just pause the momentum. Maybe we're going to make lower lows. But with that being said, App loving is up on the day, which is doing a little bit better for the overall portfolio. INTC, I ended up taking off today. This was another memory name that we had put on. We bought this one for about $284 a couple of days ago, and now we got out of that one this morning for $395. A lot of these names would have looked a little bit better. Like we could have squeezed out a lot more profit, but such a massive gap down overnight, and then we get a continuation to the downside after market open. You never really know if we're going to get a reversal after such a large gap down overnight, right? So obviously, you're not going to be able to take advantage of the full meat of the move on some of these moves, but it was nice to see the gap down overnight. Take that off the table, especially because we have more short delta on in those names like Micron, right? Micron is still a little bit underwater, but it's coming back so far. We have 3 days left to expiration. We're down $92 on this, and we were down like $250, like $300 on this just yesterday. So 3 days left to expiration. If we can take back or reduce the losses on Micron within the next 3 days, that's going to be a W trade if we can see any type of drift lower in these names. But it is nice to have on INTC, hedge a little bit of the potential loss on Micron there. And then QQQ. Yesterday for trade of the day, we bought a QQQ put contract. We bought that one for yesterday. We bought that at 313 yesterday. And then we sold it this morning for 873. And as I sell this one this morning, we continue to see lower lows being made in the Qs, which is just bittersweet every time, right? Because it's like the market could reverse half of its overnight gap on you, and then you're going to be sad because you only snuck out maybe 50% of that put options contract, whatever it is. But if we just look at, where that contract has been, I think we had bought the 728s. That's crazy. That's crazy. It's sitting outside the expected move when just yesterday it was an expected move put that we bought. So we got the expected move from the week in less than 12 hours. And now the put that we bought that was at the expected move is sitting outside of the expected move to the upside. And that really just shows how much of a large move we've had overnight so far. But just looking at some of these put contracts, you can really see the volatility of them, right? These were trading at around $3-4 just yesterday, and then opening it up at around $9.81. We ended up getting out of this one at about $8.73. And then these contracts have, for the most part, just kind of been slowly drifting higher. But that was for trade of the day. Yesterday, we took that one off. I posted that one on the trade page this morning. And then we also took off our out of the money call spread that we had sold on QQQ. This was one where our call side was being tested, but because the market gave us this gift of a sell-off, we took advantage on taking that one off the table because we sold the 725 calls and, or we sold the 730 calls, I believe. Let me double check on that. We sold the 730 calls, bought the 725s, but how deep of a sell-off we saw today, right? It's not, it would make sense if we saw a little bit of a retracement pop or a rebound back to the upside, given how far we sold off. So when I recognized that we still had 3 days left to expiration, I didn't want to risk this trade potentially being back in the money, right? Because we had such a overextended sell-off a little bit sooner than we had anticipated. But with that being said, a little bit more short delta on an SMH, up about $100 on that on the day. And then TLT bonds has actually been the thorn in my side, which out of all the underlyings in the portfolio, I would have guessed it would have been like Micron. I would have guessed it would have been SpaceX, and I ended up squeezing out a profit in SpaceX, but no, it ended up being TLT bonds. We got about 3 days left to expiration. It is a zebra trade, so we don't have to worry about any of that theta decay, any of the extrinsic value, but we do have that expiration, now that we got to consider that's right around the corner. Yeah, morning, Ranch. Morning, guys. Could be a mistake. Morning, Big Deal. Apple getting the move finally. Yeah, I was just peeping that, Jared. I'm still sitting in this Apple trade right now. I had sold the 315s. I bought the 320s, just getting on a little bit of short delta at the highs over here. But no, Apple seems to be recovering on the day. What else do we got here? Alaskan Cruise must be not. Yeah, no, I mean, I think it's a vibe. I don't know what the weather is like out there, but I know the scenes have got to be astounding. And I feel like you gotta fish. Like I feel like you gotta throw a lure off the side of the cruise. Like you gotta get an Alaskan fish. You gotta do something. You know what I mean? What else do we got here? Yeah, that's what we have for the portfolio. Just looking at quickly at oil. Oil is still continuing that momentum to the upside, and we'll switch over here to the trading view charts here in a second so we can get a better look at these oil markets over here. Let's see, where is this contract here? Jump over here. We'll come back here to NASDAQ in a quick second. We'll go over some of the scalps that we had taken today. But within this oil market, maybe I have the wrong contract. And again, maybe it's going to be MCLU. I believe it's the 2026. There we go. Here's the correct contract. So again, we're long 74.33 on this oil market. I'm going to zoom out to the hourly chart, get a broader view on what's going on here. Like I said, everyone's got to plan an Alaskan trip sometime, if possible. It's so beautiful and geographically diverse. Just do the research and decide what you want to see, Errol. I will. I was just talking to Anna. She's out here. She helps us with a lot of the content that we get out. And she was like, I didn't take you as much as a cruise person. I was like, you know what? I'm really not a big cruise person, but I'm interested. Like, I've never been on a cruise. I don't know, being out on a body of water, I'm like, I never found it that appealing growing up. But like, honestly, I see the intrigue and I got to do it. I got to go on a cruise one of these days. So I'll let you guys know whenever that does happen. But an Alaskan cruise geographically does sound really nice. But the views have to be insane. And again, I'm born and raised in Colorado. So when it comes down to like views and enjoying the environment, like I'm in there. I was living in Florida for the past 4 years and it's just so flat out there. Like it's nice getting that tropical weather. But in terms of like views, terrain, prettier bodies of water, definitely Colorado has that ingrained in me. But no, with that being said, these are the oil markets that we were looking at over here. And one thing that I was doing to gauge this trade was I was taking this previous swing high at around 93.61 on oil, and I was taking it all the way back down to that swing low and then to the current traded price. And I can recognize right now that we're trading at our value area high. So seeing any type of rejection off that level isn't going to be too much of a surprise. And I think we're actually going to take this one off here while we're together because we ended up squeezing out a little bit more profit on this one than we would have anticipated. This is one that's going to be bittersweet because we have gotten such a good entry, right? Such a good cost basis on this trade. It allowed us to hold this trade a little bit more freely, which had allowed us to catch this trend, which is really nice. But because it is just one micro crude oil contract, right? Our flexibility in terms of managing the position is very limited. So if this were to pull back all the way down to this value area low that's sitting at 78.04, I mean, I wouldn't really like that, right? I mean, that would cut the profit more than in half. So it's like, is that the risk that we want to take right now? Right? Holding this a little bit longer, understanding that pullbacks are normal in the market. We can find this tool over here, right? Understanding that pullbacks are normal, and maybe we pull back to the point of control, and then maybe we head higher through there. Maybe we pull all the way back to the value area low and then head higher from there. Or maybe we just continue this upwards trend. But the thing is, we won't know what's going to happen until it plays out, right? So, I mean, this type of drawdown, I don't think is something we want to sit in. Whether it pulls back to the point of control, then we have a continuation to the upside, or all the way back down to the value area low, and then a continuation to the upside. It's like, do we really want to sit in that potential drawdown if that scenario were to play out? I don't know. Maybe not really. So with that being said, we're going to go ahead and take this trade off. And we'll go ahead and just hit this X button. It was a nice run while we had it. It was really nice to look at that in the portfolio as we head into market open. It's really nice to have a green trade in the portfolio that covers the rest of your losses in the rest of the portfolio until that one trade turns red on you, where it's now not hedging any of the losses in the portfolio. So we'll take that one out, especially because we're trading around this value area high. I think this is going to be really interesting to see if we get any type of continuation, or maybe we start to stall out here. But I don't want to sit in any pullbacks right now, right? We've been too patient. My cousin works in cruise industry recently and posted some stories of an Alaskan cruise. The views were badass. I could imagine. I think I seen one thing that Gus had posted, and I was like, oh, that's fire. That's a vibe. I was like, that looks like my background wallpaper on my computer from 2006. Like that looks like a wallpaper. I've been in the extreme north of Canada, opposite side of the Alaska mountain range. It is an experience golfing at midnight with no lights. That sounds amazing. It sounds really good, but you got to tell me if it's overrated. But like golfing at night with glow-in-the-dark golf balls. It sounds really cool, but there's some things that sound way cooler when you think about it that might be a little overrated when you're actually doing it. I'm not a golfer, not yet. Still got to go out to the ranges, but I feel like that would be pretty fun. What else do we got there? I'm running the crude oil grads. Appreciate that, big deal. Yeah, we'll see what the oil market provides us with, but I know we have a lot of uncertainty around the corner, as we always do with especially the oil market, but especially coming into midterms, getting into this fall season. It does seem that this conflict will be prolonged, right, with the Strait of Hormuz, Iran, Trump, all those kind of things. But at the same time, we don't know the type of volatility that we could experience while the market is trying to go from point A to point B. So I think it's just about thinking about that potential volatility and thinking about if you want to sit in something like that, if you want to manage something like that, because whenever you're swinging these trades too, right, it is something that's going to take hold of your attention. And I think there's certain trades that we have to ask ourselves, how much attention do we really want to provide to this trade? Because I think certain trades definitely require more attention than others, and vice versa. Cruises are cool, but make sure you do the research on the ships, the cruise line, as you spend most of your time on the ship. Really good point. It's a really good point, Flipper. I know I was talking to Anna over there again. I hear they charge X amount for Wi-Fi or whatever it is. I can't imagine nobody not purchasing the Wi-Fi. Who's going to want to be on a cruise ship in the big 2026, for a minimum of 2 or 3 days? I don't know how long these cruises are, but nobody's going to want to go without Wi-Fi those last few days, especially being on a ship out in the middle of nowhere. I was talking about this the other day, and somebody came in here talking about Titanic. I was like, oh, hush. We're not bringing that up right now. Let's go ahead and check out this micro NASDAQ market. Go down here to the 1 minute chart. That back off. Go ahead and zoom in here, talk a little bit about the scalps that we were looking at today. So yesterday we were looking to take some shorts yesterday. The initial shorts were near that value area high that we were talking about. We ended up getting a failed auction at these highs. These moves are always annoying because they always come to, clear out the backside of that move. Anybody that has some stop losses over there. Not that they're hunting your stop losses, but, there's a lot of liquidity at those levels. Anyways, we tend to consolidate here a little bit. We noticed the weakness at this value area low. And this is where auction market theory really comes in handy, because auction market theory provides us with an understanding of the market is constantly seeking fair value. So whenever we see the market leaving a current state of fair value, we see a lot of weakness at the edges of one of these levels of, quote unquote, fair value. that's where we might want to get on some short delta. That's maybe where we might want to get on some type of short position. So that was the whole thought process there. We took some shorts at this value area low. This is where we had bought the put from yesterday. And on that first initial leg to the downside, we took off the futures contract, but overnight we had that put option open holding for a directional move right from our level of value, indicating a little bit more of like an imbalance move, a little bit more of like a breakout. Because whenever we start trading outside of value, there's less liquidity in those zones. So it makes it a little bit easier for the market to be more directional. So that was a little bit of the thought process there. Here overnight, I was looking to quickly dip by this value area high, but I'm very quick with those trades because if we don't get the bounce off the value area high, it's a trade that I don't want to be in anymore. And also if that fails, it also lets me know the market is more than likely accepting this zone as our new level of value. So seeing that, I was pretty quick to get out of those longs. And then seeing that the market was acknowledging the edges of these levels of value gave me more confidence to trade this as if it was a level of value. There was a potential short this morning that we could have taken, but given the massive gap overnight, I didn't feel comfortable taking the short. Even though everything told me to take the short, I just couldn't get short again, given how much we sold off overnight. Hindsight, it would have worked out. But with $148 of profit, I know this looks a little bit crazy here. I was trading on the 15-second chart. I'm on the 1 minute, so everything looks very mushed on top of each other. But I think this was about like $30 in this range. We were just looking to take a long back to the upside. And then once we got down to our value area low, we were looking to dip by this. And then that gave us like an extra 50, 60, $70 of profit. Market ended up making a new low. And then now, it's reversing on the day. But that's what we had done over there in the micro NASDAQ. As we jump back over to the Tasty platform, we ready for the 700 butterflies this afternoon, fam? Yo, what are we doing with the butterflies, guys? What are we getting into? I am going to be utilizing the butterflies a little bit more often, but I'm curious to see what you're eyeing right now, Jared. I live in Washington State and did the Alaskan cruise a few years ago. We both live in beautiful places. Alaska's on a grander scale, and from the water, sea life, everything, go. I will have to definitely do it then. I mean, you guys are getting me a little hyped up right now. I don't know. You guys might be some cruising ambassadors, is what it sounds like. SPXE, I got you. Looking at SPX. You looking to get on a little bit of long delta, maybe a butterfly to the upside? Is that what you're looking at right now, Jared? Pretty large gap down on SPX, right? I know we had a little bit of consolidation, near these highs right now, but it's looking like we're seeing a little bit more momentum in these indices. I'm going to stay a little bit hands off on this one, but I'm going to continue to keep an eye on it, Jared. We have been doing butterflies in the final 30 minutes of pin levels. We've been on a streak, 0 DTEs. Yo, Jared, don't tempt me with a good time. I heard you guys talking about that, and I might have to start tagging along. So let me keep an eye on SPX a little bit more. I'm going to start paying attention to this options chain a little bit more as well, and we'll look at some of those 0 DTEs in there. But I like it. I love it. Lastly, before we have to wrap here, guys, let me know what else you might be looking at. Right now, we have NASDAQ pulling back about 466 points on the day. It's so funny, right? Like last week and the beginning of this week, we had like inside day. We had like 4 out of the 8 trading days were all like inside days. We haven't really gone anywhere. We've been consolidating on SPY, on SPX, ES. But the range is starting to open up a little bit more over here on NASDAQ. This would be insane. I mean, if we get any type of big pullback before QQQ makes a high, this pullback in the indices could be pretty aggressive just because we have such a massive divergence between both of those assets. So if QQQ doesn't make it back to the highs, we probably see a deeper pullback in SPY for sure, and most likely in the Qs. I know it's still summertime, right? Like I know we talk a lot about seasonality, right? I listen to a lot of other traders. I listen to a lot of, I listen to everybody's point of view. But the way things are setting up right now, it's like, man, they can really prolong things as long as they would like because things look pretty weak now. I'm not going to lie, unless this dip gets bought up. But I mean, if this dip doesn't get bought up, if we stay down lower at these levels, we most likely have a little bit more downside. That's just how I'm viewing things right now, especially if this swing low at 660 is not protected. I mean, failing to make another high as SPY has already made consecutive highs and QQQ doesn't, and we go back to the lows, that's massive weakness in the market. That divergence never, came back closer to a 1-to-1 correlation. I use 2 computers at home. in my laptop. I just started using the beta version, but drawings made one PC aren't showing up on the other. Am I missing a settings or save? That's a really good question that you bring up. I don't believe that you're missing any settings. I know for myself, right, there's a different computer that I'll come in here on Hop On and I'll log in, and sometimes I won't have the same drawings as I do on my personal computer. So I've noticed the same thing, but I don't think it's a bug. If anything, you can give the desk a quick call and they'll answer any of those questions for you. That's a very nuanced thing that you brought up that I actually experienced myself. So, but no, with that being said, Jared, big deal, nice boy, Ryan, Flipper, BW. I appreciate all the crew's the crew's encouragement. But with that being said, guys, we'll continue to manage these trades. We will be back later today for more trades of the days, trade ideas of the day. But with that being said, we're going to wrap here. Be sure to stay tuned. We have more amazing content coming on next. We're going to take a 90-second break. You're watching Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click, all on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Pay for backtesting? Nah. Trade that capital instead. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial the DTE, stack the legs, see what survives. Check out Tasty Trade today.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Think you know where vol's gonna go? Test your theories with backtesting. Pick from hundreds of symbols, any strategy you want, and all the data to trade smarter. Tweak the delta, dial the DTE, stack the legs, see what survives. Trade what you want, when you want with Tasty Trade.
Step into the futures arena with Tasty Trade's active trader. Multiple ladders, hundreds of indicators, precision control. From micro gold to NASDAQ, all CME one click.
From the trade desk here with Marty. Marty, what's going on, man? How you doing?
That's with the man's headset.
Hey,
you know what I mean?
Nah, did you see that? People are very upset that Pat McAfee is taking over the headgear from Lee Corso. They are very upset,
right?
and deservedly so. That was his thing.
Well, maybe we need to start doing some more, promotional, field goal or trade kickoffs for
maybe
pull somebody out of the crowd. If you can put this spread on and make money, you're gonna get right.
Maybe
get the donations up.
I'm so hyped for sports, college sports, all that coming up, man. How's the desk, man? This morning compared to the last couple of days?
Kind of, mellow. Like Mondays, as we've discussed before, are intense there. Mondays are kind of like Fridays and maybe a little bit more because there's not. Obviously, on Fridays you have expirations and positions that need to be tended to. But Mondays have been, and especially yesterday with volume was nothing. I think I saw it was 63 million at the SIBO, and I don't think the SPOOs did a million contracts.
Yeah, I'm sure.
But
we're at 739K right now.
Yeah, it's been a reprieve, excuse me. And yesterday was one of those kind of sleepy markets. but it just kind of trickled down all day. And then today follow through again. So I don't know what numbers you had. I had that 77, like 43.40 in the minis as like a pivot, stayed below that. I think they made a high of like, I don't know, 77.70 or something. And now I think that 77.15 number, if it holds there, we'll see. But if it goes through that, and you could get a little bit of a flush out. We're kind of, I guess, due, maybe.
Folks, it doesn't get any better than a career and veteran trader giving you his levels right now. I mean, it doesn't get any better. I love it. Former S&P trader giving you his levels. By the way,
those are strictly observations. Those are not.
But you have an idea. You've seen some stuff.
I watch. It's like that's kind of what I know. I get up in the morning and I'm where are the minis.
Yeah.
And that's kind of, obviously is one of the biggest indicators. Or
even when you're on vacation, do you still look?
I look every day.
Yeah, I know. I know.
I just look every day. Okay.
Is this? I don't know if this is a. I've heard this is a little bit larger August expiration than what we normally see. Are you kind of experienced a little bit of that on the desk?
Yeah, I mean, I'm seeing the way that people are positioned. This could. I mean, it's been kind of busy for summer months anyway here. Which is odd in it of itself. But yeah, I mean, I'm seeing, when I'm going over accounts, I can get a good handle on when people have stuff that's expiring with the way that they're positioned. And we have a lot of traders now that are doing like the SPX where they're like long puts and they're selling shorts against it longer term.
Yeah.
And, but these guys that are doing this are all their expirations are like, okay, 7 days out, 6 days out, 5 days out, and they just keep recycling them to get to the point where I guess they're going to lessen the price of their longs because, naked SPX puts that are out like 80 days they're a bit pricey.
I mean, yeah.
They're very pricey.
Yeah. Yeah.
So, but yeah, I think it's going to be, I think that this could end up being like a kind of a nice summer month for the way it's. I mean, I was looking it up today. I think they said that, CME averages like 1.5 million minis a day when there's action or when it's busy in there. So, yesterday was like, I don't even know if they cracked 900, I think. I didn't look. But yeah, I mean, clients are putting stuff on. And I think, all of our guys, the vast majority of the people that trade with us have a pretty good idea of what they're trying to do. And it seemed to get better as they spend more time here.
Yeah, I mean, that's the emphasis, right, that we have on active traders. I mean, that's always been that reason because they're a little bit more sophisticated. They have an idea what they want to do. We see it on the live show, too. They are a little bit more aware of some of the things we say as traders.
Right.
They're aware that there's a VIX expiration tomorrow, which I think is kind of adding a little bit to what we're seeing here today.
Right.
Seeing flows change around. We got a VIX expiration coming up. Again, for folks who don't know, August VIX is expiring tomorrow, August VIX futures.
Right.
Last day to trade those options are going to be today at the close. Tomorrow, they'll just settle to whatever the VIX is. Always try to tell
people. And very few, like when we first started here, you'd get people that were trying to buy puts and get long options and trade directionally. And I kind of rarely see it, where someone's just long some calls or long puts. Yeah. I don't see it. So I guess, you guys are having a positive effect.
We try. Man.
Yeah.
We try.
I think
Could I bring you in for my review and you can just say that and just, leave out the room afterwards? That'll be good.
Perfect.
Okay. Sounds great.
You're kidding me?
Let's pull up the top 20 list of names that are flowing through the desk here today. Let's take a look.
See what we got. And this is like pick a screen too, This is pick a screen.
we got
this is when you really
whatever makes you comfortable.
Well, you have to be really able to act, and just switch views and stuff. But at number 20, we have Microsoft at a 29, 19 Palantir, 13, SLV 18 at a 23, GLD, its more expensive brother at 29, SMH 40%, AVGO at a 36. BE at a 21 at 14, 13 Netflix at 27%, Amazon at number 12 at a 16, 11 TQQQ at a 50, 10 rounding out the top 10 SOXL at a 50, 9 Intel 35, 8 AMD at a 30%, 7 SanDisk, that's a wild ride.
It's a monster.
That is a wild ride. 33 at number 7. SpaceX at number 6. The unfadable SpaceX at a 7. Number 5, Tesla at a 12. At number 4, NVIDIA at a 28. At number 3, Meta, 34. Number 2, MU at a 34. And Apple taking the top spot for a minute, right? At a 40.
Marty, with the Dave Letterman style of reading the top 20.
I like to start out and then build, build it, right?
I like it. I like it. Yeah, I mean, it seems to be still a lot of 4-letter names on the list, which you would imagine. That still has the volume. I mean, SpaceX, even though it's nobody loves it, it still has a lot of volume. People are trading it like crazy.
Say what you want. I mean, that thing looked dismal when it was down at like 110, 105. And now it's, he's just an interesting human being, to say the least. But nice to see Apple up there.
Yeah, what's interesting? Apple, there is the... I was noticing this a couple of weeks ago, and it's happening again on the days, and you can see on my side here. So these are all my tech names. These are mostly the AI related or chips names. You see Micron in there, you see SanDisk in there. All of these are down today. SpaceX gets lumped in with them, SK Hynix, all of those get down. And the two now somehow, I guess I shouldn't say somehow, and let me explain it. Apple is up, even though all the chip names are down. NVIDIA is obviously down too. And Microsoft, because it clearly is a risk on day for software names. You're seeing ServiceNow doesn't obey that trend. Adobe part of it?
Yeah.
Yes, it is. Adobe is up. So most of the software names are up. Many consumer staples names are up. Ones that I have in my portfolio, the Cokes, the Pepsis, et cetera, are up. And the chip names are down. That rotation seems to be at least back for a day. We'll see if this continues on the other side of expiration. I'm curious to see.
Anytime the market's down, CME's up. It's really interesting. Okay, coming from that background, every time there's a little bit of a break.
You guess SIBO's up too? Oh, slightly. Yeah, slightly. Anytime, you're right. I think people
interesting.
They run to those names somehow or another.
Well, that has that dividend that it pays too, which is it's kind of like an annuity. Obviously, they kind of control a little bit of the futures market. But I noticed that, just talking with like Jason at the desk too, it's like every time we look at CME and the market's down like 40 handles, it's up something anyway.
Mm-hmm.
I don't know. You could have a market where it's up like $100 or 500 NASDAQ points, and you look at CME and it's like down $4 for whatever reason. I don't know.
Are you hearing more people jump into the TLTs, the LQDs of the world? HYG's the other one, these bond-related issues?
TLT got busy, I think, a couple weeks ago, too. I had a lot of guys that were trading it, a lot of, condors and short put spreads and stuff in it. I noticed a little bit of a jump in it. And everybody's looking for that, oh, my God, what's going to happen? And then there's that nice landing base that you can trade in those. It's like, GLD and SLV getting busier again, in the sense that, are we looking for that life raft if something should happen in the market and, a correction? Because I get a lot of calls about that. Well, I want to protect myself if there's like a 10% down move in the markets. And then you're dealing with, how do you really prepare for that?
Yeah.
What are you going to put on? Are you changing the entire delta structure of your account? Are you adding stuff in there just to make sure that if it happens? So I think that, again, would you be shocked if you saw a 5 or 10% correction in this market?
5? No.
10 maybe.
I'm actually playing for a potential 5.
Right. But 10, that's kind of like the doomsday. And it's not.
Are these people with like big stock positions, or are they active traders just trying to look for it to take advantage?
I think that a lot of the clients that I talk to about it are the ones that are kind of have both, like stocks, leveraged, big option position, usually in PM and stuff like that. So they're looking for that kind of balance. Obviously, if you're looking for that type of move, I don't know that you can search for it, and I don't know that. I guess you could prepare, just be neutral. I guess
I could do the Mark Cuban trade, right? Collar,
for everything. I like it.
That was one of the first things I was taught when I got to the Options Institute at SIBO. I hadn't heard how he had what what was it? Broadcastify was his company. He got a lot of Yahoo stock. Kudos to him for even thinking about it.
Yeah.
I don't know who he talked to, maybe some advisor or something.
Right.
He wanted to protect his stock, and he was like, well, you can put on these collars.
Right.
And he went out and put those on. And I guess the Yahoo stock tanked.
Yeah.
Who knew?
Right.
Who would have thought?
Right.
Yahoo stock?
Yeah.
Man,
At
that was a big
time?
deal. Yeah.
Think about it.
Right?
But yeah, guys that, that are, trading naked short puts and a lot of stuff, which I don't think is necessarily a bad technique if you want that asset or if you're not afraid to own it. Because you could turn a covered stock trade, you could turn it into a strangle if you wanted, if you're not afraid to own the asset base there. So that one I like too. But collars I like.
Yeah.
Yeah.
I don't really have many. It's funny. A friend of mine, and I'll end on this. A friend of mine I was talking to yesterday, we were supposed to start in the options business at the same time. The only difference was I was coming out of grad school and I had no money. So going from no money to making no money was no big deal. You start in this business. Right. And he was working at Ford. He was making
transaction.
Exactly. And he was working at Ford making big money, so he didn't come in. But he still trades all the time. 20 plus years later, he always hits me up. We talk about stuff. And he was asking me, do you have any big stock positions? I was like, outside of a 401k, no.
Yeah.
I actually don't.
It's like I would never, for my kids and stuff, which like you're saying, for retirement stuff, yeah, I get it. You have to have it, right?
I don't mind having leap calls.
Right. But I would never, it would never dawn on me to go, yeah, I'm going to throw on 100 shares of, it would just, I don't kind of understand it in the sense of there's so many different ways around that.
Yeah.
There's so many different ways. That's another thing that you guys are great at. Showing somebody, well, I want to be long. I'm like, well, okay, sell a short put spread and get as aggressive as you need to get if you're trying to be long something. I mean, wouldn't you rather sell an in-the-money put spread than buy a call?
Absolutely. That's where I am now.
How aggressive do you want to be? Put it $4 in the money, see what happens.
Yeah. Folks, we just love options. Marty, thanks for coming on,
you guys
man.
are awesome.
Appreciate you.
All right, buddy.
You hear from the top 20 symbols on the trade desks. Hopefully you're trading some of those. Hopefully they're working out for you. We'll be back in a little bit here. We're going to take a quick 90-second break. You're watching Tasty Live.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The Motley Fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move. Investors Business Daily raves about us. Stockbrokers.com says we're best in class for futures trading, and Broker Chooser thinks we're pretty great too. So what else can we say other than Trade like a trader. Tasty Trade.
Tasty Trade is now on TradingView. Trade stocks and futures directly on TradingView charts with Tasty Trade's low commissions. Try it out and leave us a review.
What is going on, everybody, and welcome back to Tasty Live. We have an amazing research segment today for trades from the research team. Got my boy Sahil in studio today. We're going to talk about some markets. See what you got today, Sahil. How we feeling, brother? It's Tuesday. It's Taco Tuesday.
Yeah, let's talk about Tuesday. Same old market. Nice and sideways, choppy.
Yeah,
right?
has been pretty choppy. I feel like the last 2 weeks has been pretty choppy. If I had to guess, out of the last 10 trading days, it feels like about 50% of those have been like inside days, which we don't see every day, but it feels like it.
Yeah, it's feeling good right now. Not everything is moving up too much. Not everything's moving down.
Everything has already moved up too much.
I see.
Already.
Okay.
We're past the point of no return.
Yeah, and you are the perpetual bear.
I am the perpetual bear. But look, Tim Knight, is TP a bear too?
Yeah, most of the older guys.
Okay,
are.
those are the bears of Tasty.
Yeah.
I kind of keep my bearish tone to myself.
I see.
But I do have it.
I see. You don't want to mess with them too much, right?
Yeah, exactly. I feel like everybody hates short sellers.
So how do we trade in a sideways market like this?
Iron condors.
Try not to be directional.
Yeah, sell a little bit of premium. But how do you do that when volatility is sitting at like -15?
Are we allowed to trade long?
Yeah, I mean, you know what? Whenever I put on long positions and I buy options, like the whole chat gets silent. They're just like he'll meet his fate.
Yeah,
That's
one
the
day.
vibes I get from the chat whenever I'm not selling premium. But yeah, I don't know. Are we allowed to? Volatility is sitting at -50 right now. What are you supposed to do, Sahil? How are we feeling?
We're supposed to sit, just do some covered calls, buy some positions.
Yeah.
Let it ride up a little bit.
All right, I feel you. How are you?
It is post earnings, to be fair.
It is.
So this usually happens post earnings. It's
Yeah.
not anything special about this cycle, to be honest.
Yeah. No, you're right. You make a good point. No, I mean, what have you been eyeing so far? What do you got for today?
So, got 3 trades as usual.
Okay.
Yeah.
What we got?
Special research segment, trades from the research team.
Yeah.
As usual. I tried to put in some different types of trades ideas. So we have some regular tasty trade, bread and butter position on.
Yeah.
We have one, short legs, and then we have some long positions too. We'll see how the long position goes. So the first one is an M&Q position. 'Cause
M&Q.
We all know how much I put this on specifically.
I was like,
or my boy over here, Errol.
I was gonna say, is that a coincidence?
Yeah, the NASDAQ lover over here.
Okay.
Okay. Because we all know NQ is better than ES. Okay. That's just.
If there's ever one volume traded in the NASDAQ, just know it's me. Just know it's me.
So I'll explain the story that happened with this. I'm doing a defined risk trade in this.
Okay.
This is actually options on futures, which is an option that we have. So it's not directly selling or buying the future, which you can also do. I know you have a little futures trade over here where you're bearish in QQQ. Okay.
Yeah.
So you can do that with the futures as well, but I have over here like an options and futures position, in Iron Condor defined risk. So with defined risk, I don't necessarily need to do M&Q. I was originally just going to do a naked position in here, and so that's why I started using M&Q. You can also do this in NQ if you want a little bit more because it is defined risk, but it's just your Iron Condor position, slightly bearish actually. If you look at the delta, it's -6. I think we all are kind of a little bit bearish, So September 18th at the expiration is only 30 days. Not going any more than that. Trying to get in and out of this trade a little bit quickly. So
no, I like it.
The IVR in this one is 51.
And the buying power is only about 542.
That's the beauty of span margining right there.
That's nice, especially because we're putting on an Iron Condor in a futures product, which is a little bit larger than your regular ETF, right?
Yeah.
I like
Although
that.
it is the mini.
I'll take it. I'll take it though. I feel if that's only $542, I feel like for the mini, it's probably around a few grand to put on a trade like that. I like it. I like the volatility. I like how we're starting off so far. Some volatility.
It's
And
one of the few ETFs with actually good IVR volatility in there,
pretty solid.
Everything else is kind of on its butt a little bit. So
I like it.
All
All right, Iron Condor to start it off. He's starting off with the training wheels.
Starting off with the training wheels?
That's what you did. You give me the Iron Condor. You're buying the extra
what we
wings.
call Iron Condors now? Training wheels?
Yes.
I think
look,
you make people feel a little bit bad when they trade Iron Condors. When you call them training wheels, okay?
I only trade Iron Condors, and that's all they guided me to trade when I first got in here. So I was like, they want me to have these training wheels on. I want to take them off.
Guy who never learned how to ride a bike, right?
I can ride a bike pretty well.
Okay.
What we got coming up next?
So the next one we have is a short put position. So not a spread, not an Iron Condor, just naked short put. An NBIS. You know what this is? NBIS? It's one of the very few AI companies in Europe.
Okay.
Yeah,
So they're trying to compete right now.
Yeah,
with
this
the
is
AI
Amsterdam.
landscape.
Okay.
Okay.
Yeah, so an artificial intelligence company in Europe. So this thing is going to go to the moon one day, right?
Yeah. It
So
has
that's
to.
basically why I have a short put in there. So using slightly more buying power. It's only 2,000 buying power for a short put, which I'm saying only. That's pushing it a little bit for smaller accounts, you know. So you can define the risk if you want on this, but I want to see how a short put does in here. Again, if you want to try to diversify and avoid the U.S. stocks, U.S. ETFs a little bit, and you want to trade something European or something Asian, you can also do the Chinese stocks as well. Then I think this is a pretty good one. What are we thinking on this?
I like that, kind of diversing that risk from nation to nation a little bit. We don't really think about diversifying in that aspect too much. It's not like the default way to think
Diversifying
sometimes.
through different countries and
Yeah.
stuff.
100% different risks with different countries. I like it. I mean, a buying power of $2,000, which even for a small account, right? That's not terrible. That might be coming up to the cusp about how much you really want to allocate towards one trade. But 2,000 isn't too bad. I mean, selling a put here, you get about $7
People
worth
say
of
with
credit.
diversification, usually it's like, oh, this is an AI stock. It's going to move like basically the same as all the other AI ones. But there's more than one way to diversify and just going into different industries. You know, you can obviously diversify with the different industries, with the different sectors.
Yeah.
But you can also diversify through different durations. Have some trades put on, a 30 DT, have some put on 45, some put on 60, even have some zeros in the mix. You can also have some like this where you do different countries and stuff, So in different products, you can diversify by different strategies. There's a whole lot more that goes into diversification than just, trading McDonald's and Walmart because you don't want to trade tech companies.
Like, all I know is buy go up, sell go down. That's all I know.
Oh, wow. Okay. That's insightful comments. Right there.
What do we got coming in third?
All right, so number 3 over here is another bullish. This one is interesting. It's the long position I was talking about.
Okay.
We are bullish in TLT over here, so bullish in bonds. With a January 15th, 2027 expiration. We're going 150 days out in this.
Okay.
So basically holding the long call at the 83, right at the money, a little bit more. And because TLT is kind of on its, like with all the bonds, it's kind of on its butt right now. It's just been going down and down and down because of the interest rate stuff that's been happening. So maybe a pullback is going to happen. I think it might happen. I don't think it's going to continue to go down all the way into next year. Even if it does not come back up to its original like 120, 130 position, which it was at, it'll probably go up before the 83 call. This is just a pure speculation. This is 50% and even less like a probability of profits. This is my speculation trade with the long call.
This is a lot more attractive than the bonds trade that I have on right now. Bonds is my biggest loser in the portfolio right now. It is.
What do you have on right now?
Would you have guessed that though?
No.
Honestly not. Would you have even guessed I'm in a bonds trade right now? No. Have you traded bonds?
You don't strike me as a bonds guy.
Well, it's because I don't have any gray hair. That's why.
You don't have any gray hair.
There we go. Who's traded? You know what I mean?
Yeah.
I got a zebra.
You don't want that standard 4%.
So I have a zebra on in bonds right now. The overall position is down about 178
you
bucks.
and your zebra trade.
Yeah, it's pretty.
Next time I'm going to come up
synthetic
here, I'm going to
stock.
bring on a zebra trade.
We can do poor man's covered call with a zebra. I should probably look to see if I could sell some calls against the zebra.
You could also
that I have in
do.
TLT.
You can also do a poor man's covered call in this or a covered call.
Yeah.
Where you hold, TLT and then you just sell the put. No, sorry, sell the calls against it.
Yeah.
It's also a nice, strategy.
And I would have loved to do.
Synthetically the same. So.
Yeah. The thing is, I have 3 days left to expiration.
Okay.
I mean, how much could I really milk out of an extra call? I should have had more time on these contracts so that I could then reduce that cost basis a little bit by selling those
You've been in
calls.
this market. You know what's going to happen in 3 days. So.
I know, but I mean, bonds, I didn't expect bonds to get so volatile to the downside. I thought when bonds are down, they're a buy. Apparently, when the dip dips, it keeps dipping sometimes.
Well, our SPX and TLT, they have their inverse correlation, right?
Yeah, they do. There you go. No, we'll keep it on. I actually really like these trades. I actually really like the Iron Condor
Errol,
in the
it's
micro NASDAQ.
Important to pay attention to the correlation numbers sometimes. I know you don't like to get into the math too much.
No, I do. I do like
I
correlation.
talk to you about it and you're like, buddy, I'm trading without understanding 90% of this.
Hey, green is green.
Green is green. I like that. All right, at least you like the MNQ position.
I do.
Shocker.
I really like it. I actually really like the naked put one as well in NBIS. It's just it is pretty hefty on the buying power.
What are we
for
thinking
myself.
on the AI race over here? Everyone's saying the AI race between China and the USA. You think Europe
Ooh.
is going to get into the mix a little bit?
I think that
they're already behind.
You know what? I feel like a wrench is going to be thrown into this whole AI narrative, this whole AI story right now. So that would be very unexpected in my opinion. So that's why I think there's a chance that could happen.
I see.
I think there's
Expect
a
the
chance.
unexpected.
Expect the unexpected.
I see.
Yeah, 100%. With that being said, as we come to a close here, Sahil, actually really great trades. I'm sure
right.
others that have the buying power
That
for
you do
the
not.
necessary. Yeah, that I do not. Hey, look, there's a decent amount of buying power. We got to stair step. You know what?
Literally, one of these trades is 200 buying power, but okay.
I like that one, but I like the naked put the most. I think I like that trade the most. I just don't know if I want to allocate $2,000 worth of buying power just yet. But I'm sure some will. And I was even debating on the oil trade that has been the most profitable so far. I was like, how about we just absolutely just YOLO some trade with all those profits to build a bigger cushion. But
you too like doing your 50% less probability profit trades, right? Just
sometimes to get out of a small portfolio, you know, we're holding it down. But sometimes you need to take a shot to grow it a little bit, so you could have a little bit more flexibility with the strategies.
That you've been doing is wrong, then the opposite has to be right.
That's a good point. But no, anything else going to be top of mind before we wrap for the day?
I think we're all good. Do you have anything to add over here?
No, I like the trades. We'll take it from there. I know I need to look at the options on the futures contracts themselves a little bit more often. I think Mikey Butler has something.
I think trading
on
options
right
on futures and then also just trading the futures themselves.
Yeah.
You know, selling the contracts or buying the contracts themselves are super interesting because of the span margining. People, you know, often tend to forget about futures a little bit. So because, you know, CME products and stuff. But I think they're super, super interesting.
I agree.
And I think span margining really helps you with your BPR numbers. If you are a smaller account and you really want to, you know, help reduce your buying power, I mean, they're right there and they track the same products. So
No, you're right. It's a good reminder. I know it's a good reminder for myself at
you
least.
can get your CL and going in for the oil trades you want to put on.
I know. You can get creative out here. And these markets are volatile right now. So we'll keep an eye on it. But that is going to be trades from the research team. So he'll appreciate you. Great ideas. I know I'm going to be looking at the options on the futures products a little bit more often. But with that being said, guys, we're going to take a quick 90-second break. Be sure to stay tuned for more amazing content coming on next. We got trades of the day coming right around the corner. So be sure to stay tuned for that. More trades. Got a lot of management going on. Be sure to stay tuned. You're watching Tasty Live.
Oh, hello there. What's going on, Tasty Nation? How you doing? Trades of the day coming to you. I'm first up to bat. You know, you've heard this before, that the stock market and the economy, they're not mutually exclusive, meaning they might not always make sense at the same time. Like, for example, we're in an environment where inflation is high, despite whatever reports we've seen more recently. Inflation is still high. I mean, you step out of the house, you're spending $100 immediately, especially in a town like Chicago, that's for sure. And we're hearing about retail sales. You just saw retail sales late last week that showed it was kind of a pullback. Consumers aren't spending as much. naturally because inflation is higher. If you look at the gas pump, I mean, around this area, oil, gas prices are higher than 4% and change. And I know this is kind of a macro combo, but it's not really that much macro. I mean, it's everyday life. I like to bring, if I think about macro things, I like to bring it to everyday life. And so you're not going to hear me talk about this pie in the sky thing. These are things that are actually happening, and I'm pretty sure most of you are experiencing. You go to the store, and I tell you, you get a group of things together for groceries that normally used to be $60. It's like $120 easily. So we are in a high inflationary environment. That said, that's what's interesting about these retail earnings that are coming up this week. We just had Home Depot this morning that talked about people are doing smaller projects around the house, not these huge, massive ones, which I guess that makes sense. I mean, people are definitely staying within their homes, but they're probably trying to find less expensive ways to work on that asset, which it is an asset you don't think about from time to time, but it is an asset. Maybe I need to do a project. We have Lowe's coming up with earnings tonight, which may end up telling the same story. We'll see. Most times they do. Sometimes it's a little bit different, but I expect it to be similar. We got a couple of other retail-related earnings throughout this week, and then we got Target coming up. Target was one of those plays that had really struggled stock-wise for the better part of a couple of years. And let's look back at a further chart. And this is going back, let's go specifically 2 years. Where are we right now? Yeah, right in here. 2 years ago, stock was up to, I mean, it doesn't seem that bad, but it was when it was going through its first bout of selling. Again, this is a stock that used to be $200+ when we go back to 2022. The stock was $200+, which I guess makes sense. Coming out of the pandemic, a lot of people were buying a lot of different things. Things were cheaper and people needed stuff at home. And that was just kind of what happened. They didn't spend money going out or on casual stuff. They were still spending a lot of money at stores and getting stuff to the house. And we saw that change meaningfully kind of coming out of COVID, which I would say like middle to 2022, late 2023. And then also they were dealing with a lot of shrinkage, as we talked a little bit about this morning, like inventory shrinkage and a lot of things happening from store to store. But Target is starting to see a little bit of a renaissance here. I mean, stock bottomed late last year at 83. Man, that was a buy. Those are the times where you're like, should have bought a leap call. And to get away from Target just for a second, when you see these things happen in these stocks and everybody hates it, those are the times to attempt a leap call. I mean, why not? You know, just it's a longer term play. It's just like buying stock, and it's way less cheaper. At the time, that's $8,000 if you would have bought 100 shares. You could probably buy a leap call for probably half that. You probably could have bought a leap call for probably $40 or something, which again is $4,000, way less cheaper than buying stock. So just think about that in some of these stocks that we hate at times. Those are the times to look at it and do it, because look where stock is trading now, $150. It does seem like it just climbed. It's in the middle, actually, I would say, of this breakdown here. It probably was an earnings breakdown on November 18th of last year. Big breakdown from about 150 and change to about 120. So about a $30 move to the downside. I'm guessing it was earnings last year, because here we are seeing in August 18th and it's having earnings. So November 18th last year was probably that earnings, probably third quarter earnings or whatever. Nevertheless, it is in the middle of this breakdown, right? So right here, we're looking at about 125, 126 or so. No, sorry, 145. It just eclipsed that the other day. Looks like it possibly has more bullishness to carve out. You could possibly see maybe an upside of around 158 to 160. And then from there, who knows? Then you could possibly be looking at upwards of 165. And so that's how I'm looking at the stock. I don't know what it's going to take to get there, but I do know earnings might be part of that catalyst. So for that reason, we're going with the classic calendar call setup. Now, there's a couple of different things we could have done here. I did analyze looking at selling, say, a put that's a little bit more, a little juicy here, like a $5 put, and maybe buying a call spread, which I could still maybe be talked into. I just didn't love the idea of only selling 37 vol. I know it's a 54 IVR, but a lot of that stems from this earnings front 2 weeks, if you will, volatility, where you see the near term is 98%, expecting a 10-point move, which would get us up to 62 to the upside and 42 to the downside, which again, downside is always possible. You got to think about that. But I didn't want to sell a 37 to buy a nearer term. Like that just doesn't seem even high enough. I don't mind selling that further out to buy a near term call spread. Say I wanted to do, like the 1 150, 160. I could do that for a nice credit, but I didn't really love that. So now I did a bunch of things here, all of them calendar calls, but I'm just going to explain sort of one of them, which is, well, I'll explain kind of two of them. So I sold, the trade of the day is really doing the 165 calls. That's where I started this trade. I kind of messed up. This is what we do when we trade, right? So initially I sold one of these to buy the 165. And that's not messing up. I just, sometimes in a name like this, where it's not really super high implied volatility, like just flat vol, normal vol. When I say normal vol, November is representative of what the type of volatility that target is normally trading in the 30s, I would say, even with the earnings coming up, because you can see everything else is in earnings is affecting it a little bit. Like this, it gets higher. This is 50, this is 60, and obviously this is 98 because this is going to experience the most of the most from the earnings move that we may or may not get, depending, right? And so that's what this vol is inflated for, right? So think about it that this is normally a 30-something vol. So I didn't think about the fact that I could just sell this 165 and buy the September 165. I initially just bought the 28th 165 call, but then I realized, like, you know what? I can actually buy this one too. So I'm telling you all this because initially I sold the 165 to buy the 165. And I did that for like really cheap. I think it was probably about here, 55 cents. You see something like that, and normally you can do a bunch of them. But the thing to think about with these calendar calls, obviously you want the stock to move up towards that price so that the near-term call is effectively close to being worthless. But you also have to think about it from the standpoint of, what if it doesn't move up? Then what happens? What if the stock fades hard? Well, then it's nice to have the ability to have a further out upside call just in case it does rebound, right? Sometimes that does happen, right? I mean, even on, I think, these earnings, the last time around, you saw the stock down here, right, on November 21st, but then it was up about a month later. It was, the stock was trading as low as 121, but then say you had a December expiration call, it ended up getting back to 135, right? So that's exactly the kind of thing that you also can think about in these calendar calls. Sure, I would love for just to be this short 165 versus long this 128. But guess what? I could also go further out. In this case, it's not that much more expensive. So I think it was about 170 or something like that. I think I ended up doing this for. Oh no, hold on. Let's remove this. Let's go sell that. Ultimately, the trade of the day is selling the 165 in the expiration for this week and buying the 165 in September. So selling AUG to buy September. 175 is what I did this for. Now, as you can see, I layered in a couple of other ones because the stock kept moved down lower from where it was at one point today. I originally did this, I think, when stock was higher, probably about 152 or 153. I did it near the open, I think. And but I did that spread. I also eventually did the 160 spread because stock has dropped a little bit today. And then I've also done the 170 spread. And most of those are in September because I think that's going to give me some time, just in case stock doesn't run up the way I wanted to on earnings. I still have some time for this to play out. And like I said, I just felt like this was the cheapest way. Overall, I think I ended up, as a result of this, doing around $600 or so in premium. I'm always thinking about it like that too. When you're doing an earnings play, you want to think about, what if none of this works out? Because it is earnings. And earnings are a crapshoot. So you have no idea. How much premium am I laying out? Well, I have over $100,000 account. So $600 on the earnings premium, I would say was just about right. $500 to $600. Maybe max I'd spend maybe $1,000. That's 1% of the portfolio, but not. Most times I'm usually around $500 to $600 because on an earnings play, $500 to $600 can easily turn into $1,200 to $1,500 depending on how you play it sometimes. So that's how I think about it. I want to get a quick multiple on this $500 to $600. Can I get a double on it? Can I get maybe 2.5 times that amount of money? That's very possible. And so that's how I think about it. So like I said, I was analyzing initially sort of selling a put to buy a near-term spread. And look, that trade is there for those of you who like to buy puts. Say you want to get aggressive and you want to buy a spread like this, you could do that. And it does cost you a little bit of buying power, 2 Gs, right? you could get a $1.43 credit to do that spread. The only thing about that for me is 145 is right here, and we could see that breakdown in that name. I mean, again, that's the low end of the Aug 7th, and honestly, we've been rallying mostly since Aug 7th. Not only this stock, but the market. So you could see some release pressure if this stock doesn't perform right. If it does fade, and we already said expected move is $10, so you could see a $10 move to the downside. And guess what? I don't want to put that trade on now, but that could be my play if the stock does fall. You will hear me say, I'm going out to October. I am selling this put, and I am buying probably not this call spread because it'll expire, but I will probably sell that put to buy maybe this type of call spread. Or honestly, if it falls lower to 145, then I'm going to buy the spread like this, maybe in the August 28th or maybe the step 4 expiration. But that being said, the real trade of the day is the ones. Excuse me, the 165 call calendar. Paid $1.75. The most I can lose is $1.75 or $175, right? The max is interesting in that, and I'm talking so much, I didn't show you some of that how that works, but you can adjust the analysis. And Mike is actually going to show you this because he has a similar type trade in a different name. But you can adjust the analysis for your sort of expectations of vol collapsing and whatever expirations you're using, and then how it would look like as the stock moves up, which is the most interesting part, right? Like if it moves way out of the money to the downside or way out of the money to the upside, you lose what you paid and there's no interesting part. But if it slowly moves towards your strike, that's where things get interesting. Vol will collapse big time in the near term. Vol will stay mostly the same in September. It won't go down too very much. And that's the beauty of the trade, especially if it's moving towards that 165 strike. So that's my trade of the day, a target 165 call calendar. Now I'm going to get you over to Mike for his trade of the day.
What's up, everyone? Mike here with another trade idea for you. And I'm going right back to the well. Yesterday, had a Home Depot call calendar spread. Had a crazy morning. It opened at 8:30 up like $3-4 and then immediately sold off $6-7 right on the open, and then rallied all the way back to be net up $1.50, which is where it's at right now. I had a call calendar spread at the 350 strike. I bought back the weekly option that expires on Friday. It basically lost all of its value on that intra-morning, intraday sell-off. Rolled it out to a 360 call diagonal spread. So I bought back the 350 call in the 3-day, rolled it out to the 360 call in the 31-day, which is something that I talked about yesterday as a defensive mechanic. If we get an inside down move, I'll be able to just buy back the weekly for basically nothing and roll it out to a diagonal spread in September. That's another reason why I went out to October for that long option, to give myself that ability to continue to hedge if I needed to do so. And it was a crazy morning. We got the rally back, so it's net profitable right now by 50 cents, but just to give you a heads up, rolled to a diagonal spread. I've got the 350 long October, 360 short September now, and that is where we stand. If you wanted to close it, you can book a small winner there, but I'm going to hold on to this thing with Home Depot rallying back pretty much immediately. So Lowe's is in the same ballpark, of course. Home Depot and Lowe's, very similar business models, different product offerings within the brick and mortar stores there, but $2.50 of a rally today, up 1%. And we still have a $9 implied move for the next 3 days. They report earnings tomorrow morning before the open. So this is an earnings trade that you have to place today before the market closes if you're trying to play for the earnings announcement tomorrow morning. But 9 points of an implied move on a $218 stock. That's about 5% of the notional value, which is on the lower end of the range. But I'm expecting a similar result in Lowe's that we've seen in Home Depot. When you look at Lowe's and Home Depot, when you compare them side by side on a chart and you look at the year-to-date gains, these have been moving pretty similarly. And you can see this here. If we zoom out to year-to-date, 2026 to now, they moved in lockstep all the way through from a percentage standpoint, all the way through the end of May, beginning of June. And then you saw Home Depot pick up a little bit of steam, only down 1% relative to Lowe's, down 11%. So maybe there's an inside move there priced in. Maybe you get a little rally back to kind of match where Home Depot is, at least right now. Or maybe you see lows drop like a rock since it's down relative to Home Depot. So we'll see after the close, but I'm keeping this trade really small and defined risk. Very similar to the Home Depot analysis, I think it's super important to look at the implied volatility of lows and see where it's been throughout the year. So this implied volatility chart that I've got overlaid on the bottom end of the screen, you can add this if you just go to indicators and then type in implied volatility. You can add this on there. You can change the color, but that's about it. This is just a chart of implied volatility, the 30-day IV index implied volatility, which you can find in the overview tab of lows, 35% IV index. That's basically just an aggregate of where you're at around that 30-day mark. So you can see we're sitting at 35 right now. And then if you go to the trade page and you look at the 30-day implied volatility, there you have it, 35%. So basically just charting a change in the 30-day implied volatility for lows. And we can see here that we've had a pretty decent range of implied volatility. If we look year to date, hit a low right at the beginning of the year, end of last year actually. Beginning of this year, low was like 25% implied volatility. We got as high as 38%, and now we're sitting at 35. So when I look at this and I look at the end of the bottom of the range for the year, I would say, okay, I'd be surprised if we get lows below the low implied volatility of this year, which is about 25%. So that's where I'm going to put my baseline when I look at a really conservative analysis is, what if we get a vol crush that brings us back down to the annual lows of implied volatility for lows? That's what we're going to look at. 32% in October. So that would be about a 7 percentage point collapse in October when we look at the theoretical risk analysis. But I think if you're playing implied volatility trades or you're trading strategies that rely on implied volatility crushes, you should absolutely have this implied volatility graph on your charts so you can not only see where the highs and lows are for the year, which create your IV rank of 100 and IV rank of 0 respectively, but what is the actual range of implied volatility? Because Vega, the rate of change of an options price given a 1% change in implied volatility, Vega doesn't mean much if your range is only 2 percentage points between an IV rank of 100 and an IV rank of 0. So this range is pretty narrow here, which is good for this strategy because I'm expecting less of a vol crush in this October cycle since the lowest we've seen is 25%, which makes me believe that we'll probably see a lesser vol crush, all things considered. So maybe we see 32.5 go down to 30 or 29 or 28, but it would be a really aggressive vol crush if we went down to the 25% low that we've seen this year. So let's pull up the risk graph here and we can take a look. So the trade that I've got on, again, is the 230 strike calendar spread. So I went to the expected move in the weekly cycle, right at the expected move, just outside of it, picked up $1 and change, and then I went out to October and I bought the 230 right inside the expected move for about $700. So this is another cheap trade, $5 risk basically, right around there. I got filled at, $5.29. It's up a little bit right now with lows having an intraday rally, but really just looking to capture $1.60 of this value in the 3-day cycle. Paid $700 in the October cycle, but because my basis is $5, I can do the same thing that I did in Home Depot this morning. If we get a sell-off in lows, I could buy back the 230, roll it out to September, sell the 240 for $1 or close to $1 if it's slightly under it, and just leg into a 10-point wide diagonal spread with a cost basis of $5 or maybe $4 in change. So that would be the defensive plan if we get a sell-off, but hoping that we get a rally similar to what we saw in Home Depot. This 8:30, right on the 8:30 Central morning open was kind of wild. Got that weird move that quickly reversed. But just looking at this trade, we can walk through the theoretical analysis here. So if we flip over to Theo and then we evaluate at tomorrow's date, we'll have to adjust implied volatility in the 3-day. So let's crush this down to like 35%. I think that's pretty fair. Bringing it down to where we're at already in the monthly cycle, that would be a 28% vol crush in the near-term cycle. And then, like I said, if we bring down the October cycle to 30.5 or 29.5, we could be looking at a $300 winner if we get that vol crush in the 3-day, we get the vol crush in the 60-day, and we get a rally towards 230. So could be a great return on capital trade. Of course, as calendar spreads can be if you get that rally and the vol crush in the near-term cycle. But like I said, what if we bring this down to 25%? 7% vol crush. This is the low print of the year in lows. So this would bring us to like an Ivy rank of 0, which would be wild. But even if that does happen, we are still looking at about $170 theoretical profit if we get a rally to 230 tomorrow and we crush this implied volatility in the 3-day cycle. But what if we look at the end of the week? So end of the week, 8/21, that is when this short option expires. So we don't need to adjust implied volatility here at all because this just assumes that we get all that value in the short option. But if we crush implied volatility just a little bit in the long option, the October cycle, if we get a 3% collapse bringing us into the high 20s, this could be a $400 winner max profit from a theoretical standpoint. But if we get a bigger vol crush, of course, that's going to result in lesser profitability. But again, 25% is the low of lows implied volatility of the year. Still, we're looking at a $300 net winner overall. So I like the way that this sets up. Similar to Home Depot, looking for an inside up move here. And we're going to get a vol crush in October, but hopefully it's not down to 25%. I really don't think it will be because I think if we were going to get a big vol crush like that, we would already see it priced down in these longer term cycles, March, June, January 2028. I think we would see these in the 20s, which we're not seeing right now. We're seeing everything kind of flatlined at that 33%. So hopefully we only get a 3-4% crush down to the high 20s or 30%, somewhere around there. That would be great for this trade because it just means that I'm holding on to extrinsic value in the October cycle, still getting that decimation of extrinsic value in the 3-day cycle. So another thing we can consider is if we get a rally. This just happened in Amazon to me where I had a trade like this, a crab trade that has risk on both sides. We gapped higher and I basically forced a credit in Amazon by widening the spread that I already had. This one would be a little more difficult because I have a calendar spread on. I don't have any intrinsic value potential. So this is just a pure extrinsic value trade, which is why the cost is so low on a trade like this. If I had a diagonal spread, which is what I was actually looking at earlier, was buying the 220 and selling the 230 in the 3-day, and then buying the 220 in October. But this was trading for $1,000. I didn't feel like I needed to have all of this risk on for a Lowe's earnings play. But even still, if you wanted to be a little more aggressive and you had a bullish or even bearish standpoint on this product, you can do the same sort of thing to the downside. But looking at the implied volatility, we'll do the same thing. If we get a 28% crush tomorrow in the 3-day cycle, and then we get a 3-4% crush in the October cycle, if we get a rally up to 230, you could be looking at $300. So similar risk profile, but this one has no upside risk since you're paying $950 on a 10-point wide diagonal spread. Anytime you're paying under the width of the spread, you have no risk to the upside. So that is the analysis for the 19th. If we kick it to the end of the week, of course, you're going to see a much better max profit here. And again, if we move this to 3%, 2% down in October, if we get a rally to 230, you could be looking at a $600 winner here. But if we're at the mercy of a big vol crush, 7%, bringing us down to 25% in October, this is only going to be a $300-400 winner to the upside in terms of max profit because we're going to lose a lot of that extrinsic value in the long option. So plenty of ways to create some analysis brackets around this. But from the calendar spread standpoint, if we get a rally to the upside, my hands, especially if we get a gap higher, if this thing goes from 218 to like 250, first of all, it's not projected that that's going to happen. If we get that kind of move, that'd be a 30-point implied move, which would be a 3 standard deviation move to the upside. So I'm not expecting it, but if it does happen, what can I do? So what I could do is I'd have this in the money call. My short call or my long call is out in October. What I could do is just roll out the short call. I can't really take on more risk here by moving the short call up. I wouldn't want to anyways, but I could consider just buying back the 3-day at the 230 strike and then rolling out to the 230 strike in September. This would give me a long October, short September calendar spread. And really, if we get a rally to the upside, these options are going to be expensive and have some wider bid-ask spreads because they're going to be in the money, most likely. But we can see what we can get for this roll. Right now, I can get $3 for this roll, which is kind of interesting. But I wouldn't really be able to create like a diagonal spread here and move it up to the 240 for a credit, because I'm going to be giving up some of that intrinsic value in the 230 and moving it to closer to at the money option at 240 if we assume that Lowe's is at 240 tomorrow and a big gap higher. But at the very least, I will be able to roll from the 3-day cycle to September, keep it as a calendar spread, reduce cost basis. I'd probably collect like $1 or something. I'd be shocked if I could collect $2 and change after earnings tomorrow, after the vol crush. But if I am able to roll for $1 or so, I'll just do that. It'll bring me to a 230 calendar spread leaning to the downside, and I'll have, $4 debit cost. But here's the trade of the day: 230 strike calendar, long October, short the 21-day, which is the weekly cycle. 529 debit, max loss is $529. In the money or out of the money, but really out of the money is where you're going to realize that big max loss. Theo max profit near 230 by Friday is about $400. Again, if we get a crush down to 25%, that would be a 7% vol crush in Lowe's. That would bring us to the low end of the year and an IV rank of 0. So I'm not expecting us to get that big of a vol crush in October, which is good for this kind of strategy. As I said, it allows us to maintain a lot of extrinsic value in October, and we still get all that volatility crush and premium crush in that 4-day, regardless of what happens for earnings. But looking for a move towards 230, and we can be profitable tomorrow with a nice vol crush in the 3-day. We'll be more profitable by Friday if I hold it until then. But really, seriously, I'll just close it if we get a rally in Lowe's from 218 to 220 or 230. So that is the trade of the day. Did a similar thing in Home Depot, rolled it out, just kept it calendarized, the Home Depot one I made a diagonal spread. Sorry about that. But at the end of the day, those are the things we can do if we get a sell-off in Lowe's. If we get a sell-off in Lowe's and I can buy back the 230 in the weekly and move it up to the 240 in September for $1, I'll definitely do that, because I'd rather just get myself into a higher max profit scenario. But didn't want to do that with a diagonal spread, at least right now, with the weekly cycle. But that's it for my trade of the day. We're going to kick it over to E for the next one right now.
What's going on, guys? Welcome back to another trade of the day idea. I know we've put on quite a few of these now. We started racking up a lot more trades inside the overall portfolio. We did a lot of management today, given the directional move that we had seen in the market. Volatility is still sitting pretty low. We've caught a little bit of a bid, but with that being said, let's go ahead and jump into the Tasty platform. Look at this trade of the day idea of the day, trade idea of the day idea. But we can jump into the Tasty platform and take a look at some of these other positions that we have on. Just a quick update for anybody that's just joining us. We did end up taking off our INTC put today with the directional move to the downside that we had seen in the broader market, but also specifically these memory names. And this one's really nice because another trade of the day idea that we have done was the trade in Micron, where we had sold an out of the money call spread there, getting on a little bit more short delta. Once we saw more movement to the upside, that made INTC now more attractive. Very similar to how we were looking at SNDK, right? Because we were already short bias on a lot of these names. So the more momentum that we had seen off this rally on the backside of this move, the more attractive a short opportunity was looking. So now that we're selling back off in a lot of these names, we took advantage of taking off the INTC put, which was more of a directional trade that we were looking for, because this is what we had paid a debit for. So any type of directional move in our direction, we were looking to take that one off pretty quickly. So that one can now finance a little bit of the Micron trade that we do have on. We sold the 925 strike on Micron. We have 3 days left to expiration. It's going to be coming down to the wire here if we can get these ones out of the money as we come to a close here. But even if we have to assume a max loss on Micron, at least we were able to snag 150 out of INTC to finance that one a little bit. Given the volatility we've seen in these names, this trade is going to be a little bit different. I wanted to look at SanDisk. We could do Micron. We could do INTC again. But I wanted to look at SanDisk because I wanted to get on a little bit more short delta, right? I was saying yesterday, I made the comment yesterday how yesterday seemed to be a lot more of an attractive day to get on some short delta. We got the gap down. We got the continuation post market open today. but I want to get on a little bit of long delta here. But I'm still overall bearish in these names, if that makes sense. Because if we end up getting the pop to the upside, if we get these same price levels around 1,700, around 1,800 again on SanDisk, that's when I'm going to look to then sell the call spread. So depending on how this plays out will determine how we will manage this trade moving forward. So again, with that being said, I was thinking about doing like a skewed iron condor to the downside. We'll see what we can collect on order entry there. If not, we'll get on the put side by itself and then maybe leg into it if we do get the pop over the next few days to then get that call side on. So let's just start at the September 18th expiration, 31 days till expiration. These are all going to be $10 wide, so a little bit of a larger trade here. And if we just start with the 1540s and 1530s, that's going to give us about 465. That's a lot of credit for a vertical spread. That's almost 50% of the width. So we're actually going to go a little bit further out, and that's really a testament to how volatile, right, these names are right now. If we look at 1450, 4060, that's going to give us about $3.75 worth of credit, which is starting to become a little bit more attractive, right? About $630 worth of buying power. Max profit is up a little bit more because it is a $10 wide. 62% pop, 70% P50. So this is lining up pretty solid for the overall portfolio so far. Again, this is the one where I then want to start catching a falling knife on a lot of these memory names. But if we get a pop back to the upside, I'm not going to be complaining. And the fact that we already have some shorts on in Micron, I don't mind this potential trade. IP rank right now on SanDisk sitting at about 32. We got about 12.2 million shares traded on the day. So we're going to keep an eye on this. If we get any type of pop, that'll be really nice. But we're also not going to hesitate once again to getting on the call side of this trade. If we do get the pop, right? So now the portfolio is a little bit more balanced. We were heavily leaning short in pretty much most names. I think the only long delta we really had on was in TLT. And it's like, of course, the one position where we have on long delta, we've just been stair-stepping lower. TLT catching a little bit of a bid on the day. But over the last few days, we've been making lower lows with no potential bottom in sight in these bonds. But it's the bonds. Bonds can't go to zero, right? So with that being said, we sent through the SanDisk trade. We still have on the out-of-the-money call spread on SMH, which is going to be that semiconductor ETF. QQQ, we took off the out-of-the-money call spread. That was another trade of the day idea that we had put on a couple weeks ago. That was 3 days left to expiration. We could have milked it a little bit more. We ended up taking it off for about 50% of the credit that we received on that trade. And we could have milked it a little bit more, but given the volatility we're seeing right now in the market, VIX is still trading at around 15, 16 right now. But if the market were to have any type of retracement back to the upside within the next few days, then it would have been very likely that this out-of-the-money call spread that just came out of the money would have been back in the money by the end of this week. So I didn't want to take the risk for that. Ended up taking about 50% of the credit received on that trade, and then also taking off that put that we had purchased yesterday for trade of the day. And then today, of course, getting on more long delta in SanDisk. Given the sell-off we've seen, again, I'm still pretty bearish. Like, this is even an uncomfortable trade to put on for myself. But I would love another potential opportunity to get on more short delta here. But I'm going to take the long side for now, since we're seeing some volatility to the downside today. So we'll see how that pans out. It is $10 wide. We did collect a little bit more of our credit, so that's always nice. But again, these are some extremely volatile names. I mean, even Micron, right? I think SanDisk is the highest priced one. But I mean, even Micron, right? We're up like $200 on the day in Micron. I mean, we were sitting well into the profit just 2-3 days ago. I know it's coming down to the wire, right? In Micron, these expire in about 3 days, so you really have that gamma risk, right? As we get closer to expiration there, but really just emphasizing the volatility in a lot of these names. Things can change very quickly, which I think presses us to make more decisive decisions in terms of, number one, how much time you want on these contracts and how we're going to be managing them throughout the duration of this trade. So we'll keep an eye on that. A little bit more long delta on in SanDisk. We still have the short delta on in Micron. Also within SanDisk, this is 31 days to expiration. So the Micron trade is 3 days left to expiration. So even if we continue to sell off a little bit more, we'll still have a little bit more flexibility in the SanDisk trade. But again, Micron's coming to a close here. And at this point, even if we closed Micron right now, where we're down just $100, that's a win because the max loss on this trade is going to be about $320, if I'm not mistaken. We collected about $1.78 on order entry. We'll round that to $1.80. Got about $320 worth of risk since we collected about $1.80 on that $5 wide spread. So again, even taking this position off here would be a massive W given, where the overall trade has been. And then Microsoft is another one that we had taken off today. This one was doing pretty well. We took this one off at break even today. I wish I would have been holding this one a little bit longer. I think we could have maybe milked an extra, $3 out of it. No, but I mean, we took this one off today too, again, given the weakness we've seen in the broader market and just using today as a day to manage trades, right? I know we've had a lot of inside days over the last 7 to 14 days. So whenever the market gives us a pronounced move in either direction, we can finally start making some adjustment decisions there. And I assume everybody watching right now and everybody in chat for the most part is selling premium. So those choppy days, those range-bound markets that we've seen the last couple of weeks, if anything, most likely helped the positioning in the portfolio for you. And if you had any short delta on, right, given the inside days that we had seen, today is probably another window of opportunity to manage a lot of those trades. And again, because this directional move came on a Tuesday, we still have Wednesday. The rest of today, we still have Wednesday. We have Thursday. We have Friday. Will the sell-off continue? I mean, it could, right? It absolutely could. But I mean, how long is the overall market going to sustain that downwards momentum before we get a relief pop? So the fact that a lot of those contracts are expiring by the end of this week, and we still have so much more trading to go this week, I don't think I trust sitting in too heavily into a lot of those short deltas that we have in the overall portfolio. Here we're looking at QQQ. We're on the hourly chart. You can see this gap down from last night, from about 729, the low of yesterday, to the high today at about 722. Right? I mean, we opened up this morning at about 720. So I mean, that's a pretty big move overnight. So don't doubt if we get any type of volatility in the opposing direction. But I am liking how things are looking right now. I haven't done anything in the S&P 500 or SPY or SPX, still trading at the highs there. I find that trading near highs is very difficult to do to the short side. So that's why QQQ was more so the chosen product. Even though I trade this one on a regular basis anyways, it's a little bit more easy to trade because we do have previous highs. But trading a product where there's no ceiling in sight, I mean, you're pretty much in straight price discovery mode. I think it can be really difficult to gain any level of conviction off those trades unless we're just kind of getting long into pullbacks near all-time highs. But with that being said, that's going to be the trade of the day. We got SanDisk. Did a lot of management today in a lot of these trades. App 11 is another one that I've been catching a falling knife on. We're down a little bit more again on the day today. We've seen a little bit of a bid over the last couple of days, but we're going to have to keep a keen eye on this one just because it is $10 wide. We're down about $35 on the overall trade. And honestly, I'm just not super fond of this position, but I have to let the probabilities do its job since this trade is already on, because any level of consolidation at this point, even if we don't even get the bounce that we're looking for, if we can at least hold this for the next 10 days, we'll be able to take advantage of that theta decay, take the trade off, maybe redeploy the capital elsewhere. We have some options there. Sometimes it can be difficult to be patient on these trades when we haven't gone anywhere. I remember, getting on my first options on the Where Do I Start series. I remember putting on some directional trades, getting the move that I was looking for, and then nothing happened. I'm like, why is this P&L not moving? Right? That was when I was a little bit more naive to options, not understanding that we need a little bit more time to pass, right? Get that extrinsic value sucked out of those contracts. So we'll be patient on App 11. Speaking of Apple, 31 days left to expiration. We're seeing a little bit more of a bid in Apple today, but the short bias remains. Again, maybe we get a little bit of consolidation. We're essentially just trading or betting the fact that this momentum is going to slow down because we did sell the out of the money call spread. So we have that little cushion that's kind of built into the trade there. And even though we're getting a pop on the day, we're up about $1 on the overall position. So we'll be patient there. We'll let theta kind of do its job and go to work there. But outside of that, again, it is nice to see more directionality in the overall market. We ended up taking a couple of micro NASDAQ trades today, which we were able to accumulate about $140 worth of profit, which again is really nice because then we can use a profit from a lot of those scalps to, number one, to finance some of the trades of the days that we're doing. Trades of the days, I can't even get it. Trade ideas of the days, and just really finance some of those other swing positions. So by scalping at the same time, it really does relieve a lot of that emotional pressure internally. And then on top of that, it makes it easier to continue to pull the trigger whenever there's another way that you're kind of able to finance one trade with another trade. So that's going to also be top of mind for myself. Just taking a quick look at the micro NASDAQ market. We're trying to rally off the lows here. This is TOT. Let's go to the real NASDAQ. Well, it's nice that bonds are trying to rally off of the lows. It looks very similar to the NASDAQ price action today that we've seen. We put in a low at around 29,514 today on NASDAQ. Is the day high going to be in question? I'm really not too sure. This is one that I actually don't have too much of a directional opinion on, given where we're currently trading. But I do know that morning high is sitting at around 29,769, day low sitting at 29,514. As you can see, we're pretty much directly in the middle of that range. From an auction market theory perspective, we are trading in the middle of two value areas currently, but we have achieved, in terms of a directional standpoint, we've already made it to our next level of value. Now we're kind of bouncing off of that level. But before I take any trade, I got to see the market clear out one of these ranges. This is where the market can get really choppy, especially off of directional moves. So I'd really pay attention to that swing high and that swing low before the market gives us any type of new information. I think this is a type of range where the market can really try and chop you up, essentially. So I know for myself, when it comes down to the micro NASDAQ, until one of these swing points have been hit, then we'll keep a closer eye on what we might want to do in these markets. But with that being said, if you are just joining us, we did a lot of management today. We put on an out-of-the-money put spread on it in SanDisk. Maybe we get a continued slide to the downside. We are still bearish overall in these memory names. I just want to emphasize that. But if we do get a pop to the upside, we'll then look to sell the call side of this trade. But it is $10 wide. We collected about $3.45. So a little bit more than a third of that width of the spread. It is a larger trade, right? It's $10 wide. So we're going to keep an eye on it. This isn't going to be something that we're going to assume the entire max loss, right? Because the max loss on this trade is about $750. We're not giving up $750, not relative to the other size trades that we typically put on in the portfolio, right? It's like, I'm comfortable with risking $750 if the rest of the trades in the portfolio are near the same size, but that's not the case. And then if you did miss it today, we ended up getting out of our oil trade. This is one we had gotten long 74.33. And we had gotten out of this one. Where did we get out of this one? We got out of this one 85.65. So I didn't want to sit in any of this consolidation. Maybe we get a continuation to the upside. Maybe we finally get a pullback in oil, but we're out of that one. Trade of the day is going to be SanDisk. Got on a little bit more long delta in those memory names. We are coming to a close here. We do have Chris on the other side of this. So we're going to get his thoughts on the market, get his trades of the day. Appreciate you guys hanging out for a little bit, and we'll throw it on over to Chris.
Welcome back. Trade of the day today. Crude oil futures, CLV6 contract sitting out at 30 days to expiration. This is a market where we've seen a little bit of just upward slow price pressure in recent weeks. There's been a lot of talk around the Iran war headlines. Today, the Memorandum of Understanding officially expired. Trump's threatening to go back to war. Iran saying we're going to have a more offensive stance moving forward. Where's the volatility in this market coming in? Where's the craziness? As long as the ships are moving at a low level, oil can keep squeezing higher. But without bombs falling and there being a material escalation here henceforth, oil probably isn't going to jump to the upside, at least in the very short term. So here's the trade today. Putting on the 30 days to expiration right now, 72.73, 92.93 short iron condor. So let's just take a step back and look at this chart for a quick second. The most recent swing low here, which some technicians might define as a morning star candlestick cluster, given this trifecta of candles here, it marked the bottom. No matter how you defined it, it marked the bottom here. And so that low comes in around $73.10. $73.10. Okay, so let's just go 73, 72, $1 wide. 12 cents of credit alone is not enough to play that swing low. And more importantly, we're so far removed from it. It's not something we want to do right now on its own anyway. Selling a put spread into the support is a different story, and maybe we get to a third of the width of the credit if that was the case. But here at 12 cents on a $1 wide strike, that's not a third of the width of the credit. That's actually closer to a third of the width of the credit. So can't be done on its own. which is why I go back to these charts. And I look at the recent highs here, sitting up near 91, 91 and a quarter or so. And I put my short strike for the short call spread side right on the other side here at 92.93. And again, 92.93, you're only receiving 18 or 19 cents of credit on it. So it's not exactly a great trade unto itself. But when you combine these two together, all of a sudden you're taking in 31 cents of credit here, which is just shy of that 33 cents that we like, but it's close enough. It's in the ballpark. And so for me, it's worth taking a trade here. We need this to work or stay between 73 and 92 to effectively work out here. Why crude? Why now? I mean, for folks who have just started trading, you may be asking yourself, why do people even trade crude? I realize we don't even do this that often. Maybe we talk about why crude's so important. It sits at the intersection of everything: growth, inflation, inventories, currency pricing. Name something out of it. It's going to show up in everywhere. Petroleum is something that filters into basically everything. Are you wearing something with like polyester or nylon right now in your clothing? Are you wearing rubber-soled shoes? Does your car have tires? Did you walk on a road with asphalt in it? I mean, just, do you use petroleum jelly at home when like your lips are chapped, right? And you go out into a winter's breeze? You're using all that stuff as a byproduct of oil right now. So when we talk about what's happening here in the oil market, this is WTI CL is benchmark exposure to WTI crude. On the platform, you could see BZ, which is the global benchmark Brent oil. However, there are no BZ options. So to do this, we have to go into CLV6. You could also go into a number of the ETFs if you'd like to. But 73 short put sits below the market. Obviously, the 92 short call sits above the market. We're effectively selling both tails here, right? The trade idea is built around the idea that oil is going to continue to chop around, at least in the very short term. Longer term, we can have a different conversation about how oil looks like it's building for a much more substantial breakout here. I know that a lot of folks don't love when I do this with putting these patterns up on the chart, the inverse head and shoulders at highs, but they do work out from time to time again. And technical analysis is more art than science. So who is anyone to disagree? But the point here is this does look like it's something that's building a little bit into a little bit more of a breakout. Where have we seen this chart pattern before? I'm going to head on over to, what am I thinking of right now? Let's take a step back. Let's go to a weekly chart here. IYT, the weekly chart on IYT, right? Similar type of pattern. You're getting this build. You're getting this build here on the chart pattern, left shoulder, head, right shoulder, before it ultimately breaks out and moves higher. On the daily chart for crude, it feels like it's a similar setup right now. Just, how I analyze these markets and my memory of these charts work out. So crude is not something, if this thing starts to move higher, I want to play with. In fact, I probably want to go something a little bit deeper in time, farther out of the money, maybe looking at like 9,500, 105 strikes in oil, which at 21.6 IVR and raw volatility at the, we'll call it 58 days to expiration, only a 50% IV. Getting something like a long 100, short 105 call spread here has a lot of convexity to it, and I'm willing to pay 48 cents to effectuate that kind of view. But we're going to try to thread the needle here a little bit first. Mechanically, the iron condor is short to credit spreads, right? The put spread side 73, 72. The short put spread side, we sell the 73 put, we're buying back the 72. That's how it gets paid if CLV6 stays above 73. And the call spread is set 92.93. We sell the 92 call, buy the 93. We get paid if CLV6 stays below 92 right now. And so with them, we have a range trade here. We don't want this market to break out to new highs. We definitely don't want it to break into new lows here. So at 31 cents, the max credit received is 310. The max risk is $1,000 minus the $310 credit here. So that's 690 before fees and slippage. The lower break even in this is the short put minus the credit here. So 73 minus 31 cents would give you about 72.69. On the other side, a short call strike minus the credit received. So 92 plus 31, that's 92.31. So, okay, our best zone is going to be 73 to 92, the lower break even of 72.69, the upper break even of 92.31. And that's the options math here. So one of the points that Mike Butler has been raising here on air in recent sessions has been why USO is an interesting product to trade, because it is a product, a fund that is buying oil futures, selling oil futures, and using the differential in the contracts that really determines how much money the fund is able to make in excess of what's happening in oil or, well, underperforming oil here. So the first thing that you need to understand about oil, if you're trading this as a new trader, right? If you're one of those folks who's a SPY 0 DTE and you're looking to expand your menu of options, the type of arrows that you keep in your quiver here, oil is physical, right? This is a physical market. It's not just a chart. It's not just based on financials. It's not just based on people's feelings or expected cash flows. There's a physical product here. It has to be produced. It has to be transported. It has to be refined, stored, shipped, consumed at a point in time. So if there's too much oil being produced and not enough consumption, oil prices go down. If there's too much consumption and not enough production, oil prices go up. But if the S&P 500 gets oversupplied, so to speak, a lot of people are willing to, write calls and puts in the market, synthetically create more volume. No one's renting a tank to put all the extra supply out there. You have to have physical tank space in this market in order to store actual barrels here. So if crude gets tight, somebody needs barrels now, right? You're going to consume your energy today. You're not going to do it, far out in the future. And the curve tells you how the market is pricing oil into the future, right? I want to be clear. These future quotes that you're seeing here, what we're seeing for the CLZ6, CLG7, CLH7, these are not predictors of where price will be in the future. There's no guarantee that come the December 16th expiry, oil is going to be at 79.86. What it indicates is about how the market is feeling about supply and demand. So you'll hear this conversation about contango backwardation. Market right now is in backwardation. The current spot price is trading above the next month futures price, and et cetera, as you go further out in time. Contango is when the front month, the spot price is below that front month price. Okay. And so what we have here in the oil market is you have backwardation, however, so slight, about $2, a little less than that, actually, about $1.30 or so between the V6 and the X6 contract. During the Iran war at its peak, this was going out to about $15 wide. Traders were so desperate, right? Companies, businesses, countries so desperate to secure oil, they were willing to pay a premium to secure supplies now and not wait into the future. As the war has ebbed and flowed, this backwardation has shrunk from about $15 now down to 1, 2, 3 on occasions. But when we've seen the war escalate, we've seen this spread between the front and the next month contract blow out. So this is going to be one of the tells, by the way, if oil prices keep moving up here in the very short term, if we start seeing an 85, an 86, and 87, and we see that this spread begins to widen out some more, it's a sign that the market is beginning to bet on a little bit more near-term supply distress. And that could be a sign that the war is getting ready to escalate. And you can think about the implications for that across a number of other assets. But if we see the spread stay low and oil is just kind of grinding up, but the spread is not blowing out here and the back end of the curve is not moving up substantially, gives you a feeling that maybe this thing is going to peter out at some point in time. So what are we going to do with all this information here? Right now, if this position starts to get challenged, if we start to see prices break above 88, for example, I see recent swing highs cleared out, I start think inverse head and shoulders pattern here. I don't need to wait around for this trade to go into the dirt in order to turn a profit. If we start pressing, 87, 88, 89, and it's the middle of this week, it's the end of this week, I'm not going to wait for the 92, 93 call spread side to crap out. I may just take this trade off and flip my position into something that is just simply long oil. MCL could be a good product for that, right? MCL is a tenth the size of CL. So CL, it's big. Every dollar move in oil futures is a $1,000. Every single 1 cent tick is $10 here. So trading a naked CL, just trading the CL futures, not what I want to do, more importantly, because it's too big, but moreover, not necessarily something that the average retail trader does here. So in terms of modeling, this is where MCL comes in. Micro WTI crude futures here on the platform is MCL, and automatically you're out to the V6. Same chart you see here. 1/10 the size of CL. MCL controls 100 barrels. A $1 move is $100. A 1 cent move is $1. So same basic crude exposure, a smaller notional footprint. And then there's also QM, which is a newer product in the crude family here. And if you go to QM, you will not see any options on the trade. But right now, it sits between them at 500 barrels in this particular contract. So $1 move is $500. It can work for traders who want more size than MCL, but not as much as CL itself. There are some products out there in the world like BZ, for example, which is the global benchmark, but there are no options here. So you'd have to trade it outright. And if CL is too big of a product for you, then BZ is going to be as well. There are a few refined oil or energy products, I should say. There's RB for gasoline, which again does not have those options, but perhaps something useful to keep an eye on. You could always go over to a refiner if you wanted to get a proxy here for gasoline. There's Crack the Refiners ETF. There's also names like PSX or Marathon Petroleum or Valero. As an example, these aren't the most liquid stocks in the world, right? Less than 1 million contracts traded in Valero, just over 1 million in Phillips, just under 1 million here in Marathon. The options chain's just 31 days out. Close to at the money at 364. You're still looking at near $1 wide in MPC. Okay, so perhaps not the cleanest way to do it unless you're a long-term holder, because the shorter term you are, the more you have to take into consideration those transaction costs, the slippage, fees, et cetera. You can't afford going 50, 60, 70 cents wide on a bid-ask may not be for you. There's also heating oil, which we mentioned here. Heating oil, like these others, does not have any options available on the platform, but again, something to watch, especially if you're a consumer, right? Hey, heating oil is going up before the winter, folks. That's not going to be great. There's also natural gas, which we could mention here. It's its own beast. We call it the honey badger around here. It does whatever it wants, whenever it wants. Try to apply a standard supply demand model here. Can't really do it. So a lot of it's on sentiment. A lot of it's based on positioning. It's known as the Widowmaker for a number of reasons, particularly that March-April spread. If you want to learn more about trading natural gas before you do, and you want to learn about risk management, in fact, go look up the story of Amaranth Capital and Brian Hunter. This is a fund that went bust in the 2000s. Brian Hunter was martingaling his way through natural gas futures, which martingaling itself is a pretty dumb idea, unless you don't have unlimited capital, right? And so in theory, unless you have unlimited capital, you're going to go, I guess you could make it back, but no one has unlimited capital. So martingaling through natural gas futures is just bonkers. Go check that out. Brian Hunter at Amaranth Capital and how he destroyed his fund with NG. But either way here, I just wanted to run through some of the energy futures, energy products for some folks. Only one idea today right now. It's a CL position in CLV6, the 72.73, 92.93. Iron Condor right now collecting around 31 cents in credit. So making 310, risking potential 690 there. About a 60% probability of profit as well, paying out a little bit better than 2-to-1. So it checks enough boxes here. But if crude oil in the CLV6 starts to break through 88, take whatever loss there is on the board, I'm going to be flipping to a long position here. And at that point in time, regardless of what's going on in the Iran war, oil is a physical market. And if the ships aren't flowing through the Strait of Hormuz, Houston, we have a problem. That's my trade of the day. We're going to take a brief break. We're flipping it over to Ilya Spivak here for his coming up next on Tasty Live.
Check in on the trades that we have been putting on here. And we'll start with gold. We, of course, have been looking for gold to carve out something of a bottom here. And it looks like at this point, the move is playing out largely as expected. Here was our initial breakout right at this consolidation that held up through July. We put our first leg on when this broke out right here. Of course, what made this especially remarkable and really a sign of strength across the precious metals complex. Silver, by the way, very much the same story. Here was July's consolidation. Here was the break higher. Here's where we sit as we consolidate subsequent moves here. Now, note, here was the underside of a very similar range in silver, break and hold. And what made this so remarkable, as we've discussed, is this slide in real or inflation-adjusted bonds and, of course, the parallel jump in yields. So here's that jump in yields right here. This is the beginning of July, and we can see that over the course of this, a further 3% rise in this basket of TIPS Treasury inflation protected securities showed a strong rise in real rates. And of course, that should be kryptonite for precious metals, which yield nothing in real terms. So the essence of the trade here was, well, we've got a market that is doing not what you would think given the news flow. And of course, when we say news flow, we don't just mean sort of this headline or that subjectively, but actual market action. So the impetus here from real rates surging ought to be negative for metals and was pointedly not that. And so when we see this kind of stabilization, to borrow a metaphor from Chris Vecchio here, of known renown here at Tasty Live, we've got something like a beach ball underwater type of an effect where if only you were to stop holding it, it would pop higher. And so this seems to be exactly what transpired here. We added to the trade last week when we took out this former support turned resistance. We're consolidating that breakout now, and we're pointedly not backfilling. We're pointedly not falling back through this level. So the breakout seems to be not failing, but coalescing and consolidating these levels. So the next leg higher, one would think, still favors a move in this direction, sort of an interim level here at about just under 4,700, let's call it. And then above that into the 5,000 area. So that continues to be what we sit on here. Of course, the other leg of this same idea was the exposure to the US dollar on the short side, of course, because if we're looking for gold higher, well, then the flip side of that would be a weaker dollar. We added into this a little bit yesterday as the dominant idea that we're looking to get going here for this week, because what seems to be occurring there is something like a breakout. Also, this is the euro, and we're looking at spot here just for smoothness of chart, as it were. Spot charts don't have any kind of exchange closures, and of course, spot is uniquely liquid, more so than derivatives based on it. And so, after all, we're looking at just cash. And so, the overall direction here you can glean cleanly looking at this chart. And as we said yesterday, on the daily, it looks like this range has not given way. But when we look a little bit inward on the time frame, we can see here's a 4-hour. The break above this range right here, if we kind of guesstimate it right there, it's already occurred. And it looks like we're holding the top side of it here, resistance becoming support. So this breakout remains valid. Of course, we were already long the dollar from this breakout here. We added here. Well, today there's another layer in this conversation. And while everybody seems to be screaming loudly and persistently about the surge globally in long-term bond yields, there's been an interesting situation just over the course of the day that has occurred. And we see that in the long rate. And we can see that right here. There's a daily chart of that. Now, what's especially interesting, even if we just take all of these pretty lines off the chart, is the price action itself. So here was the range in which the 30-year was consolidating, and we see we probed through this bottom here and then pointedly held it. Now, this is, of course, a bit of a stretch to say that here we go, we have a confirmed bottom here. But from a risk-reward perspective, this looks interesting because, again, if we look inward a bit, we can see that this was a breakout that appeared to fail. So here's the previous low. We break it, and then we punch back through. You can see it on the 8-hour pretty cleanly as well. And so when we look at this here, I think the more kind of interesting part of this equation is that, first of all, we get a little bit of divergence. So as we set lower lows here that ultimately don't end up taking out the range, momentum is fading, suggesting that maybe there's some kind of a stabilizing or some kind of bottoming that could happen here on confirmation. But secondly, that there is pretty good risk reward to express this trade on the cheap. And so maybe before we get into the FOMC minutes tomorrow, given that what we're watching in gold and the dollar is the unraveling of Fed rate expectations, at the same time that this ostensibly is a story more about not just rates, but the sort of global melt up in yields, that everybody seems to be on one side of this, not unlike the exposure that we've seen in crude oil, where everybody was convinced at the beginning of the year that there was going to be a glut as far as the eye can see, and crude oil started to creep higher. Well, everybody was screaming bloody murder here over the past, let's call it 24 to 48 hours, about how we have a global surge in long rates, and that it's now for the US 30-year at the highest since 2007. And indeed, that was the probe right here. But the situation has been a lot more pronounced in things like in places like Japan, in the UK, in Germany, in Italy, which are ostensibly even more of a debt issue than is the US. And so if, in fact, we do have a debt problem, well, then the US is the cleanest dirty shirt in the pile, because it is still the world's most eligible sovereign borrower. And so what we're looking to do here then is to say, okay, well, the US is different because the US is the US, and because the dollar is the dollar, and it's still the global reserve currency, no matter what one says. So whatever problems we have in the US fiscally, and there are many, the issues are worse elsewhere. So if this is a global move, then there should be a kind of flight to quality here. So what we're looking at from a trade perspective here is to express it in TLT. And if you go out here, you can see what I've done is just a simple call vertical. And if you look at what this looks like, you can see just the most basic call vertical right here. If you price that up, you see the risk reward here is almost 6-1. So you risk a little, but you get an outsized sort of a opportunity. You go 59 days out, so you're very far away from serious delta sensitivity. So if you're wrong by a little, but if you're right, you're asymmetrically right. So if you're going to get this run up in gold, if you're going to get this run up in silver holding, if the sell off in the dollar is holding, if 30-year rates are surging everywhere, because everywhere is a fiscal issue, with the exception of fiscally conservative places like Switzerland, say, well, then you're in a situation where you might get finally something like a turn in the bonds. So makes sense to me. And so that's the trade that I've put on here. It's been a terrible idea to try to pick a bottom in the bond market. But when you get risk reward like this and you can be risk defined, let's try a flyer. Let's see what happens. Let's see if we're going to be wrong quickly or if we are going to get some payback here for taking this risk. And that's the trade for today. Thank you.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click, all on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Pay for backtesting? Nah.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Step into the futures arena with Tasty Trade's active trader. Multiple ladders, hundreds of indicators, precision control. From micro gold to NASDAQ, all CME one click.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets all on one platform. Plus, get advanced tools built for active traders. Visualize potential profit and loss with risk analysis tools. And place trades in a single click, all on the best platform for options trading, according to Investopedia. Tasty Trade. Trade with us.
Every time he explains something to me, I ask him the same question.
He always asks me the same question.
What's the trade?
I'm not always sure that's the right question.
It's the only question. Retail traders don't have a thesis on in their portfolios. They have positions on.
And if you don't know why it's moving, the position is a good guess.
And if you never get to the trade, the reason has no meaning.
Same market.
Different question.
Global markets never sleep. Explore them with Forex, now available on tastytrade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot.
Hello, hello.
Trade it on tastytrade.
Tasty Trade has crypto, and you can trade with zero commissions: Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Step into the futures arena with tastytrade's active trader. Multiple ladders, hundreds of indicators, precision control. From micro gold to NASDAQ, all CME one click.
Good afternoon. I'm Tom Preston and ready to trade on Tuesday afternoon now. Okay, really quickly. Okay, the S&P's SPX is down 0.57%. Not very big on a percentage point, but 44 points down in the SPX. Let's check it real quick. Find a similar company, SPX, and look at these options. I mean, what's the VIX doing right now? The VIX up 52, barely, still in the middle of the 15 handle. Can't even make it to 16. I don't see a whole lot of panic in this market, but right now I have the, let's do a quick little poll. Informal poll. I have the YouTube chat open on the Tasty Live side. Then, by the way, thanks everybody for joining today. Let's go into, go back in and pull that up. Anybody who has any opinion about which way SPX might end up on the day, bullish, bearish? Let's see if we can find a trade. Me, I'm kind of thinking, I don't know. I'm kind of thinking bearish myself. I think we might sell off towards the close. I don't know if, but whatever you guys think. So post that up. Let's go take a look at some other symbols while you guys cogitate on that. So one of the things I pulled up GIS was a General Mills. Why General Mills? I kind of think that if if interest rates are rising, because talking this morning to Chris Vecchio about the lousy housing starts numbers that came out, and that's because of the higher interest rates, or presumably because of the higher interest rates. Could be any number of reasons. You pick and choose your own rationale for why that's the case. But if interest rates are ticking higher, and if even though the probability of a rate hike is lower than it was, a couple of weeks ago at the upcoming FOMC meetings, it's not zero, right? So there's still a decent chance that we get a rate hike. And we could see some weakness in the market. And I'm thinking, do we want to take a look at some defensive stocks? Did a defensive stock trade yesterday in KRE, the banking, the regional banking sector, sold a put spread in there. And I was thinking, what are other defensive stocks? I'm not talking about, missiles and bullets defensive stocks like Lockheed or General Dynamics or anything like that. I mean, if you want to take a conservative position and maybe something that would outperform if the overall market's weaker. So General Mills, what's so attractive about General Mills? I've traded it before. Earnings are coming out on September 18th. September 16th. I'm sorry. Let me zoom in here so we can see it a little bit better. September 16th. What's interesting about General Mills is it has a decent dividend yield, 6.42%. And this is for all the folks who think, yeah, okay, I can collect a little extra alpha on the trade, a little extra return on the trade through dividends. Maybe you're a dividend investor, maybe you're not. But dividends are never a bad thing. Sure, they're taxable, but okay, it's at least you get some profits to tax. That's one way of looking at it. And if you were thinking that, okay, what do people absolutely need? Well, they're still buying food at the store, and a lot of those products are General Mills. So long story short, let's take a look at what the skew might be pointing to. Do we have any? No, I don't want to go out that far. So 3 days, there just isn't enough premium left in these options with 3 days to go. But the IV rank is pretty high, 56%. Let's go to a chart on General Mills. So General Mills, it's been going up a little bit. The volatility has been fairly stable, around 33%. It's not bad. If we go out into these 31-day options, let's see if we can tease out a skew. So if you figure the stock's right in between 37.5 and 40, obviously it's closer to 37.5. Well, let's say we go down a point or down 2.5 points, up 2.5 points. It's pretty even, I think. 25.30 on the 42.5 calls, 25.30 on the 35 puts. I would pull this up to the 37.5s. Yeah, I mean, look, actually, you know what? Yeah, I mean, skews maybe pointed slightly to the downside, maybe. But 37.5 put, here's what you get. You get an 81% probability of making half the max profit. $80 if you sell it at $80, we would offer this at $82. $41 before 31 days. You'd have to be willing to trade through earnings. You have to be willing to do that. Maybe you want to do that, maybe you don't. But 80% of making $41 versus $672 of buying power requirement. That's not bad. That's not a bad return. $1.89. Let's actually run that calculation. What I do is I compare the theta to the amount of money I'm putting in for the trade. So $1.89 divided by 672 is 0.002. So that's 0.28% per day. That's pretty good. That theta return on capital is pretty good. If I get hit on this put, if the stock drops and I get assigned on this put, okay, fine. You know, I buy the stock, I'll sell calls against it, do the wheel strategy or whatever, and I'm collecting the dividend. I'm going to ship this out at 82 cents and see if I get any joy. Filled at 82 cents. All right, that is our General Mills trade. Let's take a look at corn before it closes. Corn. The thing is about corn, I like corn. I like trading grains. I do a fair amount of commodity trading. And the point is, we're starting to see, I saw a couple of stories about the constraints on some of the crops, some of the fears about food shortages related to the Iran war, related to all sorts of stuff. And, you know, if energy prices do tick higher, and I'm not convinced they are necessarily, but we could see some upward pressure on corn. I have this, king corn. Who doesn't love cornflakes? No, you know what my kids, this is kids. Well, I didn't actually know this until I was kind of old myself, I told my kids who are 21 to 23, cream corn doesn't have any cream in it. It's actually the milk of the corn that they squeeze out, and it makes it look like cream. But, you know, school lunches back in the 70s, man, cream corn was a staple. Who doesn't love corn? It's full of whatever, sugar and stuff. It's not good for you, but it's tasty. So down a little bit today. It was down more. Let's look at the skew, 463.50. So here's the deal. So these August options are priced off of the September future, and you got to be aware trading these commodities of the first delivery, those sorts of periods where you start to get into the shift in the front month and all that. It's kind of a pain, and it's not the end of the world if you take delivery of corn, from a future. You wouldn't in this case. I think the first delivery on the September futures is sometime in late August or early September. I can't remember, but it's well past this 3 days. It's well before the 21st, I think. So the point is, if we look at, I was looking at some of these further out, some of the 38 days. Futures trading at 488. Let's take a look at these. These are off the D's future, off of 488, right in between 485 and 490. Go down, let's say $5 or 5 cents, up 5 cents. The skew is pointing to the upside, going from 490 to 495. The calls are 1125. 85 down to 80, puts are 985. Let's see what we get for a put spread. I got some other stuff in here. Let's do close. So I could make the difference between these is what, $250. So yeah, if I have 80 cents versus 250, that's about a third of the width of the strikes. There's no P50 number. That's something I've been agitating the developers to actually fix. Pop is low. I don't believe that. This is going to be about a 67% probability on this trade, probably because it's running off the wrong futures price. Let's bring this down and see what we get. 75. No, I like this one better. So I would be generating 58 cents of theta. I'd have, it doesn't have a lot of delta, not a lot of risk. Max risk is about $162. Max profit, I would expect to make half that at some point in the next 17, 18 days, something like that. So bullish on corn. I'm going to sell these with the stock at 488 or the future at 488. Let's ship it off. See if I get filled at 175. Submit. To get it? No, 175. Submit. Working, pending, working. All right, that's my corn trade. Do we have anything for any opinions on SPX? Yeah, so Jared, thank you. Crops are looking real good here, fam. Just saying. Yeah, that's what I've been hearing too. But I still think there's enough demand out there. And I think as far as, remember, these are global products. And you guys know that. And they're traded all over the place. And so I'm not sure, I'm still bullish here on these grains. Let's see. SPX here, Inferred Market doesn't care what your name is. All right, you know what? I'm going to do a trade anyway. Let's go in. I'm going to get my corn's working. SPX. Let's get into here. Let's go 0 DTEs, 49. Look at that stuff. Let's buy this. Let's do this trade. 240, ship it, $2.40. Been having a fairly good look on bearish trades. And I can handle fill to 240. I can handle a rally in my positions. Let's go back into the watch list. So General Mills, corn, VIX. Let's take a look at the VIX. So VIX is up 57 cents today. Whatever. That's nothing really. It's still cheap, under 16. This is what a chart looks like of the VIX. And, it's still down at the bottom. I'm just, when the VIX gets this cheap, it can go lower. I've seen it go lower. And it didn't rally up enough today to save my little 16-17 put spread that I had expiring today. So thanks for nothing, VIX. Day late and $1 short with that. So here's how I evaluate it. If I want to be bullish on the VIX, where's the future trading at? So what I do is I look for a strike, like the 18 strike, where the calls and puts are relatively even. Okay, click on the buy, click on an order to buy the call. I'm not routing this as a trade. This is informational only. Click on the ask price of the call, the bid price of the put, get that debit. So 19 cents debit. So the future, the September futures trading at 18.19. So 17.5, 17, 16.5, those are all out of the money. Okay, 18.5, 19, those are out of the money calls. It's not based on this 1574. It's not what it's looking. These options are priced off of this future. Okay, so if I were going to do, and part of it is the Greeks. If I were going to buy the 17.5, 18.5, the theta is not minus 47. That's not a bad trade. I'm going to go back in and do another short put spread. If I do this one, buy the 16.5, sell the 17.5, 54 cents. That's not bad. It's more than a third of the width of the strikes. Let's take it down to the 16, 17, 45, 16.5, 15.5, 35 cents. I'm going to do that. I don't like to have too much risk on the, well, let's go 2 points. Who we get? Take a little more risk. And I'm not getting a third of the width with that one with a 2 point. Let's do this one. Buy the 15, sell the 17s. $130 worth of risk. Max profit $70. Again, it's and it does not have negative 75 theta. Ignore that. It's going to have positive theta, but I would expect that to have about a 65 or 70% probability of making 50%. In other words, a 65 or 70 P50 number on that, because I've done this a lot. And I have my own little P50 calculator that I can plug things into. I did not do it for this trade. But the max profit, $70, I would expect to make, 35 off of that in maybe if we get a little bit of a sell-off, maybe. And maybe if the VIX actually moves up. So I'm going to route this. And just as a bullet, this is how I express bullishness in the VIX. Just like Chris and I were talking about earlier, somebody bought these 24 calls in September. I'm not a big, they bought these calls right here, 244,000. And of course, somebody's 265,000 open at the 20s. I don't see this as just speculation. I could be wrong. I don't know. I don't think anybody's saying, I'm going to take a shot on the VIX and buying out of the money calls in that size. Don't see it. I think this is more of a hedge for dealers who are short premium. I'm going to route this 70 cents. Going back to the well. Let us take a look at, go to the watch list here. Oklo. So one of the things I did in yesterday's cherry bomb, my argument for Oklo and my argument for nuclear, and if you're not getting my cherry bombs and cherry picks, go to our newsletter, go to tastylive newsletters, news and insights, and sign up for the newsletters. Put your email address or get those cherry bombs I send out every day. Cherry picks go out once a week. I'm working on, as soon as I end this, I'm going to finish up the cherry picks and you'll get it this afternoon. What I'm going to talk about is, let's do the Oklo trade first, and then we'll talk about what I'm going to write about this afternoon. And they're not very involved discussions, but they're just data centric. So let's go to 31 days. So my argument about Oklo is somebody has to power all these data centers. Oklo is basically vaporware at this point. All right, it's a little more than vaporware. Okay, I think they're actually doing some testing with their small modular nuclear reactors. And realistically, I think that has to be the future of how we power these data centers. The problem, so if I go in, stocks at 41.23, right around here. Let's say it's 40, down 5, up 5. Skew is pointed to the upside in these things. But the problem is if I sell a naked put in here, it's kind of steep, $1,232. That means it's not accessible. I don't think the $1,200 is something that somebody with a modest sized account is going to want to do. That ties up a fair amount of capital. And then the problem is it's got these 5-point strikes in these 31 days. Let's go in 17. Let's take the 3 days. See what we get for 3 days. 3 days we have single point strikes. So if I go here, if I ignore this expected move, if I go in the option that is 65% probability of expiring worthless, this came up yesterday. And by the way, folks, there was a question that came up yesterday about, can I talk about what skew is, what implied volatility skew is? I just finished a video for the tastylive YouTube channel that talks about exactly what implied volatility is, how it's calculated, and what the skew is. Okay, and how I might interpret it. So stay tuned for that. Check out our tastylive YouTube channel for that. Going back to this, if I sell this 40 put, buy the 39 put, what credit do I get? 28 cents, not quite there. If I pull this up, and again, 87%. I don't really care that the IV rank is 14%. The actual IV is 87%. This is, let's do 2 points. Yeah, let's do this one. Let's let me see. Go out to another expiration. 10 days. Let's go here. Let's go here. And by the way, this is trading, folks. This is just pushing this stuff around. Let's go out to 10 days. And I'm not getting my third of the width of the strikes. All right, this is where I start fudging it a little bit. Maybe I can't pull it up. I'm buying 37, selling the 39s. This trade, 71% probability of making like about $28, $27 before expiration. $2.19 versus 100 of theta versus 145 buying power reduction. 2.19 divided by 145 is equal to 0.015. So 0.15, or excuse me, 1.5 theta return on capital. I like that trade. Let's ship it. Bing, filled 55 cents. All right, whatever. Anything, reason to do the VIX and not the VX, just curious. So Jared, the question is, why don't I just trade the VX instead? Because the VX futures are expensive. It's as simple as that. And that's just like buying stock. Okay, so if I have this VIX future here and I want to buy it, it requires, where are my numbers here? Review and send. It requires $6,000 of capital to buy that future. Yeah, I can do a $6,000 margin requirement future. And I'm not bragging, that's not the point. But basically, this is just a 50-50 bet. It's why I sell a put spread in corn as opposed to buying the future. That's it. And to go back to, let's clear this out. Going back to this VIX thing for a second. Let's go to the options. Let's go to VIX. These options are trading the September future. Okay. So even though these are not, strictly speaking, futures options, they're priced off the future. So it's like I'm trading, selling that put spread in there is like I'm trading options on VXU, but I'm not. They're VIX options that will settle the cash, but they're priced off the sub future. That's why, even though it's in the VIX, I'm kind of trading the VIX futures. So that's the reason. That's just the reason. The VIX futures are expensive, and they're just 50-50 bets. That's my take on it. So let's see. SPX. Yeah, bearish on SPX. Thank you, Ryan. Yeah, me too. So I just put that in there. Let's go in and do, how much time do we have left? A couple of minutes left. Couple more minutes, a couple more trades. So Oklo, SMH. It's also looking at, so the SMH, let's do Meta. Who's bearish on Meta? I'm bearish on Meta. Stock's down. I've had some pretty good luck being bearish on Meta in my own trading. It's getting crushed. And it's like, look, am I a trend follower? No, I don't really look at charts. I don't look at trends or anything. Should I be a contrarian here? I don't know. What does the crowd say? I don't know. Bullish, bearish on Meta. Me, I kind of want to lean bearish. How about can we do a 1-day strategy on the 448 right in between here, down 5, up 5? Yeah, there's this. Let's do a 1-day call spread. Selling a 1-day call spread in Meta, 61 cents. So let's do this one. 84 cents. Not bad. Okay, so generating $13. I have $166 of margin. So this is a 1-day trade. Do they have any no zero DTEs for me? Volatility is pretty high, 39%. Nothing else. All right, I'm going to ship this off. No, I want to do 80. Let's do 81, 82. Ship it. A little greedy for this thing. Ship it. Point B Traveler, TP, what are the cues you look for a day like yesterday when the IC strikes are breached and the market dropped in the midday? Exited 2x loss. How do you play the red days with your IC? So I don't adjust those things. Hey, filled on Meta. Down with Meta. I don't adjust those. The reason is that if let's say the market's down and I rolled the call side down, it is just as likely that the SPX blasts right back up again in the last 15 minutes and kills me on the now closer call side. Maybe I'll just take the call side off if it's trading for like a nickel or something like that. But I think if the loss is getting bigger than you want to have, in other words, you're okay with the max width between the strikes, maybe you sell $10,000 worth of risk. But it's a little bigger than, okay, I want to quit. Just take the trade off. There's no adjusting it. Make sure you're not doing more size than you should be. So if you're kind of feeling these iron condors, I'll start with a 1 lot. Keep the strikes to 5 points wide. Keep them tight and let them go. That is, in my experience, the better result. Take them off what I do is I take them off at half max profit, half whatever the credit is, and then if they're losers, let it go. Because sometimes I've seen too many times that SPX turn right around and turn a loser into either a smaller loser or even a little bit of a winner. And it is very frustrating. You think I should be managing this, so I should be doing something here. I do not. Yeah, so you exit it, and I have no problem with exiting on that sort of thing. But look, we can address that when we have a little bit more time. I think I'm out of time. Do we have one more time? Time for one more trade. Let's do SpaceX. How about an Iron Condor and SpaceX with 3 days? How about, let's just do it, people. Let's just do it. $1.93. Oh, these stupid half-point strikes. Hate these things. All right, fine. We'll tighten now. No, I hate that. I don't want to. Okay, skipping SpaceX for now. Or do we just want to be bullish on SpaceX again? I've made that mistake too many times. No, I'm not getting the credit. Not getting the credit. All right. So what we did today is activity. We sold a call spread in Meta, sold a put spread in Oklo, working VIX, bought a put spread in SPX, working put spread in ZC, sold a put in GS. So getting some trades off. Thanks for joining us. This was not a trade recommendation. If you do decide to trade this stuff yourself, please do not take any more risk than you're comfortable with. Stay tuned for some more trading. Ilya is coming up next, and I will see you guys tomorrow.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stuff.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
Investopedia says we're the best for options trading. Stockbrokers.com says we're #1, and Broker Chooser raves about us too. So what else can we say other than boom? Trade like a trader. Tasty Trade.
We're back. This is Futures Power 45, sponsored by CME Group. I'm your host, Chris Vecchio. He's Ilya Spivak. We're on until 3 Eastern, 2 Central today, and then we'll get Tim Knight, Slope of Hope himself, to take you up until last call, where I'll be back. Ilya, rough day today for markets. The 30-year Treasury yield rang the bell of the highest level since 2007. ZB broke below 108. Oil prices moved up marginally, and stocks that was enough. Too much. These yields shouldn't be this high. They can't be this high. We can't function with yields this high, Ilya. Everything that requires a good deal of financing, right, in the AI space, it's getting hit pretty hard.
Well, take a look at ZB, because you're right. There was all kinds of hand-wringing about, oh my God, this is the worst, blah, 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 since 2007. And then it didn't hold.
No.
Then it turned and came back into its range. And when you look at a 4 hour, when you look at an 8 hour, it didn't just get back into its range. It barnstormed back and erased the breakdown.
Mm-hmm.
Looks like a false breakdown to me.
I actually
bought a little bit here. I bought a little bit here because to me, this is not about the Fed. To me, the Fed lives toward the front end of the curve. And what's interesting about this is that it's happening all across the world. We're seeing a huge jump in long end rates everywhere. And the great Robin Brooks makes a very interesting point here. He was discussing it on his Substack this morning. And he makes the point that this is about essentially fiscal concerns all around the world. And there's an interesting stacking of the kind of countries that are seeing the biggest increases. The U.S. is by no means the one seeing the biggest rise. The biggest is in places like France, Germany, Japan, of course, is in the lead. So the countries that don't have the global reserve currency and lots of debt, whereas the U.S. just has lots of debt. And so, but clearly has the global reserve currency and is still, by almost any measure, the most eligible borrower, sovereign or otherwise.
Not if
that doesn't mean
has his way.
Yeah, well, that's the whole system.
He's
that's
talking about it all
situation.
weekend long. Talking about it all weekend long. I was tweeting about it over the weekend, retweeting about it over the weekend. If you want to get rid of the dollars, the world's reserve currency, you are effectively saying, I want everyone in my country to be poor. That's it. Full stop. Don't need to think further than that. You get rid of the reserve currency, America will be poor.
How frequently
will make less?
How frequently does JD Vance, you figure, talks to Scott Bessent? Because Bessent could explain this to him.
I don't think so. I think like it speaks to like Curtis Yarvin, and I'm going too deep in political weeds here. Anyway, Ilya, dollar reserve status.
Yeah, Scott Bessent. If anybody's got Vice President Vance's cell there, Scott Bessent could explain this to him. Basically, the entirety of U.S. hegemony rests on the ability to borrow with impunity.
Wait, isn't it crazy today, by the way?
On the dollar.
Isn't it crazy today, by the way? What are the odds? The 10-year yield is breaking out to its highest level of the year, and all of a sudden, when U.S. markets open up, it's like someone is out here stepping on the curve.
Yeah.
Hasn't this administration shown a proclivity to get feisty and intervene in the market when the 10-year yield is up in that 4.7 range? Can we point to interventions, memorandums of understanding, ceasefire agreements, pick something out of a hat since late May? Get to 4.7, the administration announces some nonsense. Today, they haven't announced anything except for the fact that now apparently the Strait of Hormuz is U.S. territory. And
could be.
And bonds are rallying sharply after we get through 4.7 again. I mean, Ilya, this is not a market for coincidences. We've seen this movie before.
Yes, we have. And so against my better judgment, because I have to trade the price action and because I can't be just gun shy because this hasn't worked before, I have to be a buyer of the long end here because I look at this and I say, right, so we had a breakout. We got pointedly rejected. And as long as we've seen this administration shake the trees when the bond market tells them enough, they stop. We saw that with Liberation Day last year. When the bond market went into conniption mode, the administration very quickly backed up and said, whoa, hold on, no. That's not what we're doing. Calm down now. Tariffs? What tariffs? Did we say tariffs? Hold on. Give us 90 days to rethink what that word means. and then give us 90 more days to really think about it. And then maybe we'll start to trickle out something. Just don't freak out. Don't freak out now. Hold on. And we're at those levels, by the way, again, on tips, which is fun. But I think when you look at this whole thing and you go, okay, if in fact there is a global concern about sovereign risk, that money is going to come out of places where that sovereign risk is a real thing. And it's going to go into places where it's less of a real thing. And so if in fact we're going to really worry that Japan finally got it wrong, that Europe is finally going to face a reckoning, if that's really true, which I doubt, but if that's really true, then the money's going to go into U.S. debt because there's nowhere else to go. And so I'm looking at the 30-year here and going, it rejected the breakdown. You know what? If I'm wrong fast. But if I'm right, there's 6-to-1 risk reward here on a TLT call vertical. 59 days out.
59 days. 59 days is a long time for a lot. I mean, right, 59 days from now,
dilute your exposure to Delta, and a TLT vertical here through the ETFs could be something you use to make this go smaller. You don't have to use the futures. You could.
So I'm gonna quibble less with you because you're going that far out in time. Right. To me, the risk is the September Fed meeting. If the September Fed meeting comes out and produces a hike, then the bonds are going to rip. Right. I would point to two things here with respect to this conversation. This came out last night on Bloomberg. Citadel Securities says spiking yields reflect Fed policy risk. Who here has been saying that for the past several weeks? That's why the long end is blowing out. But this is what I'm talking about. Besant moves. Wall Street sees a bond market angst. So listen.
I mean, that's why I like being a buyer here. I mean, I think you're right. I think we've reached the pain
bond
point.
Market is sensing. So the market sees a pain point and they're just going to give Besant 4.7 and say, you know what, you're trying really hard here. We'll let you have 4.7. We're not going to push this further. Or when the market finds a whale on one side of the move, does it hunt? I'm staying short. You haven't convinced me. Short-term time frame, no, because we haven't gotten any indication that Fed rates are moving in a more restrictive direction, and the SR3 reflects that as much today. We can have part of the reason why I'm obsessing about this little particular thing is that this has not been a result of a sudden, oh gosh, the market now sees hikes coming. We don't need to be fearful of those inflation problems coming at the long end of the curve. This to me reads as what's in the zeitgeist right now. And what's in the zeitgeist right now is that Besant's stepping on the 10s. And as soon as we cross 4.7 today, the market open, 10s and 30s get stepped down. This is a fight that I think this is a fight the market wants to have. The market wants to force the Fed to have higher. If you're not going to hike for us, we will push higher rates onto the market for you.
That has been a story that has been going on already. And arguably, that's already something that's anchoring here. Look at our favorite ETF here recently, TIP. It's a basket of tips. And you can see here that it's anchoring now and has been anchoring since the beginning of August. So the market is not forcing the issue here further in real terms.
For now.
Moreover, gold has popped, silver has popped, the dollar has sold off, having stabilized all through July, even as those tips were surging to the tune of 3%. Moreover, Fed rate hike odds have fallen across the entire Fed funds spectrum going through the end of next year. We're not even sure we're going to get one hike anymore. Even that conviction's loose. Still looks like we're going to get a performative something with a 90 plus probability in December, but December is maybe a pricing waypoint than a real number, because before then it's 50-50 and after that it's 50-50. So there's just some sort of magic in December. Maybe that's because that's when the task forces are supposed to report. So the pricing around that meeting is fuzzy. But the likelihood that we're going to get any hiking at all has been falling all through August. And gold and silver and the dollar seem to know that ahead of time.
Well,
Meanwhile, the Atlanta Fed GDP Now growth model has lost 2% in 2 weeks and
It's still
went
at
even
4.8.
lower today.
So it's
No,
what,
it's at
4.3
4
now?
now.
4 now? Okay.
No, 4.
Here's the problem with your view. Jim Cramer tweets today, we wake up
Yes.
to stories about worldwide bond sell-offs, Houthis doing what Houthis do, Oman in the crosshairs with brand new threats, a pal like Kim Jong-un, $1 trillion interest bill on U.S. debt, and they're still giving money to Aschenbrenner. You just want to go back to sleep if only you could.
Okay.
Jim Cramer's the worst weather vane for this kind of stuff, Ilya. Just pointing this out.
I mean, listen, at some point, when you have been a reverse indicator, a contrarian indicator, if you will, for 20, 30 years, and everybody knows that you are a contrarian indicator, and everybody is trading you as a contrarian indicator, that's a contrarian indicator.
Okay.
At
Ilya,
some point.
Let's go to the charts.
Now,
here
who
for the
knows when
S&P
that is?
500.
I'm not by no means suggesting that I am taking these comments from Cramer and saying, yes, follow along. No, I'm just looking at the bond market and going, they could have had a breakout today and then didn't.
Maybe. S&P 500, line in the sand is probably the highs that we had in June up near 76.95, we'll call it. So today's pullback is modest,
That's what I'm looking at.
77.22. But it's 3 days in a row. It's down about 1% from the highs that we had on Friday here. Back below the 1 week moving average, by the way, for the first time this month on a closing basis, potentially. So we'll want to keep an eye on that. And then that 1 month moving average is at 7677.43. As for me here, Ilya, I had been in a short iron condor in the S&P 500 a while back. And when this thing started running up, I noticed that the short put spread side of my trade had gone from being, this is we're talking $25 wide strikes here. It went from being around $8 and change down to, I think, less than $2. Like, there's no reason to hold on to a short put spread when you've reached 75%, plus of your max profit threshold here. The iron condor, the short call spread side, though, quickly went to max loss. So I held on to it, figuring what's the worst that happens? It's already at max loss, going to Thelma and Louise this thing. Maybe the market comes back in a little bit. I could peel this off at a little bit less of a loss. So today, while my MES position, ESH7 positions are hurting, those have different time scales that I'm working with here. And I still feel good about the 8,000 calls in ESH7 that don't expire for another 130 something days. So I'm not doing any adjustment there. But this one, from being a 600 plus loser to now just around $422. If we get a little bit more of a dip today, if we dip below 7,700, I may not look the gift horse in the mouth and just take this as an opportunity to take off a little bit of a loss or smaller loss in this side of the trade, and then netting it out. As long as I lose less than $310, then I'm going to break even, at least on the iron condor. So pull back another few days of pause this week. It wouldn't be the worst thing in the world for this particular leg of how I'm trading. But the Russell is the other thing that I have that's in the futures market here with 24 days to expiration. I was thinking about taking this off yesterday, and I did not, because I got in around $6 and change. I got at $6.40 was the price that I got onto the credit. Now it's trading back to $6 or $5.80 here. It was $4.80 yesterday. Hadn't decayed to a third of to 50% more. But this is becoming a little bit of a test here. 3,000 can still work. Not the greatest looking chart all of a sudden after one day. Now listen, tomorrow could bounce back. We're holding up against the 1 month. Then I'm going to be singing a different tune. No change necessary here, but a little uncomfortable. Never like seeing gains go from bigger gainers to smaller gainers, bigger winners to smaller winners. But it's something that we just deal with.
Yeah, I mean, I think you look at this and you sort of let it find its way. Yesterday, we were talking about, okay, this upside breakout in a world where the economy seems to be weakening under the surface doesn't make a whole lot of sense, because if these Fed rate hike expectations are weakening because finally there is something cyclical that's starting to get sniffed out, and it certainly looks that way after the abysmal retail sales, the abysmal consumer confidence, the decline in CPI, half of which was accounted for not by adjusting crude oil to a war that was maybe on the wane then. Different story now. But maybe on the way then, but came from core services, which is where most U.S. consumers shop. That Russell was uniquely vulnerable because it doesn't have a huge tech sector in it to hold it up.
No.
And data centers that are going to get built no matter what, maybe. So you look at this and you go, right, okay, that breakout was a little suspect, and indeed we undo it here. I wouldn't go so far as to say that I'm prepared to be a seller. I think that line in the sand there you have at about 3,000 is a good one. I'm not rushing to jump in front of this. I want to see what the FOMC minutes tomorrow say. I like this idea that the market has overcooked Fed rate hike expectations, and then now we have to have a big unwind all around. So I like being long precious metals. I like being short the dollar. I'm not yet to the place where I think it's time to dip back in on the short side of stocks, because stocks have, at least last week, reasoned that falling Fed rate hike expectations, that's a good thing. They haven't really come to terms, it seems, with the idea that those rate hike expectations are fading for all the wrong reasons. Crude oil is up. Those rate hike expectations are not fading because the war is solved. They're fading because the economy is choking.
I think that they're fading because Kevin Warsh said, we're not going to do this. And if Kevin Warsh said, if it's laid out a different argument in June and July, the market would absolutely be pricing in hikes still.
I mean, it was a very hawkish statement.
This is probably our biggest point of difference right now. I am so on the opposite side of you about the economy being in a difficult place right now. It's not a good place, to be clear, but like we're not on the precipice of recession. Timestamp it. 818, 238
let's take a screenshot. Let's take a screenshot of this moment right here. It's August the 18th.
Yeah, go for it. We will not have
it is 11:40 in the AM Pacific time.
Very specifically, we're not going to have we're not going to have a contraction in GDP in the third quarter of this year or in the fourth quarter of this year.
I agree with you there. I don't think that matters in the slightest. I don't think the market needs a recession at all in order to say it is absolutely bananas to think that the way we are going to solve inflation here is with a rate hike at a time when the economy is losing jobs in the latest report, when the impetus to disinflation is a falling away of demand in core services, the biggest part of the economy, at least on equal footing with an adjustment in crude oil, losing its wartime spike, and that somehow all of this is just fine in an environment where almost all growth is coming not from consumption, which is already on the back foot, but from a tiny slice of the economy, less than a fifth, and that's the data center build out. The idea that this is sustainable is lunacy. Of course it's not sustainable. Consumption is 5 times larger. If consumption takes a back step, it doesn't need to go negative. It just needs to contribute just a bit less. And looking at the retail sales numbers, the inflation numbers, you can clearly see that that's what's coming. And the markets are erasing Fed rate hike expectations because they see it too.
So if the market sees declining inflation expectations, why are long and bonds going up? Why are those yields blowing
Because
out?
that has absolutely nothing to do with it. Because what's happening with long end bonds is happening for the entire G10. It has absolutely zero to do with what the Fed is going to do or say. It has everything.
Disagree.
I mean, we know the long bond is not a reflection of Fed policy.
No,
we know the long bond is way too far for the Fed to influence with a 25
none of the
basis
treasury
point
curve.
move.
None of the treasury curve is directly related to Fed policy, and the further you get in time, the less influenced it is. But anything that the Fed does that can pull on growth or inflation relative to market expectations, there's empirical evidence that it moves out at the long end of the curve.
Well, no, but consider that. So you've had a relentless march higher all across the borrowing cost structure, basically since the start of this war. Okay? What have you seen? You have seen a massive, massive, massive build out in rate hike expectations, where at one point we were looking for 2 hikes this year. All of that's gone. Why is the long end not responding? We'll go back to tips. Tips have been relentlessly marching lower. Real rates have been relentlessly marching higher. Why? Well, because all of this, and why everywhere? Why not just the US? Why more so in Japan, more so in France, more so in Germany, more so in the UK, more so in these places that some have worse debt problems like Japan, some have less bad debt problems depending, but all of them, unlike the US, don't have a global reserve currency. So why more there?
Well, if yields are coming in, then
global fiscal thing.
If yields are coming in, then why shouldn't we buy the dip in stocks? If like we're worried about yields going down, and all of a sudden this cost of money problem that was
Because
flaring
this is
up
not
overnight.
good news for stocks. Because the reason the markets are looking at rates jumping everywhere is they realize that indeed we are looking at an economic downturn.
This is like
and the
ergonomics,
only way
Ilya.
to deal with
Rates
it
are
is
going-
borrow and spend more.
Rates are going up because the market thinks an economic downturn's coming.
No, the stock market hasn't seen it yet and refuses to. And we're going to see when and if. But rates are going up because everybody understands that the fiscal hole is only going to get larger.
Yeah, it's going to get
Everywhere.
larger. TP's been all over this. TP's been all over this. But this is one of the reasons why you can't be bullish on the long end of the curve right now while we're in the midst of the AI infrastructure build out, because the corporate debt issuance to help finance the infrastructure build out is sapping demand for treasuries in a material fashion at the long end of the curve.
I mean, this has been my song and dance since the beginning of the year, that inflation is, yes, episodically about oil, but the real inflation is not about that at all. It's actually a much bigger story, and it's because you're overclocking business investment. It's running at 10% annualized, but it's a tiny share of the economy, relatively speaking, to consumers. And so to power the economy on such a small engine in isolation is incredibly inflationary. So we know that. The thing is, that's the prior story. That inflation has already squeezed consumers up against the wall. They're retrenching already. Retail sales numbers show
Klarna.
it.
Do you see Klarna today?
No.
The company that lets you finance your burritos. You can break up your
there you go.
burritos over the span of 6 months.
I mean, I rest my case.
I
There
can't
you
believe
go.
the burrito bond company isn't doing well.
I mean, there you go. So you look at these things that are consumers sensitive, they're getting kicked in the face. And so, and I was just talking about the economic data. I mean, Klarna is certainly a nice cherry on top today. But you look all across the board, the consumer is starting to choke on all of this already. And if there is an economic downturn, well, then all of these economies have to figure out how they're going to borrow more for fiscal stimulus, because there's not much central banks can do to cut.
We're going to get a
certainly in this
global
environment.
debt jubilee. Stop worrying about things. We're all going to agree. I owe you $50. You owe me $50. We both have $100 of debt. Let's just cancel it out. Let's just duration match and cancel it out. Global debt jubilee. We'll all pretend the music will keep going. The punch bowl needs to remain filled. I mean, Ilya, when has any
Do we have
politician in the
any
span of our lifetimes
historical precedent for anything like that? I mean, I know in Japan, in medieval Japan, feudal Japan, they used to have periodic debt jubilees where the emperor would just come out and reset everyone every so often. But that's Japan, and only Japan. And they haven't done that in the modern era as far as I can recall.
Yeah, I mean,
hasn't happened anywhere else, has never happened globally other than I mean, unless you're betting on a world war.
Listen, when you go to the Wikipedia page for debt jubilee, they point out how this was discussed during COVID, and then the history of debt relief section is 2 sentences. The earliest known debt cancellation was proclaimed by Enmentana of Lagash, circa 2400 BCE. Similar measures were enacted by later Sumerian, Babylonian, Assyrian rulers of Mesopotamia.
There you go.
And then that's the end of the section on the history of.
There you go. There you go. This has worked never.
Never worked. Okay, we got to get past the talk. We got to move to the trades. Part of the rotation that we're seeing today here in the market is certainly more defensive. One thing that I'm having trouble wrapping my head around, Ilya, is that like the equal weighted stuff is not really struggling at all. It seems to be a lot of rate sensitive things on the board right now. So telecom, tech, semiconductors, home construction, regional banks, right? Kind of the stuff that if the 30-year yield is going to keep going up and recession's happening and whatever your interpretation is there, like this is the stuff that's going to get hit hardest. There is the defensive nature of this market today. You have healthcare, which is pushing up into a new all-time high here. Ilya, sometimes you punch lotto tickets because we had this equidistant range in XLV that seemed to be breaking out. When did I put this on? July 2nd. July 2nd is when we started to break out. Like we see the breakout. I'm being a good boy. I'm doing what I'm supposed to be doing. You buy the breakout. We broke out, we retested, we started breaking out again. So XLV breaking out here today, we can get a little bit more juice. Hey, this trade cost me nothing now. I paid $1.05 for it. It's now trading at $1.05. Give me another buck or two, and we can have a nice little winner here, Mr. Spivak. So something defensive working in XLV, but also that speaks then to some of the other position that we've discussed recently, which is Procter & Gamble's up today. It's got to get back above that short strike at 145, but the Kimberly-Clark of the world, you see this here, still consolidating above 105, which is nice. Been rolling out the 105, 100 short put spread, Ilya. So the defensive stuff is obviously having a little bit of a better day today. Even in the consumer space, right? Home Depot's given up most of its gains after its earnings. Lowe's, for example, given up a lot of its gains. What else? We have Ross stores coming up this week. It's a little bit lower. XRT, the retail ETF, looked like it was breaking out, maybe now breaking down. But a lot of chop. So unless you're in tech, if you're not in tech, like all my non-tech stuff is fine. SMH getting pulled back here, wheeling out this trade is obviously having a rough session, down $26 on 100 shares, but I'm still short that call spread near 630. So it's helping cushion it a little bit right now. But unless you're in tech, the rest of the non-tech world is just, today's like not really anything.
Right.
It's still, maybe it's day one. Maybe it's day one, but like we need more than just today. Maybe Vixpiration does it.
I'm not ready to say that you have, and I think your chart at the top of the show with the S&P 500 is kind of a telltale one. I'm not ready to say that this is a turn that's confirmed at this point. We do, I think, need to see what those FOMC minutes are going to give us. I think that'll be a meaningful kind of input into this story, because again, if what we're worried about and what we're debating, as I think we can clearly tell by this conversation, is what's the interplay between front-end rates, long-end rates, Fed policy, surging oil. If that's the conversation, as opposed to how many billions of dollars will the hyperscalers rain on these AI companies, if we are now in that conversation, well, that speaks very loudly that what we thought was a bulletproof stock market that doesn't care about macro is none of those things. Maybe it was, but it isn't. We've been talking for ages now, years, about how forget macro, it's the future, baby. We're going to build the AI. It's going to be all the things. It's the Jetsons the day after tomorrow. Suddenly, all of a sudden, wait, fiscal spending and central banks. And if this is the conversation, well, then the fundamental premise of the "this time is different" chorus is, as usual, completely and predictably wrong. So when you look at that, then you go, okay, well, if this time isn't different and the cost of money matters and the macroeconomy matters, well, then listen to the FOMC minutes. Let them tell you that they are not in a hurry. And if they're not in a hurry, well, then you get further adjustment in gold, further adjustment in the dollar, and maybe, just maybe, you start looking at the bonds and go, why aren't they in a hurry with inflation like this? What do they smell? It was a 9-3 vote in July. 3 dissented in favor of a hike. What could these minutes say? Is it going to be any more hawkish than we've already priced in? Look at what the markets have been doing since then, going the other way. So what is it that the markets smell in all of this hawkishness?
So right now, another push higher here in stocks and deterioration in bonds would make bonds really appealing. We've talked before about the Fed stock valuation model, the Fed model, where you're taking a look at the earnings yield of the S&P 500 and you're comparing it to the Treasury 10-year yield, right? And as long as the earnings yield of the S&P 500 is greater than the 10-year yield, then you allocate the incremental dollar to stocks over bonds because you're getting better bang for your buck in terms of risk-adjusted returns. But when that flips and that ratio dips below 1, right, and all of a sudden the 10-year yield is giving you more than the earnings yield of the S&P 500, the asset allocators and managers are faced with the real question: why would I take more risk for less return? Because stocks historically have more risk than bonds. Not there yet. The S&P 500 forward earnings yield right now is 5.02%. 5.02%. The 30 is crossing over the earnings yield. That may be creating some drag, although most people aren't buying stocks with like that kind of 30-year time horizon. The 10-year yield, though, I'm just going to keep an eye on this, 4.706%, Ilya. If Besson keeps stepping on this year, it can, like, the albatross will not weigh down stocks too much. If this thing blows through 4.7, 4.75, we're up at a 5% on the 10-year yield. Correct me if I'm wrong, this is certainly my feeling anecdotally. It feels like when it's the first time the market sees 5% at some point along the curve for the first time in X number of years, that's always a day or 2 or 3 of indigestion and problems for the market. I remember this specifically coming out of COVID. Like the first time the 2-year yield hit 5%, everyone freaked out. And the second time, people panicked, but not as much. The third time, okay, we've been here before. The fourth time, it was like, okay, whatever. But now we're encroaching like the first touch of 5% again, possibly in the 10-year in years and years and years. Rates are always the problem point for me. But I know you and I disagree
Rates
on
are
this.
always the problem. We don't disagree. The cost of money is forever the biggest issue in all things.
I see a little overdone panic here. Okay, I want to give us a trade here in M&Q.
Which is why I'm not stepping in to sell.
I'm giving a trade here for M&Q, right? So the recent swing level around 29,400 or so. I can paint this on the chart. We'll call it 29,300. Some support, resistance, back of support when we broke out. Maybe it holds, maybe it doesn't. But if I'm seeing today's vol expansion, if I'm seeing today's move higher, and I want to say, maybe I can.
I mean, are you going to sell this vol right here?
Yeah, I would take a little stab right now in MNQ, not NQ, in MNQ at 30 days. Where do we sit below our support here? We'll call that what? 29,300. We said a second ago, 29,300. Let's start with 50 points wide down
if you're willing to buy them here, or to put on something with alongside bias like sell this vol, that would be a genuine difference, because I'm certainly not doing that. But I'm also not taking the short side here. I think you're right. We don't have a reversal here that's confirmed.
No, we don't.
I am by no means abandoning my core idea, though, that really the main driver of the story has already tipped its hand. And it's tipped its hand in gold. It's tipped its hand in the dollar. And maybe today it's starting to tip its hand in the bonds.
Maybe it is. If M&Q is breaking out and this is legitimately a bullish falling wedge, then it would hold that this is not the end of the rally. We should probably be holding up around these
It would hold
levels.
right there. That's where it's got to hold.
Below 29,300, 29,250, 29,200. Okay, that's 250 points wide on the strike here in M&Q. So we're looking for at least $83.33 on the credit. There's $84.25 for a 60% probability of profit. Little bit around risking 2 to make 1, Ilya. That kind of fits all the criteria right now. And maybe, and listen, there's no trading volume in here. M&Q is tough like that. Maybe this is better done through triple Qs, but this is a future. So I'm going to take off a quarter and see maybe if I can get it filled.
You might have to go a little bit wider.
I might have to go wider, might have to go into triple Qs, but either way, right? Let's see what's going on here. RSP is not down. The rates, okay, were they breaking out? Yes, now they're not. Ilya's long.
I'm not betting on the short side here. I don't think we have the ingredients.
VIX is tomorrow, but VIX and volatility, generally speaking, today over the course of the day, it's been jostling. It's trying to edge up here a little bit more. I'm going to go to this actually an hour or 5-minute chart here, Ilya. Volatility has been moving sideways since that move higher, but we're going to be back for 30 minutes for the close. Last call coming up later on today after Tim Knight, Slope of Hope here. We'll break down some of the earnings trades that are coming up. We're getting into the dense part of the week. Tuesday, Wednesday, Thursdays when we get most of these names, your Walmart, your Rosters, Lowe's. You already had Home Depot this morning. We have a few things cooking there, percolating. So we will check those out. Ilya, as always, a pleasure. I'll see you for overtime at 4 Eastern, 3 Central. Until then, everyone else, good luck trading and stick around because Tim Knight, he's next. You're watching Tasty Live.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that 1-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade has crypto, and you can trade with 0 commissions, Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
We built Tasty Trade's web platform for today's traders. Drill into data, find opportunity, and track the action with hundreds of indicators. Fund your account and start trading right in the app. Join the club. Tasty Trade.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Hello, Tim Knight. Charts. This is the first decent sell-off we've had in weeks. It's been horrible. I'm probably the only bear left on the planet, for good reason. But one thing's for sure. Whenever the ultimate top is, I will have sold the top because I'm always selling. So count on it. But it's a good day, a very red day. Almost every single short I've got is bleeding, which is wonderful. I came into the day pretty prepared for this, but I also came in prepared on those wretched days when things were spiking higher. But last week, of course, we had those, this is the world that believes in fake news. I just sort of roll my eyes. But yeah, I'm going to say fake news on this one. The PPI, the CPI, ludicrous. I mean, you pay your grocery bills, right? Groceries, there's that new word. You pay your grocery bills, right? And you pay your utility bills and credit cards and all that, go to restaurants. I do. Inflation's not 3%. It's not. And, or the PPI, was it 0? So whatever the numbers were, tiny single digits, deep into the double digits, I would say. $1,000 a month for utilities. A simple lunch with the wife, $70, etc. So yeah, they cranked those numbers out of God knows where last week, and the market loved it, just gobbled it up. But the broad trends are clear. Geopolitically, it's a mess. Energy prices are going up. Bonds are on the whole going down. Today it's up a little bit. Interest rates are going up. And stocks have never, ever been more expensive. They're more expensive than the dot-com bubble. They're more expensive than the financial crisis. If you look at the charts over the long term, those were pikers in terms of bubbles. The internet so-called bubble, the financial bubble, all that, stocks were cheap in those days in early 2000 and in the autumn of 2007. They were cheap compared to where they are now. And this is completely dependent upon AI. And when the AI bubble pops, it will dwarf the financial crisis. And as usual, the bulls will whine about it, and the government will, I guess, bail them out, even though they have no money left, $40 trillion in debt. But bulls always demand bailouts. Never happens for the bears. And I guess we'll just be $50 trillion in debt. So it's going to be interesting. I continue to say that until the election, they will try to prop things up as best they can with scotch tape and baling wire and spit and anything else they've got that's sticky. Scott, help us. But anywho, after the election, things could get more interesting. Having said all that, we might as well look at some charts together. My boyish good looks only go so far, so we're going to have to go to some charts and thumb through what's cooking today. As I said, today's the first sell-off we've had for tech stocks in a long while. The spider has had 3 red bars in a row, but here is, if there's a theme to today's show, it's this. So YouTube title maker person, here's the theme. We finally have a price gap. We haven't had a down price gap in a very long time. That really helps from a charting perspective. Because if it's just like up and up and up and up to lifetime highs, it's like, how about that? What are you going to do? If you get a price gap, at least we finally have an anchor point. We can just slash a line across the screen. And we've got something to work with. And that's what's happened today. We finally have a price gap to work with. And so I've been busy today, but I've been doing this kind of thing where you just kind of slap a new line on there as some kind of guide or some kind of limit or stop loss. So, on the spider, we're at lifetime highs on Thursday on an intraday basis, but we slipped on Friday and yesterday and today, and that is pretty right on. The diamonds are down again just a little bit. They have been bleeding out for a couple of weeks. They've been the odd man out. This was a shooting star that began it all. And down. And we are approaching a price gap here. So this does represent a modest level of support. Let's break it, And if we do, then the next level is down here at this gap. But we've undone a lot of this. And if you look at the ES, if you look at the NQ, the CPI and PPI rallies, particularly the PPI rally from last week, totally dead. Those were eradicated last night. I can only suppose that the quagmire that we're in with Iran and the dawning realization that a $50 billion industry does not justify a $1.5 trillion investment, aka AI, might be causing people to say, I'd prefer cash to these equities. So there we have it. IWM small caps finally giving up something. Lifetime highs on Friday, inside day yesterday, and Pukarama today. So we've thrown off the past 5 days of gains with a 1.18% drop right now, and we are clearly below this gap. Let's just change that location just a skosh right there, bang, like so. And we'll change the color to red to suggest that this is resistance, not support. So everywhere you look, the low yesterday is that price gap. Now, this is not to say that it's all just peaches and cream in Bearland. Population 1. The thing is that these horrible several weeks have been a terrible confidence shaker. And the aggressive positioning I took on ain't aggressive no more. For example, SMH, I used to have puts on that, January puts. If I just put my little fist on my little hips and done nothing, I would have been just fine with those because this was doing great. But the chart was a mess, an absolute mess. And I'd pretty much given up on semiconductors yesterday. Out of nothing but spite, I did short the SMH yesterday, but did not buy puts. Buying puts is, nominally much more profitable because it's an expensive instrument, SMH. And so I've got nice profits on the short, but nothing like the puts, even though they're January and have tons of time on them. So this darling little rally they've been pulling on us for the past 3 weeks has been horrible for the bears, both from a day-to-day perspective and also from a psychological perspective, because the time to go crazy shorting is when you're at utter despair and figure it's all over. And that's when the VIX is like 13 and puts are free, and you just, I shall set aside the colorful metaphors I could offer, but you become tame. And that's a shame. As far as the VIX goes, signs of life. I talked about the VIX yesterday because we were down at Epstein levels here, but we are getting a little higher, blasting to 15 now. As I said, wake me when it's 30, but showing a little bit of life here. Although it's illustrative, I think, of how poor and rotten the ETFs are that are meant to take advantage of this, because here's UVIX up not even 1%. So at long last, you get a day with some selling. You got blood all over the screen. You get a VIX that's up, a meaningful amount, and UVX is up, measured in pennies. This instrument. So yeah, I don't mess with this stuff. I don't know how it's constructed to throw off such poor returns for such risk, but no thanks. Now, the one chart, weirdly, and I specifically mentioned this yesterday, even though I didn't show the chart, I talked about it. The one chart that kind of called it was KORU. It's amazing. Look at this. So here's the chart itself. Here's the price gap. And we got very close to that price gap. Now, as a reminder, this is the triple bullish South Korean fund, heavily influenced by semiconductors and memory chip stocks. And leveraged ETFs should be like a funhouse mirror. It should be just warped and distorted and pretty much useless from a charting perspective. On the contrary, with this one, this is actually very useful, it seems, because even though SMH was just pig slop, KORU was basically saying this is a very low risk entry point for the bears out there. And there's our stop loss right there, like so. So what do we have today? A 23% drop. I seriously doubt there's anybody that heard my mewings yesterday and did anything about it. But if you did, God bless you, because that's terrific. Good for you, hypothetical person. So that was just absolutely wonderful. And if you look at the long term, keep it going, because we've already heard that the good people of South Korea forgot about their pain right quick, as people tend to do. It's like, I will never trade stocks again. 72 hours later, how do you get margin? So they're all heavily invested again, and now they're seeing once more, ooh, should have kept my pledge to myself because I'm getting fricasseed again. So this KRU chart to me suggests that there's massively lower prices ahead. And again, hats off to anybody out there who had the temerity or tenacity to give it a shot, because that worked out really well. A little more subdued is the SMH, which poor old Tim shorted. It puny compared to the KRU, down, but I'll take it. 4.5%. It's not terrible. But as I said, as recently as August 4, it was still a good-looking chart. Really nothing wrong with it. But then we started getting cute and pushed higher and higher and higher, and it got messy and ugly. But we have undone how much? 1, 2, 3, 4, 5, 6, 7, 8. So we've undone about 7 trading days. We're back where we were on August 4th, of all places. So all of this was this fool's errand an appreciation that has already been undone. And this is why, if I had just been a brat and not touched those puts, they would have been worked out just fine. And, I'll level with you. I think it's just going to keep going down, and I'll just get madder every day not owning them. But I've got, at least I have my short position. But I cannot bring myself to go back into that. You know how these things go. But this notwithstanding, which I really resent, market gods, it's still well positioned for just a complete crack up. Broadly speaking, as far as the cubes go, even punier, we're looking at this 23% drop in the KRU. This is 1.72%, but again, I'll take it. We got terrifyingly close to breaking this trend line. We did not do it, and we've leaped lower here. And so this, hopefully, if God is munificent, it will be the resumption of the proper direction, which is down. And it's always a battle between reality and political expediency. And so reality's got us for the moment, and hopefully will continue to assert itself. There's a tremendous amount of white space between here and prime support. So I'm sticking with that, short the cubes as well, and just tightening up. And our old friend Fingered here is definitely doing its job. FNGD up almost 4%. Nice little pop there of the leveraged bearish fund against the FANGs stocks. And it's beyond FANG stocks. It's a kind of an amalgam of large cap tech stocks, but FANGs definitely, it's the general idea. Not that they're all down or anything. Like, here's Microsoft is actually up a little bit today for whatever reason. In a sharp contrast to this, here's Meta, which is down yet again. It's just crumbling. And here was the bottom post earnings, and up we go. And I mentioned this morning, we got pretty close to closing this gap, but the company is so fundamentally broken that not only are we in a continuation of a year-long bear market, a year long, with these absurd valuations, Meta has been in the bear market for a year. That's embarrassing. It should be. But I think vastly lower prices are going to come up for this one as well, especially as Alexander Wang's AI attempts clearly produce no fruit of any kind. So yeah, down we go on that, tumbling away. I have no position, sadly, cynical as I am about Meta. Going back to the whole aforementioned psychological damage, I just couldn't bear with it. But if anybody else out there who's short against these guys or owns puts, I say God bless you again. This is part sermonizing and part charting. I'm offering my blessings to you for having the strength to do that, because I think they're in terrible trouble. And anecdotally, there's a big trial starting against them to hold them to account for their presumably addictive products for teens. SpaceX, just briefly, is they're down, but relatively speaking, they're holding their own. They're down about 2.7%, but the range is working. The range is working as predicted. This is the bottom, this is the top, and some exogenous event or intrinsic victory will be the only thing that can push them above that resistance. As it is now, they're locked in. And as I made mention this morning, the unlocking of shares will continue apace until December 9. The next unlock, that's a modest one, about 7%, will come on Friday, the 21st. Metals did exactly what I said they would do. Finally. Well, not even finally, the whole way, because what I was pointing out was this gap. The gap was never violated. Now, what seemed to have taken a while was an actual dip, but we are turning away from that gap. And that's great. Precious metals are turning south. Here we have silver, SLV, down 3.2%. Same idea. This one actually pushed above its price gap a while ago, about 8 days ago. But this right triangle pattern, which is common to both gold and silver, has held intact. That was never violated. So gold's behaving itself, silver's behaving itself. Miners taking it on the chin, 2.61% negative on that. Gap never violated. So the price gaps are doing their jobs. And I facetiously mentioned dust yesterday as one kind of high risk idea. That's doing okay, up about 5% on dust. So that's pretty cool. I was in none of this stuff. The only thing I did was shorted XME, but not bad. Negative 3.76% on that. So substantially more dramatic drop than plain old GDX. So as I suggested, given the two, I felt XME was a better looking short, and it's behaving it that way so far. One day does not a trend make, but it's definitely a step in the right direction. So my own position is roughly the same as it was before. 28 different positions, all of them bearish. I'll just incidentally state that I did get out of my bond short this morning, not because I think bonds are going to at all change direction, but they were showing a little bit of strength, and I don't like strength on a day like this. Anything showing green, I don't want to be any part of it. So I took bond profits, took TBT profits, and it was just pure equity shorts right now. As far as oil goes, it is green, not massively, but USO's up about 0.25% or so. It's fairly, we've been in this wild range for months and months now. This 2-week war has become a 6-month war, and we're still at it. But the crazy gyrations are for the moment not going around. We seem to have found a happy home at around these levels. But XLE has another green day on its hands. Lifetime highs. So we have beaten, and let's just change the color to celebrate that, to honor that. So we have beaten the highs set on March 30. And as I said yesterday, this is even with much lower oil prices. That's kind of interesting too, which suggests to me that people are very optimistic that this thing's going to be sticking around for a while. These high prices are going to be with us for a while. And the companies that own rights to get that liquid out of the ground and have the infrastructure for it are going to be printing money for the foreseeable future, because what they sell is worth a lot more than it used to be. Let's thumb through just a few individual short positions. Some you've seen, some you haven't. As usual, I put a red dashed line where my own stop loss is, and I'll just try to remember to stop, to mouse over it so you can see the actual level. So here's ALB. This is a newer position. This one's been quite good. Bloom Energy, BE. This is right here in the Silicon Valley. I guess their shtick is that they're providing energy to AI outfits. And this is a good example of the kind of fake outs that are going on right now. I'll just, since I've gone from 15 minutes to half an hour, I actually have the luxury of time. So I always glance at the clock to see when I can chatter on a bit more. But let's look at BE for a sec. So here's the top. Fell, retraced, fell some more, pushed higher. And then what is all this going on? What are you doing? So it's pushing into the pattern. It's violating our stop. It's just a mess. And so it's impure. It's imperfect. It's not textbook. But I gave it a shot, ugly as it is. And finally today it behaved itself, and it's down about $25, almost 11%. And so I just tightened up the stop, which actually should be tighter than that. More like bang, like there. So that's working on. But this is what I'm talking about right here. This abomination, this insult to the chart, pushing into the pattern like that. Because I guess there's so much clamoring to get into the stuff that it even pushes into that overhead supply to some degree, but it doesn't last. That's the key thing. It finally succumbs to reality in spite of that obnoxious interruption of our bear market. Caterpillar, CAT, down over $44. It's kind of a mess, but it's kind of not either. Take note of this channel. We've been in this for a very long time. Nice and clean, beautiful, lovely, down we go. And then we crack it, and we're clinging for dear life to that. We fall away and then rally. And this bar right here, I believe that was earnings day. Very strong open, pushed even higher at the high, but it closed up, but near the lows of the day. So look at that repulsion away from that broken channel. Now, 99.999% of the people, they see this, it's just kind of wiggles on the screen. But if you know where to lay them, you can see where the appropriate levels of support and resistance are. Now, it's not to the penny, but that's a very potent repulsion of that price action, because the earnings, people's socks flew off their feet. And we fell and pushed higher, and so now I've anchored a new stop to this dash line here. And of course, what I'd like to see is a continued demolition of this thing down to at least this price gap. So just a really nice chart example right there for Caterpillar. Our old friend Carvana, finally behaving itself. Here again, just to be completely repetitive, it got way too high in this pattern. I haven't measured it, but it's probably about the 50% mark if you consider this entire thing the diamond, and that's the range, and that is probably around halfway, but it's annoying. And so this had broken the diamond. It fell. Let's zoom in on this. It fell away, retraced. That's fine, perfectly fine. Doesn't get back into the pattern, then falls away harder, and then it keeps going up higher than it did here. Not lower highs. It pushed deeper into the pattern. It pushed above this high. Very obnoxious. But yesterday and today helped undo all of that. And what we want to see, of course, through some shock announcement or God knows what in the days and the weeks and months ahead, is to get way below this low. But this is really vexing right here to put up with this sort of junk. But last I checked, there's no complaints department for this kind of thing, so they're not going to change that for me. There's some amount of interpretation required here. There's some amount of, again, I'm trying to keep this G-rated, but just internal strength. Marathon, weirdly, is actually quite weak, and you've probably heard me talk a lot less about Bitcoin. I've kind of chilled on Bitcoin, not because I think it's going to be a fantastic bear market, but I just kind of got bored with it. How long can it stay at 64,000 day after day after day? So I just said forget it to my Bitcoin inverse. But I am still in the strategy. I'm still in Marathon, and Marathon's having a good down day, down over 8%. And this for all my griping about charts. This one, kind of the same idea. We push deep into this pattern, but it is starting to fall below that huge pink zone right there. So far so good on that one. Finally acting appropriately. And as I said, strategy still into that. We're down almost 5% on MSTR, so that's pretty cool as well. Although, it has been, speaking of boring, it's been very range bound since all the way back to July. All of July and all into August. Look at this. Just playing hopscotch, playing jump rope. Very, very little motion. Far afield from, like, for example, this. That's my kind of thing right there. Now we're just kind of monkeying around where that line is. So, it's nice that we're down 5% today, but we could be up 5% tomorrow and just undo the whole thing. It's been doing that for weeks and weeks and weeks now. Planet Labs, PL, down a bit more than 4%. It's obviously a SpaceX competitor. And, as we look around to the different rocket companies, on the whole, they've been much lower since SpaceX became tradable. I got back into ST Microelectronics, STM. It's a little bit interesting because even at its strongest, say yesterday, it's still way, way, way below its highs. Unlike things like Micron or Applied Materials, which at their recovery peak weren't that far below highs. And their patterns are also just a dog's breakfast. But this one, it's innately weak, it seems to me, because its recovery was so modest. A few more. WDC, this one, thank goodness, down over 7% today. I mentioned this one on my weekend video, and this was, going back to the whole annoying thing. In a perfect world, this gap right here would have held. It did not hold. We, on Monday, jumped right above that sucker and stayed above it all day long. but I still shorted it. I got stopped out at the open yesterday, but I re-shorted it later in the day. And that's worked out because we're down about 7%. We're back below that price gap. But it here again shows that sometimes, it's kind of dazzling that things are to the penny and it's very, very clean. Sometimes, though, it pulls one of these cute little tricks right here. A one-day wonder. But it still worked out because more potent than a little price gap or a one-day move is that channel right there, like Caterpillar. That channel is busted. And it's way more important than, for whatever reason, they were able to lumber their way above their gap for a few hours. It's moot now. So the broken channel is more powerful to me. IonQ, down almost 5%. I guess this is another one of these quantum companies, so I'm into this one. And one last one, another rocket ship company here, Rocket Lab, RKLB, down about 2 3/4%. And there's the stop on that one. So all in all, pretty cool stuff. But just to kind of put a bow on all this, I just want to repeat the theme that, it's not like we're down 5,000 points on the Dow. We're down fractionally. We're down just not even maybe 2/3% on the ES, just a little bit. But what's important is the fact we've got these gaps now. The fact that we've got our price gaps back. It's been a very long time. And so as we look, for example, at the NASDAQ composite and zoom in, is this not updated for the day? Shame on you. Okay. Missing the price bar on this. It's there, honest, there really is a price gap. But we do have a slip on that. And while we're here, and since I've got 80 seconds left, this is kind of a beautiful chart. You can see here this massive bull run going through the 80s and the 90s. So right here, of course, this was the internet bubble. This was the bear market. They used to be a thing. And then up we go, and a much lower top for in the financial housing bubble because it's not tech. And that took a tumble, much briefer, but substantial. And ever since then, March 2009, we've been doing nothing but go up. And the last sort of kind of bear market we had was, of course, back during the post-COVID era. But as it is now, we're very close to lifetime highs. But I'm very grateful for the price gap. We're missing it on that one as well. Yeah, these index charts, this is my platform, so nobody blame but me. But those are end of day based. But in any case, just to sum things up, in 8 days, NVIDIA, that's going to be the big earnings event. There's precious little in the way of economic data between now and September. And NVIDIA is the only game in town, earnings-wise, until, October comes around. So it's a pretty dry season. So really all we've got is to wake up and say, what's going on in the news? And that's kind of the driving force right now. So anyway, a good day, and I hope you're doing all right, and I hope the charts are helpful to you. And I will be back tomorrow morning and afternoon. See you then. Bye-bye.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options, profit, and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
We built Tasty Trade's web platform for today's traders. Drill into data, find opportunity, and track the action with hundreds of indicators. Fund your account and start trading right in the app. Join the club. Tasty Trade.
You bring it, we match it. Get a 3% cash match on all qualifying deposits, up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Ring the alarm, hey, ring the alarm, boys. Turn up the charm. Listen up, y'all. Get out the damn stall. It's the last call. Hey, the last call. The last call. The last call.
We're back. You're watching Tasty Live. This is the last call. I'm Chris Vecchio. He's Errol Coleman here to take you through the final 30 minutes of this trading day as we wind down this Tuesday session. Errol, quick jaunt around these markets. Stocks are lower, but they haven't moved all that much the past few hours. Much of the selling was in the early portion of the day. S&P 500s. We just crossed 1 million contracts traded here in the futures market on the session. Now 77.20 here. We've been pinned down here for what feels like most of the session, though, and I say that because when I checked in this morning, we were trading at around 77.30, and it's now only 77.20. So for those who at the U.S. Open played their short iron condors, or this was a market that would be stuck today, you pretty much nailed it because the decline came overnight and really halted once U.S. Treasury yields turn around. That 10-year yield was up over 4.7 today. Is the administration stepping on it again? Folks will say that's a conspiracy theory. I will say that they have not been paying attention, and the administration's been basically doing something every time the 10-year yield gets to 4.7. So today we try to go through 4.7 and we get rejected, Errol. Okay, so what's the big news here? Software up, right? SaaS, if you're a CRM, for example, 3.7% higher. Adobe, you're up by 4.4%. Mag 7, you're basically flat. And then if you're a semiconductor name, you're getting smacked around. Errol, doesn't this remind you a little bit of the July market?
Yeah, it does. It almost does feel like, though, that July market was a little bit more volatile. But in terms of getting slapped around, yeah, 100%, I would say so. That's definitely comparable.
I was listening to your trade of the day idea because I got to come on right after you. I think you were talking some semiconductor names here. What makes this pullback today so appealing for you to buy a dip? Is it an overstretched position, or is just the pricing there?
It's honestly more so just trying to see if that momentum is going to last a little bit longer in some of those semi names. Like, it's nice we finally had seen a significant pullback from those euphoric highs that we had seen in almost every underlying that had exposure to that space. But with this little pullback that we're seeing, I think it's going to be a true testament to see if this momentum is going to see any type of continuation from the euphoric rally we had seen earlier in the year. So a little bit of long delta on in there. Let's see if the momentum sustains. What are your thoughts on some of the memory names and the momentum we had seen overall over the past few months in there? You think we're starting to top out a little bit? Maybe we get a little bit of sideways movement. Is that euphoric rally over with right now, Chris, or how are you shaping up to it?
I hope not. I mean, yesterday, WDC is a good example. I had been in a position here that just really wasn't fun to be in for a number of weeks because it was a 510, 500 short put spread. And obviously with that pullback the start of August, things were looking pretty darn dire. I used yesterday when we were sitting out 3 days to expiration to take whatever little profit I had off the table. When I put the put spread on here, 510, 500, it was 393 in credit. I was able to take it off for 343, which not a huge profit, but when you're in something that's like 35 or 40 days and you run down the clock down to 3, if you're in it 20 days and you try to run down the clock to 3, right, and you finally get back above water, you get out.
Yeah. 100%.
So fortunately, I rolled out though a little bit here. So this WDC position today is not doing great, but it's at, with the expiration window coming up, I said, I don't want to go so short term. What if I go out to 60 days, 59 days now? It's still a loss today. It's about $1.18 from where I got in, about 260. So now it's trading at 378. But this would be a much worse position if I held on to that short dated WDC 510, 500. All of a sudden, I'm below my short strike. I'm back to max loser.
Yeah.
This is why I've been harping on gamma risk recently so much. Too much gamma risk yesterday in that position. A far smaller loser here today. Period, end of story, thanks to rolling.
Yeah, no, 100%. I felt very similarly in a short micron trade that I was actually in right there. 3 days left to expiration. That gamma risk is picking up a little bit more there. And it was sitting at a max loser within like 24 hours of putting that trade on. So being able to even just recoup half of the max loss feels like a W on the day, or a W for that overall trade, because of that gamma risk and because we only got 3 days left to expiration. So definitely gamma risk top of mind. Was thinking about that in the portfolio all day today as well. So nice to hear you touch on it.
So what I took off yesterday was at 343, just as to put a line under this. Right now that's trading, we'll call it 575. And I've seen it jump up to 6. So this would have been like $250 down compared to where I took it off yesterday, relative to the $1.18 today. So that's what the roll saved, right? It saved a few $100. Now this thing the one I'm currently in may ultimately go for max loss. This could be the top, and we're going back down towards 400. Who knows? But I'll have some time on my side to deal with that if that's the case. And I'm not going to be worried about assignment risk or, oh gosh, this thing needs to bounce back. I have the luxury of letting this bounce back now. So very much with you. The one thing that in the space that I am short, because I'm still nursing mostly long stuff, Qualcomm here. Yesterday, this was the super bear trade that was put on at 60 days to expiration. Why, Errol? Twofold. When you see such strength in the semiconductors yesterday, right? And Qualcomm wasn't rallying, to me, it's like, okay, this is the laggard. If something gets picked off, it's going to be Qualcomm. Second to that point was broadly, it fit my criteria for a technical bounce, sell the rip. It did put it a move above the 1 month moving average, but still below the 50, which has a negative slope. So I want to sell that rally. So although it's bouncing back intraday, like some of these other names are, I'm very comfortable with this trade here. Short the 190, 185 call spread. Also sitting long the 140, 135 put spread here. It's doing nothing. There's still a lot of time left, but if I'm going to take a shot short in semis, it's going to be in the one that is not doing well, not taking advantage of the upswing, like a SanDisk, a Micron, like those have been.
Right. What exactly did you have on there in QCOM? There, they reported earnings not too long ago, or am I mistaken with Broadcom or Cisco, maybe another one?
No, you're right. They're all those names seem to blend together for me too. But the super bear, I call it the double bear. It's the opposite of the double bowl, Super Bowl. So Mike and Jermal have really made that popular around here.
I'm gonna start calling it the double bear now too, then, Chris.
Double bear, short call spread, long put spread. So you're collecting credit, and then the credit that you collect, hopefully, it pays for the cost of the put spread itself, right? And so it's going to be a low cost position to express a fairly bearish view. Either way, though, Errol, what is working in today's market? I mean, what's up on the day? It has to be the defensive stuff. I couldn't help but notice that healthcare is at the top of the board, cycling into new highs. Do you have any exposure in healthcare stocks? Because I feel like I've been trying to get some defensive exposure here, and I have something in XLV. I have not played any of the individual components per se.
No, I have none. I'm very Mag 7 loaded up right now, I got to say, Chris. And then obviously got some Delta on in the indices. And I didn't even really recognize that until you really pointed it out right there. But no, as of now, no healthcare stocks. I don't know what's been the most relevant stock within that industry right now. Is it still United Healthcare? I could have swore I heard a little bit more headlines about that incident not too long ago.
No, it's my beautiful darling Eli Lilly.
Okay.
Which is up to $1,200. I suppose actually I did have two names in here recently. I don't have anything on right now in J&J, and it wouldn't have made a difference today because I took off. I mean, maybe it would have gone down to like 8 cents or 7 cents here, but I had put on a short put spread, 58 cents, took it off for 17. It again, like the structure here is really nice recently, where you have these pullbacks below your 1 month, but above the 50, which has that positive slope. And that, to me, that's like buy the dip. It's a market in an uptrend that's experiencing a small correction. So selling put spreads within there. This thing now looks like a bull flag from my view. Like this thing wants to break out. I'm looking for long exposure here. We had a trade of the day recently that was an AbbVie. Go over to AbbVie here, which is now breaking out a little bit to the upside.
Is that another healthcare right there?
Another one of these big healthcare components. So XLV's largest component is Eli Lilly, LLY at 15%. Johnson & Johnson's just 10.5%. AbbVie 7.6%. United Health is 6.4%. Merck is 5.5%. But AbbVie here, again, breakout, pull back to the breakout level. Where were we? Below the 1 month, above the 50. Errol, watch, rinse, repeat. You have like a system. You kind of got to stick to it. So short the 235, 240 put spread. Again, that's working here today. That was put on last week in ABBV for $1.41. And now it's trading at 34 cents of credit. So actually, Errol, I'm just going to take this off right now. If I can get filled in this, I will happily take that trade off at 75% profit.
Yeah, take a fill, Phil.
Take a fill. So we have that working for us here. But yeah, the healthcare stuff. We had talked about this previously too, and I want to pull up this chart in context of oil. Merck was an inverse head and shoulders pattern sitting up near the highs. People say, don't trade that, Chris, because that's not where inverse head and shoulders patterns appear. And I would say, listen, nerd, you're sticking too close to the textbook. Okay. Technical analysis is not a science. It's an art more than anything because it's based on emotions and people are not rational.
Nature. Yeah.
It's human nature. People are not rational. So we had outlined this inverse head and shoulders pattern here at Merck several weeks back when it was breaking out. I've been playing this bobbing in and out of it. I didn't have anything on today when it was getting to the top of the range because like it's getting to the top, but it does hit that upside target now. So that's good news there. Defense is the name of the game is what I'm getting at though. But can I transition us to oil here? Because this is the chart that I want folks to remember in their head.
Of course.
See this here, Merck, or, in fact, we're going to go to transports here on the weekly chart. Okay. And what do transports on the weekly chart look like? That kind of looks like what we just saw in Merck on the daily, does it not? So then we go over to crude oil here. And there we have something similar forming right now. There's that little inverse head and shoulders pattern up at the highs, not breaking down, which if it follows the path of IYT or Merck, oil is going to be going a lot higher soon.
Yeah, I know oil's still sitting in that backwardation, and it actually looks like the backwardation on oil has that curve seems like it's steepening with that near month beginning to get even more expensive than that back month. But I actually exited my oil trades today just given the momentum to the upside that we've seen over the last like 7 days. I get, if we have a continuation to the upside, didn't want to sit through that potential pullback if that were to come. This is how markets work, right? They trade up and down sometimes. But I got to ask you this, Chris. When do you personally like flip the cards? Right? I always hear you never flip the cards. You stay to the bias set you have. You try to fight for price, find your entry, find a favorable risk to reward that you're comfortable with. But from Chris's point of view, when do you flip the cards? Do you ever flip the cards, or do you just stay on one side of the market until your trade thesis is invalidated? But I hear the term flipping the cards. You never flip the cards. Do you just stay on one side of the market until you get the opportunity you're looking for? Or do you stay hands off, or do you ever jump to the other side?
I'm finding it much easier, and this is a crazy set of circumstances. I find it so much easier to flip the cards and change my opinion
right
in single stocks than I do in any of the futures products.
Ah, interesting.
And I have, and if it's related to something that's like a macro theme, maybe it filters through and impacts my ability in the stock market, but I just find it so much easier to change my mind in stocks. Maybe just by background would be a longer term trader. Right. I've always said how when I'm trading these futures things, I like to give myself some breathing room. My idea is they need to decant like a nice bottle of wine. You got to like pour it into a decanter and then just let it sit there for a little bit before it actually works out. Perhaps it's because I think I see things before other people do. That's probably arrogant and not true. But like gold last year, it was all about that, right? Like I wasn't trading against my view. I was trading around my view for 2 years. And finally last year it worked out and I didn't give up. And then on the way down in January and February, it hurt a little bit. Mm-hmm. It really depends on my time horizon, Errol. And I think this is really hard to do. And I'm still developing this. I think you're developing it. I think all seasoned traders are developing it. How to separate their emotions and what they think they should do versus what they should be doing.
It's such a great point that you're making right there, Chris, because sometimes I'd fight with myself. What's the difference between a trader being emotional and a trader trying to make the most efficient or effective decision right now in this moment? Like, how do you teeter that line, right? I'm not being emotional, but it's like, okay, this happened,
it's
so
ego.
I have more information. Let me change my mind. Because I think there is a difference between just changing your mind and then also being emotional and flipping your bias left and right.
Yeah, I mean, look, I was doing this with gold earlier. I was short 10Z and it was working a little bit around the Fed meeting. And then it kept chopping. And Ilya's like, listen, Chris, hey, you always say beach ball underwater. And
Ilya's trying to get in your head right now. He's trying to get you.
He was right, though. He's like, listen, I'm long, you're short, and this thing isn't going down and rates keep going up. And look at all the things that we usually look at that would be negative for gold. And how come gold's not going down? I'm like, you may have a point there, buddy. And so that I flipped long, and then I caught the move here in August. So perhaps it's because, again, what was my bias though, Errol? I was only trading short 10Z. Last year when I was trading long gold, I was trading long GC. Like my bias is to be long gold.
Let me
and
ask
so when
you
I'm
this.
short, I'm doing it through a smaller product. So if I'm wrong, I don't bear the emotional burden of like, I can't believe I was shorting the thing I was so bullish on. I'm so stupid. But it's all ego. It's all ego.
Yeah, no, 100%. Let me ask you this. That trade, you flipped your position, trade ended up working out. If that trade wouldn't have worked out, would you have kicked yourself for changing your mind and flipping the car?
No, because of my bias. I am more upset with losing money in gold on the way down than I am on losing it on the way up.
Interesting. Okay.
And that's just a total bias I have. And it's just because
it's psychology. Yeah. It's different between individual to individual. Yeah.
And it's because of like last year and the success I had with it and how I kind of made up my personality a little bit here on the network, like always talking about gold and silver. And that was well before they made their moves, right? Jermal will attest to it. I've been talking about silver for years when it was in the 20s, how this thing was going to, go into the 40s and probably the 80s or 100s. And then it ultimately did. So I do like, but this is what I'm saying though. I think why I have such an easier time now, like doing these shorter term trades in individual stocks. They're just tickers and it's just the math. And I just could not care less to learn anything about what any of these companies actually do.
Right.
And so, if the chart setup looks good and the options pricing is there, I've been just taking them. Yeah. And it's been really refreshing. It's like, oh, I can do things this way and not have to have like so much talk and chatter in my own head about, does this really matter in politics, this and economics, that? Like, you can just do things, Errol.
It is good. It is a good point that you made, but being very well informed on the macro environment, I definitely see the perks as well. 100%.
But perhaps there's a lesson here because the market still is. Did I say it's not moving much since this morning? It's only 77.18 here, which closing in on the lows for the day. We're not going to dismiss that. It also really hasn't done anything since, I don't know, when did we last see this tick? 9:30 a.m. We had a tick of 77.19 at 9:30 o'clock in the morning. So if you bet on the market doing literally nothing, you're 2 points away from that was. Part of the reason why I like stepping out, and I've talked about this in here before, how I do like monthly, quarterly reviews of my trading performance to see what's working, what's not working. If I should have been doing something more or less, did I step outside of the mechanics of what I was trying to accomplish there? Was that a good reason that I stepped out, or was it wrong in hindsight? Like, okay, in the future, when I feel this feeling, ignore it because it's clearly not right. Almost the reverse Costanzing myself, where I believe something, so I do the opposite. I knew I have biases, and I've always said I'm not a great short-term trader because I have my background as a CFA charter holder is anchored towards more like longer-term investing,
right.
And then I think about my economics background in school and my political theory background and the lecture at Duke Law School on FX, portfolio theory. And so none of it's short-term geared, and I recognize that problem myself. But by doing more of the short-term trading, particularly over the last 3 and 6 months, I've only begun to realize and appreciate how much of a problem that is for me.
Yeah. No, I one thing that I am fond about shorter term trading is you have a faster feedback loop. So I think you're able to highlight certain traits or characteristics that you have within your trading personality a little bit quicker. Not that
I agree 100%.
Each trader is still going to have their own style of trading, but the shorter term trading definitely gives you that faster feedback loop. And we have a question right here for you real quick, Chris. A point was ask Chris if he's exited his ZB. Curious to know if he still expects the bonds to drop further in his long put spread.
Yes. Ilya and I were having a debate about this earlier because bonds did break into the 107s overnight. And unfortunately, I was saying this on air yesterday, if I can come in this morning and see a tick in the 107 range, I am absolutely going to get out. When I first checked bonds this morning, I checked around, where is it? 635? Yeah, this is it. We're trading on 108.04. And so I start running, I start doing my things. I poke my head up after our production meeting this morning. I'm like, okay, it hasn't moved. It's 108.2. And so in that very small window when I was putting together the morning note, bonds got into the 107 handle, but 107.29. I was hoping for 107.5 or so to roll out of this position. So yes, still sitting long. 10 DTE. I've gone back about half of the gains here today in this, in the 108, 107 spread. Why is this going up today? I don't care about the reason. I see a market that just broke down to new lows, that the 30-year just went up, getting close to 5.5%. You can lock that in. I want to just take a step back for traders and think about this from an investing perspective, Errol. There is a break-even rate of return for most of the money in this market. Most people who are deploying capital into the market on a day-to-day basis, yes, there's a lot of day traders here, but they're pension funds, They're gigantic institutions. They're asset allocators. And they are doing things under a very specific charter, which on an individual client basis is called an investment policy statement, right? And in the IPS, you outline a whole bunch of different things. What's your income level? What's your wealth holding? What are your tax considerations? What are your liquidity concerns? And with all this information here, you go to your advisor and they say, okay, well, if you want to retire with this much money for your nest egg in these years, you're going to need to have an annualized return of 7.8%. How can we achieve that? We can do a mix of this and that and this and that and this. And as you get older, we'll take less risk and you'll get closer to your target. So we can take less risk. Okay. If yields at the long end of the curve keep going up, there's a point where money managers sit around and go, why would I take the S&P 500's earnings yield of 5.1% or 5.2% when I can get the 30-year at 5.5, or I can get the 10-year yield, which is the theory behind this. The Fed model ratio, as it's called, you compare the earnings yield of the S&P 500 to the 10-year Treasury yield. If the Treasury yield goes north of 5.2%, you can get the same unit of return for smaller units of risk. Errol, why would we take more units of risk for the same exact return in the market?
Right.
So higher yields impact asset allocation decisions. Are we there yet? No. Also, Errol, has anything been resolved with the war? Have we seen the refiners go down meaningfully whatsoever? Are gas prices coming in at all? Gas futures today are going to close at their second highest level of the year.
It's time to buy an EV, Chris.
Kill me. Honestly. Honestly, last year I was like, okay, I can time to get a new car. I'm like, what? Should I get an EV? Should I go this? I was going to we were looking at the Q5, one of the Audi electronic cars. We don't have solar panels yet. Next car we will.
Solar panels.
So I went for a gas guzzler and I love the car, right? It's a nice ride.
Yeah.
Filling up my tank the other day was $78.
I mean, I heard a comment from the White House. I believe Americans may have to bear higher gas prices for the time being to keep nuclear weapons out of the hands of Iran. So, just go ahead, fill that up. $85 tank, just a few more times. Chris, hang in there.
Yeah,
that's the consensus so far. But yeah,
we're gonna get a battery installed in the garage soon. That way we can cipher the rest of the solar from the summer, and we get those nice days in the fall and just store it and sell it back to the grid. But
there you go.
My electric bill so far this year has been under $300 total, which is delightful.
There we go. What was it on average, if you don't mind?
$330 a month.
Okay. Yeah, that's pretty good, actually.
Yeah. So paid out of pocket, used the rebates from the government, insurance money from when the tree hit the house, got the panels basically for free.
Oh, nice.
And now they're paying for themselves.
Okay.
So don't feel too bad about that, but I don't have an electric vehicle, Errol. Okay, we're chatting a lot here.
Yet.
Why are these guys ranting and raving about EVs and they're not really talking about the market? Because the market really hasn't moved today. It is sliding here into the close, 77.14 on ES. The NASDAQ triple Q is down by $1.75% here. Errol, I have something going on in Tesla right now, and there's that Abbey position. So we did get out, which is nice. Quick little trade there. Tesla the other day bounced back to the halfway mark between its close prior to earnings and the low point after the earnings. And so I went in here and sold an iron condor at 31 days to expiration. When this was put on, it was not 31. It was sitting in at, it's 31 now. That's what matters. Either way, though, 295, 300, 365, 370, which if you were to put this on today, it's basically at the edges of the expected move, that brown bar here on the trading platform. It hasn't done much of anything, though. So I'm going to keep this. There's no reason to do anything with it right now.
Right.
It's chopping sideways. Vol is up a little bit since I put it on, which is part of the reason why this thing hasn't, clawed in any potential profit despite the, theta decay here. But I like this setup right now. It feels like it's not going to go much higher. And also, Tesla, forget the ticker. Errol, top left, bottom right, bounce back after a big down move. We get back in between the 1 month and the 50-day. The 50-day has a negative slope. This is closer to a sell the rip setup than anything else here. And so if this trade busts out because the call spread side is tested, I am feeling so good about almost everything else I have right now. Tesla's been such a dog. So okay, if anything, I may want to sell another call spread up against the 375, 380 level, but I'm not quite there yet.
So you have an iron condor in there right now, and we're pretty much sitting in the middle of your range right now.
Not going to be upset. Got to stick
You're at
with
the
it.
expected move. Time will do its thing.
We're at the expected move. I haven't done everything well recently, especially, gosh darn it, Amazon. What a bummer of a trade here, Errol.
What's going on over there?
Super Bowl, went in with, Mike and Jermal, took off the short put spread side because it got to like 85% profit. We were trading close to 280. I said, hey, look, I've got like 2 weeks left in this thing. We're get $5 away from my long strike. Why don't I just hold it? It's like a nice little lotto ticket. Problem with that mentality is that now this little lotto ticket's look, I can still make $24 on it. You know what? If someone wants to take this off my hand, I mismanaged this so poorly. Hey, can you believe that? I made money on a 280, 285 call spread on Amazon, even though it's down at 260 with 3 days to go.
There we go.
Poorly managed trade, Errol. It happens.
Sorry, we're on to the next one, right?
On to the next one. So you said you're trading Mag 7. I've been talking a lot. Tell me, what are you doing with the Mag 7
No, you're
here?
good. Trading a lot of semis right now. Like I took off some short delta in INTC today. I purchased a put there. So that was a nice profit with the gap down in those names. And then with that gap down, that profit from INTC helped finance the short call spread that I'm down on right now for Micron that expires in about 3 days. So I've been doing a lot in there. I had some short delta in SMH, which is the ETF for semiconductors as well. So you can kind of already see how I'm leaning overall in the portfolio. But with such a directional move today was a perfect opportunity to take some of those things off of the table. Just in case we get any type of relief pop back to the upside. So we had done that, had some short deltas on in the Qs as well, took that off today. Maybe we get a continuation, maybe we don't. Today was Taco Tuesday as well, so you can never risk a continuation to the downside considering the day of the week.
A few people tweet about it. It's like, guys, don't worry about this market. It's Tuesday, right? Like 10 years on your 4-7 and it's Taco Tuesday.
No, exactly. Yeah. Hey, you got to adapt. Hey, you got to adapt to the market, all right?
So you took off your put here in Intel. I've been looking at a potential trade here. Forget the name. The chart looks decent because we ran up into a former swing level. We kind of failed there. And now we're keeling over again.
Right.
The problem is the math, right? 35 IVR, but 67 raw volatility. Okay, so maybe Intel vol is cheap relative to where it's been. It's at the 35th percentile. But a 67 raw vol for a stock at 59 days to expiration, like that's not something that you shake a stick at. So I'm looking for this. Is there something that we could tether around this 108, 107 swing level here? We wanted to go to the other side for a short 110 strike at 60 days to 59.
So you're a little bearish right now.
But the math isn't there, Errol.
No.
Like, I'm not going to take $1.15 in credit.
No, we're not going to pick up pennies in front of this steamroller for sure.
On a $5 wide strike. I mean, just to do the math simply, we talk about a third of the width. If it was $10 wide starting at 110, the strike outside of the recent swing highs, you're looking at $2.04, so 20.4% of the credit.
Yeah, and you're at the expected move. Yeah, I'm good.
I'm good. I'm really good. I'm not trying to do that here. Same thing for SanDisk. It's off a little bit right now, bouncing from its 1 week, so maybe the story is not over. I certainly need more of a rally in SMH here, but there you go, Micron, bouncing off of the swing levels here. Can we be cheeky here? We have a minute left. We have 5 seconds left. Nothing's going to get filled. Errol,
what are you thinking right now, Chris? I see you thinking something. I see the light bulb on top of your head.
We're going to have to do that in overtime because we're done here. 77.14 on your last call for the S&P 500. Your NASDAQ, it has the roughest of rough days among at least the 4 major indices. Finishes down 1.7%, although bounces from its 1 month average. Was this a rate scare today? Ilya and I have very different feelings on this. As we all know, he's wrong and I'm right. But you can come listen to how wrong he is next on Overtime.
First thing about Tasty Trade is how easy it is.
It's a very quick, light platform. It's all on one page.
And with 1 or 2 clicks, you can be anywhere on the platform.
Being able to see graphically where your profit and loss zones are.
Whether it's a pool, a puddle, or a sea, you can navigate your way out of it with the Tasty platform. So I love that.
You bring it, we match it. Get a 3% cash match on all qualifying deposits. Up to $3,000. You can trade stocks, options, futures, and prediction markets. Tasty Trade. Trade with us.
Investopedia says we're the best for options trading, period. Investors Business Daily raves about us. With stockbrokers.com, we're #1 for options trading and best in class for futures too. The motley fool really likes us, and so does Broker Chooser. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The rates are coming. The rates are coming. This is Tuesday, August 18th, 2026. This is Overtime. I'm your host, Chris Vecchio, New York. He's your co-host, Ilya Spivak in San Francisco. We're here to take you through the next 27 minutes as we wind down this trading day. And what a day it was, where the 30-year yield hit that 2007 high for the first time in 19 years and scared the kids a little bit. But bonds bounced back here over the course of the session. Oil isn't running higher despite President Trump proclaiming that the Strait of Hormuz, including parts of Oman, Iran, and the UAE, are now U.S. territory. Oil obviously looked at it and went, come on. Like, how do we even price this in? We can't even touch this. And so oil doesn't move all that much. Hike odds don't move all that much today, but it's a weird day. It's reminds me of that time in July, Ilya. Software, good day. Mag 7, semis down. Almost like an over-leveraged unwind, so to speak. But Ilya, we have a defensive day on the markets. Your staples, they're up. Healthcare is up. If it's related to tech, if it's rate sensitive, it's down. What an interesting session. It's the first time we climbed past 1 million contracts traded in the yes and over a week. So I guess maybe there's some volume coming
Very
back.
interesting session.
How much does this have to do with VIX expiration tomorrow? Today was the last day that August volatility traded.
I mean, I certainly don't think anything is lost on markets here. Tomorrow is a big telltale thing for a whole host of reasons. The retailers are going to have a big announcement. The FOMC minutes are coming out, and you have VIX expiration. So tomorrow is a loaded day. How you unpack sort of which is going to be the more influential, we'll see. In my mind, I think the kind of meltdown in kind of headline VIX necessarily is something that, and our friend of the show here, Jem Carson, has been talking about this. It's happening at the index level, but under the surface, there's plenty of volatility in individual sectors and names. And so what this speaks to me is a lack of conviction at the kind of sentiment index level, at the market mood level. And that's not good news, because I think as we then look at kind of reasons why vol might be a little bit cheap here and a little bit low, they really start to stack up. I mean, consider what happened today. You just mentioned oil. I agree. I think, were we to get these same headlines 2 weeks ago, even, but let's say a month, we might have a much more violent response, but we don't. Is it because the market has concluded that this war changes its character every 48 hours? And so just as we have escalation today, so too in 2 days' time, we're going to be back to talking and we're going to have the greatest deal in all the known universe? I mean, maybe. I don't think anybody is convinced that we're not. And that's part of it. The other bit seems to be that if you look all across the major assets, the connecting thread seems to be that the market is less sure in Fed rate hikes. And the reason that they're less sure isn't that there is a deal, isn't that oil is down. It's because none of those things are true. There isn't a deal, and oil is not down.
No, the MOU expired today.
Right. So what are we so gung-ho about here as we look at these Fed rate hike expectations fade? Why? Why are they fading? Why are we no longer sure we'll even get one hike between now and next year? Why did this suddenly unravel? And why, on a day when global long-end yields surged, did the surge in the U.S., after touching that 19-year high, fully erase and the bonds actually end the day higher? Why? In my mind, it's because the reason that you're seeing all of this fire and fury is that actually the global economy is starting to turn with the U.S. out front. And you've seen evidence of it mounting for 3 weeks now. From the soft jobs report, to the CPI and PPI numbers, to the retail sales numbers, to the consumer confidence numbers, to the frankly abysmal data today. The Atlanta Fed GDP Now model was adjusted from 4.3% to 4% just today on the strength of today's numbers or lack thereof. Just today. Well, not apparently not. Apparently not.
Like strength.
Right. So we've gone from a 6% estimate at the start of the reporting for the Nowcast to now 2% lower in basically 2.5 weeks. That's a steep, steep decline and a bad indicator on what this U.S. economic data is saying. Now,
well, hold on a second.
You have these FOMC.
If you go to CNN, right, like peruse the headlines here. Well, something about Hayden Panettiere, which I remember her as a kid in commercials locally. She grew up in the county next door to me. She was big around here. Horrible what happened. She's like a month younger than I am. It's like just awful. Bond market is getting hammered. Trump's a draft dodging crook president, according to Ossoff.
Would you expect CNN to pick this up?
Iran losing control. Well, listen, bond markets are getting hammered, and Iran losing the control of the Strait of Hormuz being on CNN. Like those are kind of market-centric headlines on a major publication.
It's not losing this. I mean, who's lost anything?
Well, okay. The argument that they're making. The argument that they're making.
Stuff.
The argument that they're making, because I clicked into the article before I brought it up, is from a report from Kepler.
You did what they wanted.
Is Kepler? It's based on the Kepler. It's from KPLER, the firm. They track ships, and they've pointed out that if you go back a few months, and KPLER's report was out yesterday. I'm going to sneeze, so just a second here. They pointed out that a few weeks ago, it was basically 0% of the traffic was going through the the Omani side of the Strait of Hormuz. Excuse me. Thank you. With their most recent update, 80% of the ships that are going through the Strait of Hormuz right now are going through the Omani side because it's been demined.
Sure.
And they're doing it with their AIS transponders off, so none of these ships are showing up in the official data right now. Which I suppose, if you wanted to find control over the Strait of Hormuz, Iran is no longer able to stop or throttle ships going through to the degree that they were. So I suppose that indicates less.
They haven't shot at them.
Right?
Were they to shoot at one, it would stop.
I'm going to point out this trade that I put on here for trade of the day, Ilya, which was the crude oil position here at 30 days to expiration. I'm looking short the 72.73, 92.93, short iron condo right now. It's not a big trade. When I put it on, it was 31 cents a credit. Right now, it's 31 cents a credit here. So basically the same exact position. The idea there being we have a swing low down on August 5th at 73.10. We have the high on May 18th at 91.27. So I'm looking for short strikes right on the other side of those things. But you see this chart set up here, and I brought this up on last call. Nice little orange descending trend line here. Left shoulder head, right shoulder. I'm going to go to Merck from a few months ago. Ilya. Got a nice little trend line here. Left shoulder head, right shoulder. Merck ultimately broke out to the upside. So I'm keeping an eye on oil right now, where if oil breaks through the July 23rd high of 88.07, even though my short strike in this position will not be tested up at 92, this then looks like it's starting to get into continuation higher territory, ticker agnostic. It starts to look like it's getting in ticker. So I'm going to then flip to something a little bit more aggressively long. I will be reaching for out of the money calls again in oil, as has been done previously. And, looking out at 30 days, I might go up to like a 100, 105 long call spread, which costs 33 cents. That seems like a big
I don't hate it
to me.
whatsoever. I don't hate it whatsoever.
That's kind of my roadmap for oil right now.
If it does what we're discussing here, and I'm looking at the chart setup, and I'm putting another orange line on it, connecting the most recent swing bottoms, and the upshot is very similar. I mean, I'm not looking at a head and shoulders. I'm looking at a symmetrical triangle, which is a consolidation pattern in an uptrend that tends to resolve higher. So very similar kind of,
Both point to the same conclusion.
Right. So I look at this as a symmetrical triangle and go, here's an uptrend that's consolidated into a triangle. The path of least resistance is a break higher. I'm going to wait for the break to occur. Because again, if my running thesis here is that the decline in Fed rate hike odds is not about oil, if it's about the economy, as would seem to be what's lining up with the data and the timing and when these adjustments happen and the response from gold and silver and the dollar, well, then all of that tells me that there is a demand destruction story in oil that you got to be careful with. So let's see. If it breaks higher, I'm in. I mean, as you know, I got long oil back in January, and the war just kind of fell into my lap. But I already thought it is absolute lunacy that everybody is on one side of this oil thing, and everybody thinks we're going to have a glut until the end of time. So as soon as prices started to perk up a little in January, I started buying. I've been out of it since we've started to kind of anchor and stopped making higher highs, but I'll get right back in. Incidentally, just like everybody thought that oil will go nowhere but down, now everybody seems to be on the same side of the bond trade, where they think bonds will go nowhere but down also. And when everybody gets so skewed, when a trade is so vastly hated, it's probably that everybody's finally wrong. So everybody is skewed and the bond markets didn't stick the break. I'm a little long there too.
Ilya, we had some earnings that came out over the course of the day today. They're not huge ones. Home Depot probably being the most notable here, which for the trade of the day yesterday, we were talking a series of short iron condors across Home Depot, Target, Lowe's, just Walmart, pick a name out of the hat. A few that are reporting this week. Home Depot, they had a pretty good set of earnings, but with what's going on in the bottom market, home builders were the worst performers today. So Home Depot finishes lower by 21 cents.
And the data was terrible.
Oh yeah, data was bad today. 322.5, 325, 352.5, 355. Short iron condor pinned in the midpoint of the range. Delightful. Love when that works out. It doesn't work out all the time.
Pending home sales down 2.3% against an expectation of a rise. Housing starts, hold on to your seat here, down 12.4% on the month. Mm-hmm. On the month.
Yeah,
so
rates are going
not
up.
Good stuff here for the builders.
Thank goodness. I said it before. I'll say it again. Thank goodness that we don't have the kind of spreads and mortgages that we did back in 2021 and 22 that we had today. Because if we did, then the 30-year mortgage rate would be approaching 9% right now instead of sitting at 6.75%.
Mm-hmm.
So Ilya, my game plan here, the Home Depot trade was put on for 96 cents. I was hoping I could get a little bit more decay because it was around 50 this morning. It's now 36. So tomorrow morning, take it off, move on to the next one. The next one would be Lowe's, which coming out tomorrow morning here. Likewise, I'm still sitting in that short iron condor at the expected move. I got to say, Home Depot comes out and Lowe's is staying pinned going into its own report. Feels like those are two comparable businesses, right? Home Depot and Lowe's. Okay, so
I would say so.
I was using Home Depot to help inform the Lowe's position. If Home Depot went way outside of its range and it wasn't due to something with its management team because something's going on with Ted Decker, then I would get out of the Lowe's. That's fine. Walmart as well. We're kind of pinned here. We jumped up today, only up 88 cents, but I'm 3 days to expiration. 121, 109 short strikes, and then Target. Same story. Up a little bit today, but 165 and 144 short strikes. So Ilya, I'm set for my earnings the next few days. If the market continues to jostle around, if the S&P pulls back more, I'm probably gonna have to make an adjustment there. But for the retailers that are coming out this week, a good start with Home Depot. And then outside of them, I don't really see much of anything else that I want to trade. I was looking at Estee Lauder potentially for a potential, short iron condor here, but are we even getting enough? And it's a pretty tight move. 45 cents of credit on $2 wide strikes. That's just not sufficient. Even if we pinch them in a little bit, maybe you go to 47 cents, but now you're starting to leak into the inside of the expected move. I'll play around with it. I just, that's before the open, so it's too late. I didn't do it.
Yeah. I mean, I think what we're looking at here kind of overall, for me still is a conversation about guidance. Because if I think that the economy is turning, and if I think that it's turning because consumers are weakening, these are the names where you'd hear that. So I think, obviously, we had Home Depot, that's one name, but the kind of mass of it all, on top of everything else that's coming tomorrow, is still ahead of us. We're going to get TJ Maxx. We're going to get Lowe's. We're going to get Target. Then Thursday, we're going to get Walmart and Ross. In my mind, I'm interested in Target. I'm interested in Walmart. I am to some extent interested in TJ Maxx and Lowe's, but I think the kind of frontline consumer names, and less so the earnings, more so the guidance, is where my head's at. Because if the Fed comes out tomorrow with these minutes, and it's an interesting upshot. I mean, the minutes were a 9-3 vote to hold. The statement was hawkish. And you go, okay, well, what was in the statement and how does that comport with what's happened since then, right? Because this is now backward looking. What they say in this statement: job gains have kept pace with the workforce. Not anymore. Economic activity is expanding at a solid pace. Not anymore. Second quarter was slower than the first, even though consumption rebounded, maybe only episodically thanks to the World Cup. Why do we think that? Look at the retail sales numbers. It's already fading away. So you look at all of it together and you go, hold on now. Let's see what the frontline guidance is from a Walmart, from a Target. Because if they're starting to get a little worried and the FOMC minutes are like, well, if we weren't in a hurry in July, we're definitely not in a hurry in September because a lot of the inputs are less benign than we called them in July. Well, then all of this again becomes the same thing. No rate hike, higher gold, higher silver, weaker dollar, and then maybe stocks realize that the reason that these Fed rate hike expectations are fading are nothing to be happy about.
Who's happy about them? Is the stock market happy that they're fading?
The stock market could be a lot more concerned in a cyclical way and isn't yet. Although maybe today's day one. We'll see. Early days yet.
They've got to pump this market through midterms, my friend.
I think that's kind of what you see at the long end, in a way. Is just saying, well, listen, central banks aren't, if there is an economic downturn, central banks aren't coming to help with inflation like this. They're going to wait longer.
No, inflation's the one. Inflation's the one that's got to go first. They care so much more about
Right.
inflation.
Well, so if central banks aren't coming, and you got to juice the economy, how do you juice it?
More debt.
Right. And if everybody's got to do all of that at the same time, and you're concerned that there is then a fiscal issue in Japan, in France, in Germany, in Italy, what's the cleanest shirt in the dirty pile?
Gold. Not going to tell you. I'm not going to say treasuries.
I mean, of the major sovereigns, that's the best one.
Is it the cleanest shirt in the dirty laundry? We're out here talking about how we're going to end South Korea. I don't think clearly at all. Just like I said in April, I thought that we were going to lose the Iran war, and you said, no, we're going to win it. Iran war, we lost. We've lost the Iran war. I didn't say we were going to win it. I didn't. I don't think we've lost. I don't think the Iran war is anything like over. Or will be over. We lost.
I mean, in fact, I would say
they're not disarmed, and now we're negotiating for the Strait of Hormuz. This is the worst crisis in American history.
We don't have goals.
Worse than Vietnam.
How
I said this before. Pissed off the audience.
Never had goals.
Yeah, well, that's kind of the point, right? Yeah, but that's okay. They're wrong about this. This is worse than Vietnam. It's America's Suez crisis, and England now has a lower standard of living than Mississippi, so they haven't recovered from
America's
the Suez crisis
is worse than Vietnam. That's an interesting thing. To itself.
I think more. I think when we look at the standards of living across countries and what access to clean air, water, education, housing, with Europe's heating problems, I think more people. Yeah, I'm going to go out on a limb. I'll say something controversial. I think more people have died in the UK because of the Suez crisis and the trajectory that the country went on in terms of like the alternative reality. Let's say the empire never failed and they never went on to this standard of living decline. I think the UK's population would be bigger. I think they'd have a higher standard of living. They'd have less mortality. Brexit would have never occurred, right? Like so many problems that result of this. And we see this across the Western world.
I don't think you can even begin to draw a straight line like that. But I don't think whether you do or you don't matters in the slightest. Because we're fighting none of that.
We're fighting this war to reopen the Strait of Hormuz, which is already open before the war started. And so we traded Iranian control for the Strait of Hormuz for no nuclear. Yeah, it's all about the dollar and the reserve status. I get it. But we just put that all at risk. If we don't get the Strait of Hormuz and Iran is nuclear disarmed, then the dollar is going to end up losing its reserve status sooner than any of us could have dreamed.
Not going to happen.
Definitely
not going to happen. Like, for sure, not going to happen in our lifetime. Not because there's not issues, not because we're not making policy mistakes, because there's no alternative. None.
Sure there is. There's plenty of alternatives. None of them are good. None of them are good. None of them are as liquid. None of them are as deep. You can't trust them.
There is not a single other bond market.
No, there's not.
There is not a single other currency market that can even begin to be the kind of collateral that treasuries are and the kind of medium of exchange that the dollar is. It's just not even remotely in this universe.
You're telling me that Japanese and Italian bond markets aren't safe havens? The Italian bond market with its 48 governments since World War II, that can't be a safe. Yeah, listen, I get it. But that the dollar then is in such a tough position where people are using it by like, I have to use this thing, not because I want to, but because it like,
yes.
Because then you don't use dollars at the margin. You keep your reserves in other things that are non-fiat over time. And you only use dollars when you have to transact.
Reserves are a tiny, tiny fraction of the dollar's use. Tiny. 88% of global monetary transactions are settled in dollars, up from 85 5 years ago. It's only become more, not less.
I know, but that's not the talking about. That's because the euro is losing favor.
That's a much bigger use of the dollar than reserves times 5.
I'm aware of
globally in aggregate.
What direction is trade going in right? What direction is trade going in right now? That the U.S. is doing? Are countries wanting more or fewer dollars at the margin? Are they transacting with the United States more or less
for
than they
reserves? Clearly less. Clearly less. But they want less of all sovereign fiat because the system is breaking apart, and you can't trust sovereigns not to weaponize.
Thank you. And that is exactly why
I'm long gold.
I asked the question before when they,
I'm
with
long
all
gold
the sovereigns
and
hitting the
silver and
fan,
short dollar. Let's be
with
clear.
all the sovereigns hitting the fan, where do you go? And you wanted me to say treasuries, and I said gold because we're all dealing with the same problem. That's why I joke: are we going to get a debt jubilee? We're going to break out some Assyrian policy?
Maybe. I'm long gold. I'm long silver. I'm short the dollar. Let's be clear. Also, these issues were there in the first half of the year when all of those moves were going the other way. And I was long dollar and short gold and making money. I think the ship has turned, but to say that any sovereign in the known universe is a more eligible borrower than the U.S. with all the U.S. issues and the war and blah, 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 to say that the U.S. is not a more eligible borrower than every single other one that we know of is just wrong.
Well, we're going to agree to disagree here.
In the sovereign world now, in the sovereign borrower world, name me a country that's less a credit risk with a comparable bond market in terms of size and liquidity to the U.S.
There's none.
Of course not. So what are we talking about?
The system can limp along, and people will continue to use the dollar, and they will absolutely want to do as minimal business with the United States as possible. And if they can transact in other currencies, then they will, or other mediums of exchange, they will. There's a long tail to the.
But they're not.
There is a long. Right now, they're not, Ilya. But there is a long tail of consequences that 5 or 10 or 15 years.
I'm trading today.
Down the line.
Not trading in 15 years.
Well, you're not trading today. You're talking about GDP and a potential contraction of the economy, which is not happening at the moment. With
right, I'm trading in the next quarter. I'm trading in the next 5 weeks. Let's say.
I'm just saying the problem with all of this and the long end of the curve. You have AI issuance. The administration is trying to fund a super unpopular war that's pushing up gas prices for everyone. A guy who ran on the platform of No More Foreign Wars is talking about seizing and taking control of territory in the Middle East. It's a bit
all
much.
of that is true.
It's like
it
so,
is.
You know, I actually make a hold on. I gotta make one point. Everything that Donald Trump is doing wrong kept receipts. Everyone said that Kamala was going to do, that Hillary was going to do. It's driving me up the freaking wall that my gas prices are $4.50 because we're back.
It's impossible to disagree with that assessment.
That's it. That's where I stand.
Those are just the facts.
The facts are that we have not closed below the June high in S&P 500, 7693. We're still above the 1 month. The NASDAQ dropped below 30,000 here today, 29,579, but still kind of through the breakout level when we had that big up bar on August 4th. Is this rates related? We're going to find out more tomorrow, Ilya. Vixpiration, FOMC minutes, of course. We're going to have Lowe's earnings in the morning. You mentioned that there's a few other names out there. Walmart comes on Thursday. Ross Stores comes out on Thursday. But then we get back to where did this calendar go? TJ Maxx, Lowe's, Target, Viking Holdings, Estee Lauder, and Food Truck Alliance. YMM. That's all tomorrow morning. So if you have trades in those, keep an eye on the pre-market. We will have Mike Butler and Jermal are back in the morning, of course, for the live show, and that picks up at 8:30 Eastern, 7:30 Central Time. I'll be there with them in the morning to go over the morning news, and we kick off another great trading day here. I did see a question. When is Gus coming back? He is allowed back, I think, Thursday this week. Allowed back? He's coming back from vacation. We're going to let him into the office either way. He is allowed to come back at any time he wants. Trust me. For Ilya Spivak, I'm Chris Vecchio. This is the end of overtime because we're out of time. So we will see you on the other side of a break, and good luck trading.
What's up, everyone? Welcome to the show. My name is Mike Butler. I'm here with Jermal Chandler, and we've got some retail earnings on deck today, amongst other things. But E-minis are down 36 right now. NASDAQ is down 380. Join us on the YouTube channel if you haven't already. We're streaming live there. You can throw in your trade ideas, questions, in that chat along the right-hand side. But Jermal, how you doing?
PCA, 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 PCA. Did you see that last night?
I saw that he hit a homer in the first.
Hell
and then Suzuki hit a
yeah.
homer in the first.
And then he hit a homer to close the game out.
Did he really?
Yes, walk-off homer.
Amazing.
It was awesome.
I feel like there's been magic at Wrigley recently with a lot of walk-off wins.
Yes.
I feel like that is statistically accurate. We have one of the highest walk-off win rates of this year.
I feel like that's probably accurate. We're going to make it accurate, but that was a really fun game last night. I'm still hyped up from that, obviously, as you can tell. So that's how I'm doing. I'm doing hype because of that. Other than that, like you said, we got some retail